Very good morning and welcome to India Market Open with our hopes and prayers to everyone in Delhi. They faced tremors this morning and not too high on the Richter scale, but because it's the epicenter, everyone felt it.
Yeah.
It's been tough for Delhi over the weekend. The stampede at the railway station also with lives being lost. But with the focus on markets, hope for some relief this week?
Yeah, I don't know. This morning, I'm just feeling a lot more constructive, and multiple factors, and we'll talk about that. But a lot more constructive because a lot of damage is done. And last week, Tamanna, Alex, the slew of people that we got on the channel, and we got a high number of very high voltage people on the channel, right? People who've seen enough cycles. All of them unequivocally said that this seems to be the capitulation phase from where usually the new bull market or a relief rally can be born. Now, whether it happens today, next month, who knows? But yeah, the damage has been very strong.
Whether there's further downside, but you're saying that downside could be limited from this?
Maybe, genuinely, kisko pata hai? I mean, because the FI exodus continues, right?
Yeah.
So that is a problem.
1 lakh crore in 2 months, less than a month and a half.
So the FI exodus continues. 8 consecutive trading sessions of drawdowns all of last week. The Nifty closes below the 23,000 mark on a Friday. Not one day of relief through the 5 trading sessions last week. I mean, we need to have real reasons to feel optimistic this morning. And the global setup perhaps is not really giving us any big reason to cheer. The fact is that even if global markets are great, Indian markets have not been in lockstep in that sense. But let's take you through what the global news flow is looking like. It was a mixed day of trade on Wall Street. The Nasdaq ended in the green as a relief set in that Trump is not applying retaliatory tariffs immediately. The Treasury yields, though, have slid. 10-year dropped nearly 5 basis points low to 4.478%. The FOMC minutes will be watched very closely this week. Meanwhile, crude prices slid as hopes of a resolution between Ukraine and Russia are growing. Brent at $74 mark. That's one sort of good news possibility on the horizon. Asian markets, meanwhile, have opened weak. Japan's economic data is in focus, which is why you're seeing a bit of green on the Nikkei. Japan's GDP grew 1.2% in Q4, sharp uptick from Q3, and plus you had a good number on the export figure for Japan as well. Now, what's President Trump up to in our Trump tracker? The administration will begin talks this week on ending the war in Ukraine. The Russian President Putin and Ukrainian President Zelensky have both spoken with Trump. In fact, he made a statement earlier today, and we'll see if we can play out that soundbite for you, where he talks about the conversation for peace talks going forward and confirms Zelensky's role in the peace talk. Let's listen in.
I think he wants to stop fighting. I see that. We spoke long and hard. Steve Witkoff was with him for a very extended period, like about 3 hours. I think he wants to stop fighting. They have a big, powerful machine, you understand that. Because if he's going to go on, that would have been a big problem for us. And that would have caused me a big problem, because you just can't let that happen. I think he wants to end it, and they want to end it fast. Both of them, and Zelensky wants to end it too.
So that, I suppose, would be the big driver, apart from seeing what really happens with the reciprocal tariffs that President Trump has been speaking about. I'm going to quickly pull up implied open for the Nifty before I get to our first speaker this morning. And it's none other than Dr. Edward Yardeni. Okay, 21 points down is what we're looking to open at, so no real relief. Okay, Dr. Edward Yardeni, President of Yardeni Research, with us this morning. Dr. Yardeni, always a pleasure to speak with you here at NDTV Profit. Thank you so much for your time. Let's start by talking about the proposition of the end of conflict between Russia and Ukraine. President Trump putting himself at the front and center of that. Do you think that this is an achievable goal?
I think it's an achievable goal. I don't know if it would be ideal in terms of long-term stability of that area of the world. But clearly, what we're going to see here is the United States is going to negotiate separately with Russia. And then after that conversation, the United States is going to negotiate with Ukraine. It's hard to see how you get a perfect solution from all that. But clearly, a lot of people would like to see an end to this war.
Yardeni, morning. So I read in a recent report that you'd said that you're in the none and done camp when it comes to monetary policy in the US, and I find that quite interesting because every other week you have data that points to something that might suggest that you need. You might need to spur the economy. It's not really in the docks, but it's not firing on all cylinders. So what makes you say that the Fed is done for now?
Well, the economy has been running growth of 2.5% to 3% at an annual rate, looking at real GDP. We, over the past 3 years, as you know, had the most widely anticipated recession of all times that never happened. It was a no-show recession, proving the resilience, the strength of the economy in the face of a major monetary policy shock. Interest rates rose dramatically, and yet the economy continued to grow. I think that is something we can extrapolate and conclude that perhaps some of these policy shocks up ahead here will also not unsettle the economy. You may be referring to the latest data on retail sales, which was weak, but January was bitterly cold. We had the fires in California, and I just don't believe that the retail sales numbers reflect the underlying strength of the consumer. And the consumer has been strong.
Dr. Yardeni, good evening. Neeraj here. I kind of go back to your start of the year belief around what the S&P and the US markets could do, and the small pivot that global fund managers have made towards Chinese markets, actually a fairly large pivot, but towards Chinese markets ever since DeepSeek came about. And I'm just trying to understand, there is, amongst the large markets, you've been constructive on the US. Could it be yet another year of US exceptionalism in light of the fact that China is seeing renewed focus, and expensive markets like India have come off quite significantly from their highs? So now if you have to pick and choose from this point onwards, what would be the first amongst equals and why?
Yeah, I think you're making a great point. India and the U.S. have been very strong markets. Valuation multiples have gotten high, and a lot of global investors are looking for cheaper opportunities, and they're finding some in Europe. They're finding some in China. But when it comes to the underlying fundamentals, both the economic and political, domestic stability, the rule of law, I think the U.S. and India really still stand out. So I think, sure, these other markets can have a run, but I don't think they're going to be long-lasting. And I think for long-lasting, for long-lasting trends, you're better off continuing to look at the United States and even India in terms of emerging markets.
All right. Just as you drink some of that water, Dr. Yardeni, you talked about India. And the mood right now, pretty somber as far as equity markets in India is concerned. A consistent exit of FII flows out of India. Equity levels just dropping, indices just dropping. Our Q3 has not looked too great. Why do you think India is still a long-term story?
Well, I think for a lot of reasons, a young population, a very educated young population, certainly the potential to become a superpower in the area of technology. There's a lot of technological know-how in India. I think that this rapprochement between Modi and Trump to discuss the potential for much more trade between the United States and India, and maybe using this negotiating tool of reciprocal tariffs to actually bring tariff rates down in India so that the United States doesn't reciprocate by raising its tariffs. So again, I think India has a lot going for it. Certainly a big population, an educated population, plenty of opportunity for infrastructure spending. And I think all that will boost earnings for a lot of Indian companies.
Dr. Yardeni, we've spoken about broadly equity right now, but we're speaking at a time when gold prices are going through the roof.
Right.
I'm just wondering if you think that that's perhaps the best, if not one of the best plays in 2025.
Yeah, I definitely think that gold is a good place to overweight in a portfolio, and everybody's got their own view of what that means. But if maybe you had allocated 5% of a portfolio to gold, maybe you need to consider 10%. But I think gold is actually pretty simple. Ever since Russia invaded Ukraine, the countries that have central banks that the countries that haven't been friendly to the United States that now fear that the United States will use its economic power to freeze their assets when they do take actions that are not agreeable to the American government. A lot of them want to have fewer dollars and have more gold, and so they're buying gold. And I think it's really quite that simple.
I'm wondering what your take is, Dr. Yardeni, on tariffs and the reciprocal tariffs that were announced late last weekend. And of course, we'll need to see how they pan out. I think a bit of a breather that they're not coming in immediately. And there is now some planning around it. It'll come in April. Just wondering what your take is. First of all, will it be as bad as is expected? Or is this, again, once more sort of a warning shot more than anything else?
I think it's more of a warning shot, quite honestly. I'm encouraged by the words that have been used by the administration to describe the adjective that's been used to describe these tariffs as reciprocal, not retaliatory. Retaliatory is what we had in the early 1930s with the Smoot-Hawley tariff, when the Congress raised tariffs significantly, and other countries retaliated, and there was just one retaliation after another. To get out of that mess, Congress, a couple of years later, in 1934, passed the Reciprocal Tariff Act. So reciprocal means that the administration intends to match the tariffs that we're facing from countries like India. But before we do that, we're willing to postpone these tariffs, giving us both sides time to negotiate these tariffs down. So I think at the end of the day, we're actually going to see lower tariffs, not higher tariffs, once these negotiations transpire.
Thank you so much, Dr. Yardeni, for speaking with us. I think it would be a relief for everyone if this doesn't go into a full-blown trade war or choke up the global economy. But having said that, what a tough week we've had.
Oh, certainly. And the worst in 2025 for the Indian equity markets. Let's run through this because you've been watching, I'm sure, the way that the markets have been. I'm pretty sure that you've been glued to the screen. Foreign institutions once again net selling on Friday to the extent of 4,295 crore rupees. Domestic institutions buying and matching that. That has been the case in the recent past. The selling continued in the worst week, as I said, for the Dalal Street in 2025, and foreign institutions have now sold close to 1 lakh crore rupees of Indian equity in 2025 itself. The weekly fall for the benchmarks, the Nifty 50 falling as much as 2.8%. The mid-cap and the small-cap index falling much more, 7.4% and 9.6% respectively, which means that this is the worst week since COVID, actually, for both of these two indices. The fall from the peak is also quite substantial at this point, 12.7% for the Nifty 50, 18.5% for the mid-cap index, and about 22.4% for the small-cap index. I was looking at the number of constituents from the broader gauge that might have fallen more than the benchmarks, and you actually have 415 constituents out of the Nifty 500 that have now fallen more than 20% from the 52-week high. In that time frame, you've had a couple of indices that have actually proved more resilient. And while the Nifty Bank has not done too much on the upside, at least it hasn't fallen as much as some of the other indices. It's down about 9.9%. And the most resilient sectoral index at that. IT is not too far behind, falling only about 10.4% from 52-week highs. The Nifty 50, as I pointed out, fallen more than that, close to 13%. Energy, oil and gas and realty have been the worst performers, and that's despite, for example, realty having performed quite well in the span of November, December or thereabouts. Friday's big moves, you had heavy selling across the board, as I pointed out, and you had a late recovery for the Nifty 50, which caused it to end about 0.7% off the low point of the day. The broader markets capitulated, as I pointed out. 9 stocks declined for every stock that gained. And the selling was across sectors and themes, but banks and IT proved resilient once again on Friday. Neeraj.
Yeah, so I mean, across the board, there is negativity, of course, and global flows will continue to impact sentiment, and the outflows continue, right? There's this lovely story on Bloomberg, by the way, which speaks about how, if you look at Asia dedicated funds, the number of funds which have opened up the taps towards China post DeepSeek and moved out of India. So there is clear, I mean, no point in not calling it out. But the point is, there are a couple of things. So for the very short term, I think Dr. Sikanaran writes in his column that the January lows of 20 to 830 become the key support level in the very short term. And therefore, you got to watch out for that. Lower than that, maybe 20 to 400 odd, but that's 300, 400 odd points, if you will. The positives, viewers, here are a couple of things that you need to watch out for. Now, the percentage of stocks above the 40-week EMA is now in mid-teens. This was last seen in COVID. Effectively, in a bull market, the number of stocks or the percentage of stocks which will be above the 40-week EMA would be very high, right? Because a lot of stocks are going higher and the 40-week EMA is lower. At the current point of time, the percentage of stocks above that level is actually come off from maybe high 40s, 50s to mid-teens. This level was last seen in COVID. This negativity, broader market-wide, was last seen during COVID times. And therefore, typically, from historical levels, etc., or historical perspectives, these are the times around which the markets tend to bottom out. Now, these might be the famous last words, all right? And it will not happen.
No,
but
it's okay. No one's going to hold a gun to your head. You're seeing what you're seeing right now.
And it's data.
And it's data. This is one. Two, the other really important data, and we'll talk about it a bit later on as well, but just briefly mentioning it for people who just tune in around here for our early morning chats, right? The bond equity yield gap. This has been a proven indicator. The 10-year GSAC yield between 7.10 to 6.7, whichever level it moves at, right? Because it keeps on moving. But around these levels, versus the Nifty earnings yield, which is at about 5.67%. That gap has narrowed to 138 basis points. This gap, the long-term average, is 145 basis points. Anything below this, usually, or in fact, there is data which Ikigai says that any time period that you take, 3 months, 6 months, 12 months, 24 months, if you invest when the markets are below 145, you have made more money over that period than you have made money at any given point of time when you put in money to work over a 3-month, 6-month, 12-month period. So if data is to be believed, if history is to be believed, around these levels, if you were to initiate longs, they have paid off rich dividends relative to any other point of time in history. So both from a broader market perspective, wherein above the 40-week EMA, the number of stocks are the lowest, and they are as low as they were during COVID, versus, and the bond equity yield gap as well. I mean, there is history to suggest that things might actually work out. And we'll talk in a bit detail about the fundamental factors too, but from a history perspective, these are great levels. Now, whether it works out this week or over the course of the next 2-3 months, time will tell.
No, so at least one fundamental factor which you think is turned around, because this data is really interesting.
Yeah.
But the problem is that the fundamentals are not supporting it. And nothing is changing between the last 2 weeks and now.
Earnings-wise.
But actually, you would
No,
argue...
earnings-wise, global-wise,
No, so I'll talk
dollar-strength-wise.
about it also. But here's the thing. I think what is not working is technicals. And by technicals, I mean FI flows. Fundamentally, if you look at it, Q3 better than Q2. The government doing what it could.
On
The
CapEx.
RBI doing what it could. No, even the boost for the consumption
Income
boost being
tax,
given.
the 12 lakh crores.
So I think there are a lot of
taxes.
factors that are actually working well. Aside of an earnings contraction in Q2, we've sequentially done well in Q3, even though it's not been a great quarter, and Gautam Duggal and Amish Shah will talk about it. So I think there's reason to be hopeful.
Okay, so this is called watching the glass half
full.
and hoping, manifesting the glass to be half full at this point. But yeah, I mean, if it works, then why not? All right, stocks on our radar. Let's get to ideas this morning for you. I'm starting off with Afcons because of a note from Nomura as the first stock. I mean, we're just towards the end. We've pretty much done with this result season. But this one caught my eye, which was a brokerage note. It's a thumbs up. Nomura has initiated a buy with a target price of 561 rupees. Because they say Afcons is well known for completing intricate projects within stipulated time. Revenue CAGR of 22% over FY 25 to 27 is led by robust ordering momentum, They expect the PAT to grow at a CAGR of 39% over FY25 to 27 and focus on margin sustainability. They say the consistent track record of financial performance characterized by stable margins and a robust balance sheet. So which is why Afcons, because it's a solid company, which I don't know if it's a mix of timing of the market, etc., doesn't seem to have really gotten its due. So Nomura's initiative buy is one reason why I've put this on my radar. Uflex is the other one. Revenue rises and margins have improved. A thumbs up for Uflex in their Q3. These are consolidated numbers year on year. Revenue is up 12.8, about 13%. EBITDA is up about 37% at 454 crores. Margins have come up from 10% to 12.2%. And net profit is at 137 crores versus loss of 67 crores. So quite a turnaround there. What has worked for them? Better asset utilization, better portfolio mix. Forex has also boosted profitability, and which is why you're seeing that PAT figure looking pretty decent. But the gain of currency has been about 25.7, about 26 crores. Sales volumes are up 6% as well. And then the third one I'm looking at is a GlaxoSmithKline. Again, a thumbs up. Key highlights include a strong performance across key product portfolios. Their respiratory portfolios achieved robust growth. Net profit growth was also due to a low base. Let's take a look at the numbers quickly. Revenue up 18% to 949 crores, so above estimates. EBITDA up 34% to 292 crore, a healthy beat on estimates as well. Margins at about 31%. Versus 27%. So a good bump up in margins, which I think is going to go well for the company this morning, the stock this morning. Net profit up to 230 crores, also once again above estimates. So those are my top three.
Yeah, the respiratory portfolio working well for Glaxo. I mean, and you would suspect that in India, respiratory portfolios will continue to do well.
That's that's the downside of it.
Yeah, it's a very gloomy thought,
yeah.
actually. Unfortunately, it is what it is.
Yeah, but right now we're talking about investments in markets, so I'm saying.
I'll tell you what, the first stock that I have picked is actually, it bodes well not just for the company, but also to what you were saying on consumption. Because Mahindra & Mahindra's bookings, it just tells you that there is money out there to be spent. We're talking about the EVs that were launched and went on the shelf, so to speak, on Friday, and 30,179 bookings for these two. And if you look at the fine print of where these bookings came through, it bodes even better for consumption, because premiumization is alive and kicking, and how. I'll tell you about that, right? The context is that 1 lakh EVs were sold in India in 2024. 30,179 was the booking number for these two vehicles that went on stream. 56% of the bookings were for the more expensive XEV9e. 73% of the bookings were for the top-end variants of both those models. Of course, from this perspective, it is an EV, and people have gone for the more powerful battery, or the battery with the more capacity, so that the longevity of the run is more. But still, it's something that you should take away from this. Consumption is very good here. Current capacity, the company has stated it's 90,000 units per year at the Chakan facility, which can be scaled up to 1.2 lakh per year. So certainly they can meet the demand. Morgan Stanley has come out with a note. It maintains its overweight rating with a target price of 3,675. It says that the bookings are an impressive start. The mix was also a positive surprise, as I've mentioned, and the fact that the more expensive model got more bookings. It is likely to be the fastest growing PV play in 2025, according to MS. Second, Citi has also raised, or rather maintained, a buy with a target price of 3,680, but Citi is building in a 52,000 unit of sales volume for the BEV, or the battery operated EVs, in FY26, which is lower than what you would imagine. It's also accounting for cancellations and other factors. The second counter that I've picked is Easy Trip Planners, and this is a disappointing quarter in what should have been actually operationally a very strong quarter. We're talking about the October-December period. Revenue is down 6.4%, EBITDA is down 21%, margin contraction to 31.7%. There's a lot of stuff that has happened in the last few months about this company that have disappointed retail investors. The stock is down quite considerably. Watch out for it in trade today. And the last one is actually a positive, despite the fact that the company reported a loss. It was a lower loss than anticipated. Aditya Birla Fashion is the name of the counter. Revenue has risen only about 3% or thereabouts, but the margin performance is where you should focus. It's coming at 14.75%, and that is better than expected. It's also an improvement in the comparable quarter as well. The net loss has actually shrunk to 51 crore rupees versus a loss of 78 crore rupees. The cost of raw materials also accounting for some of that improvement. The Pantaloons segment margin increasing 170 basis points. So that's certainly a positive for this company.
Yep. Well, interesting list of names out there, right? I'll add 3 more to that list of stocks that you need to watch out for today. And one of them is BHEL. It receives a thumbs up yet again because this is the third order of over 6,000 crores in the last 20 days. It's received an order worth 6,700 crores from Singareni Colliery's company for an EPC package. Now, remember, I think on 12th of February, if I'm not wrong, it received an order worth 6,200 crores from Damodar Valley Corporation. And just before that, it received an order worth 8,000 crores as well. So it's been receiving large orders, and the book-to-bill ratio is very solid. Now, does it execute, or is the order book good enough to revive the fortunes of the stock, remains to be seen, but certainly something that you got to watch out for in the session today. So that's the first one. In terms of numbers, chosen one which may not do well, Bajaj Consumer. Revenues were down 2%, margins at 11.2 versus 15.1. That's a very poor performance on the margins, as a result of which the net profit was down 30%. Let's see if this one has a negative reaction in the session today. And I've also chosen a brokerage note for variety. That's the third stock on my list. On SBI Cards, HSBC has upgraded the stock to a buy from reduce. They've hiked the target price to 1,000 from 560. They say, improvement in card issuance, softening money market rates, earnings upgrade cycle is more likely now. And this is probably the 4th or the 5th brokerage in the last 10 days to upgrade SBI Cards. Do watch out for this one. It's a great way to play. Credit cards is a great way to play a rate cut cycle if you believe that one is coming in India. So keep that in mind. But here's an interesting one too. So top 3 on my list, but guys, there's so many more today. Yeah. There's Sudarshan Chemicals, which came out with a very good set of numbers. Ingersoll Rand.
Good set of numbers. I thought Sudarshan was fairly weak.
No, I think the margin. So the bottom line was lower because of a one-off. They accounted for a 30 crore cost because of an acquisition. But the margin performance looked very, very solid here. So that could do well. Ingersoll Rand could do well. A clutch of names out there, which.
SAMIL also in focus.
Yeah, so a lot of stocks in focus.
Zentech is the other one that caught my eye, and just quickly look at it, and I ended up giving it a thumbs down because profit was good, but other income played a part in it. So the order book at 816 crores. Revenues so up 53%, EBITDA up 4%, but margins have gone from 42.7% to 29%. So big slide in margin numbers there. Net profit up 30%, but other income had a part of it as well. So for a stock which has really been a favorite of the street, in focus as a defense play, I think Zentech might have a bit of a patchy morning.
GSK Pharma also looked good actually.
I took GSK.
Oh, you did what was on your list. Yeah. There's so many stocks that you lose track, right? Yeah. Okay, but by the way, quick reminder, NDTV Profit is holding its first ever conclave on the 18th of February. That's tomorrow in Mumbai. And we're excited to be in conversation with stalwarts of the markets and the giants of India Inc. as well as policy makers that are steering the nation. We'll be live through the day. We're talking about how Indian consumer habits and behavior has changed with the rise of quick commerce, among several other things, and also how to make India the manufacturing hub of the world. We've got gritty entrepreneurs from a brave new generation open up and give us their valuable and very insightful thoughts on all of this. We're excited to host the NDTV Profit Conclave 2025, which is the blueprint for Viksit Bharat 2047.
स्किल के चैलेंज
All right, back with India Market Open, and just so many points to focus on today in terms of results or otherwise, and in terms of brokerage coverage as well, that the list of stocks is very, very high. Now, Sonia, I want to come to you on a stock which has now been in news 3 times in the last fortnight with reason, and that is BHEL. I'm guessing the charts must be terrible, but they have won yet another order worth 6,700 crores. This is in addition to 2 other orders over 6,000 crores in the last 15 days. Is it forming any kind of bottom, or is it giving you any kind of trading opportunity, BHEL, long or short?
So Neeraj, I think it's actually consolidating. It has a strong support somewhere around 185 on charts, which can be seen. But derivative data is suggesting that towards 200, 203 is also resistance. So it's just consolidating. Fresh longs can only be seen if it's able to take out the levels of 203 plus. So above that only you can see it heading towards a 215 plus level. So I think that's going to be interesting to watch. But right now in this consolidation or range bound play, I would suggest that just wait and watch and let the resistance break. In any case, if 185 is also breaking on the downside, then fresh shorts can be seen. But current levels, rather no long, no shorts can be seen. So just wait and watch. And if 203 takes out, one can go for long.
Okay, so BHEL in focus. The first few ticks on the market, I mean, we'll have to wait for it to settle and see if there are any big moves here and there. But Easy Trip is catching my eye. GSK Pharma is catching my eye. Easy Trip 20% up. And the numbers weren't that great, but GSK Pharma about 16% up, that was on our list. ABFRL, another one on results, which is moving. And remember, this is literally the first minute, so all of this will change. Godfrey Phillips, Indigo Paint also there. I'm just wondering, last point to you, Parag Bhai, and you mentioned this very briefly about newspaper reports this morning saying that December quarter indicators are showing maybe an uptick in FMCG and consumption, maybe those tax breaks which have yet to actually come out, but sentimentally is boosting people's spending habits. Do you think that you will see a consumption theme for the next couple of days as a short-term sort of a move?
Not couple of days, huh? So I'll see it as a yearly trend. I would say a year, if you can tell me to give a 1 year sector to be in, that is consumption. For sure. Whether it is, and this will be company specific because we are not going to see a huge momentum in consumption. This is a company specific theme, like in two-wheelers, I mentioned TVS Motors. And there again, it is not only domestic consumption, it is actually exports which is driving the major growth. And plus this PLI benefit, which is going to boost margins and market share gains in domestic market. So I would, in FMCG, for example, I would like to say Liebherr, Pidilite or Britannia kind of names. Pidilite benefits from lower crude oil price, as well as if rupee appreciates a bit, their margins get a tailwind. Plus Q3 itself, their volume growth was 9%. So it is company specific, but I would definitely like to bet on consumption more because stocks have not done well from last 4 years. Government has woken up to the fact that they have to drive consumption, to drive private sector capex also. And RBI is doing his bit by reducing rates and providing liquidity to the system.
Okay, so just look at a BKG this morning, look at a delivery in the pre-open session, of course, for the first few seconds, and one wonders if a consumption theme is in the offing. BKG was 3% up, delivery as well, if you can quickly pull up. Then as we thank Parag Bhai, thank you so much for speaking with us today. There you have it, delivery about 4.5% up. All right, we've been talking non-stop about quarterly results and the large takeaways that they have been disappointing once again. But what are the details? What has worked? What has not? Gautam Duggar, Head of Research, Motilal Oswal Institutional Equities, joining us now for his wrap-up and review of the quarter gone by. Gautam, pleasure speaking with you as always. You know, the one thing which really, and of course you'll start with the overview where you've had a third quarter in a row where there has been single-digit growth, etc. But the small cap miss is the big one, isn't it? Where earnings have just not matched expectations.
Yes, Tamanna, good morning. Thanks for having me. You're right, the small caps vis-a-vis the valuations at which they are trading at, the miss has been quite big in the sense that we were expecting a decline. We cover a fair bit of small caps. We have a coverage of 125 small cap companies. For them, we were expecting close to 5% earnings decline. The actual decline is 24%. And not just the aggregate headline numbers, but even the spread is very weak, I would say. Almost 55% of the small caps that we cover have missed expectations. Whereas on the contrary, if you look at mid caps, they've done fairly well. We were expecting a good growth even in mid caps, at about 17%. We got a growth of 26% for close to 90 mid caps that we cover. That being said, if you look at the 9-month numbers, because quarterly numbers obviously fluctuate a lot, and there is a lot of element of base effect which comes into play depending on the sector that you talk about. So if you look at the 9-month numbers, on a 9-month basis, mid-cap earnings are up 8%, large-cap earnings are up close to 2%, 2.5%, whereas small-cap is still down close to 18%. So small caps earnings have been weak, not just for the quarter, but even for the first 9 months of FY25.
Okay. Gautam, there are a couple of standout sectors, right? And in your report, you're talking about PSU banks and NBFCs. PSU banks in particular, I'm wondering what you think, because some of these names have gotten beaten down. At what point do you say that, considering a lot of them have reported better than expected asset quality, and you're talking about resilience in their loan book, at what point do you say that they become strong contenders to buy into?
So yes, PSU banks have posted a better than expected set of numbers. We were expecting close to 12-13% earnings growth. The actual number was 24%. And the heartening thing is that all the 6 PSU banks that we track have beaten our expectations. In fact, we've upgraded Punjab National Bank to buy rating during the quarter, while our overarching preference, as far as mid-cap is concerned, is still with, as far as PSU banks is concerned, is still with SBI. Now, the thing is, PSU banks are still benefiting from lower credit costs. If you look at their PPOP growth, NII growth, they are broadly in a mid-single digit to low double digit. So NII growth is close to 5-6%, PPOP growth is close to 10-11%. So what happened is private banks stopped getting that benefit of lower credit costs from last 2 quarters because the base is very normalized for them as far as credit cost is concerned. Whereas PSU banks, which started benefiting from the lower credit cost slightly later into the cycle, are still accruing those benefits. I think a quarter or 2 down the line, even the PSU bank earnings will normalize. Having said that, the valuations are still very attractive for PSU banks, more so after the recent correction. You told me obviously very selective in that space because the weightage in benchmark is still very low for PSU banks. As far as we are concerned, we have SBI in the model portfolio, and now we've upgraded Punjab National Bank as well to buy rating. But yes, fact remains that this quarter they stood out because very few sectors in the quarter managed to post 20% plus earnings growth. In fact, you can count them on fingers: healthcare, real estate, PSU banks, and capital goods, and of course, non-lending financial. So 4 or 5 sectors out of the 25 sectors that we cover. And PSU banks are a big part of, the sectors that have beaten those estimates.
Right. Gautam, morning, Neeraj here. Some pockets which posted some very good earnings, but the valuations have been high, and therefore we've seen continued correction, right? So recycling could come in there, and I'll talk to you about that later on. But I want to talk about EMS because that is one key bucket wherein the valuations were very stretched. The numbers by and large seemed okay, but we haven't seen the stocks do well because presumably because of the valuation pullback. What's the thought there now? I mean, do you reckon that a larger part of the correction is done, or is that the new bull cycle? Whenever it starts, we'll see different leaders and therefore EMS companies get relegated to the backbenches?
Sure, Neil, good morning. So 2-3 points on EMS. Clearly, EMS have a very long cycle ahead of them insofar as their fundamentals are concerned. Because the whole push from the government policy apparatus is to drive, make in India, drive PLI, manufacturing, and even the global macro trends are favorable for them. And insofar as supply chain diversification is concerned, some of those stocks had run up way ahead of the earnings, and which is why you saw a good pullback in the last 2-3 months. Some of the stocks are down 40 to 50%. As far as quarterly earnings are concerned, for the 7 companies that we track, if I remember well, the earnings growth is close to 75%, which is slightly below expectations. We were obviously expecting 100% plus growth. But do remember the fact that the quarterly profit pool of EMS companies for all the 7 companies that we track put together is somewhere about 400-500 crores. So percentage miss obviously misguides you. Valuations are still very expensive, I would say, but the growth insofar as this 7 stocks are concerned, the growth is going to be far better than the market earnings growth and some of the other sectors. But are the valuations offering you decent risk reward now after the correction? Selectively, yes. Amongst the 7 companies that we track, we saw earnings upgrade only in 1 and downgrade in about 4 to 5 companies. Our preference in EMS is still towards companies which have already demonstrated scalability, where the operating cash flows are decent, and the opportunity in the next 3 to 5 years is very meaningfully large. So we like Dixon, we like Keynes, and we like Amber, but that's about it. In the model portfolio, we still have just 1 stock because the sector obviously enjoys far less weightage. It's still not part of any big indices. But clearly, valuations had run up way ahead of their fundamentals.
Okay. You mentioned Amber Enterprises, and incidentally, I want to focus on a note that came through just a short while back, and Harsh is joining in to tell you about what Jefferies had to say about a target price of 8,845. Harsh, what are they saying?
Well, it's very solid upside, right? And you know what Jefferies is saying is there are multiple levers, first off, and they've spoken with Mr. Jasbir, who is the chairman, on the sidelines of the UK investor meetings that they've been having. And so some of the levers, first off, one, you've got deepening market, and they're expecting the room and air conditioner market in this regard to grow at 30% CAGR into the foreseeable future. Second, they're seeing deepening customer traction across the board. They're seeing diversification into margin accretive components, and some of those are growing at a faster clip, and therefore margins should go up. And they're also seeing overall in terms of the component space, they're seeing better traction given that Amber size is going up. So some of those factors to well aid Amber for the next 3 to 4 years. Strong levers with regard to electronics as a whole is what they are seeing. In terms of mobility, while there's been some delays, the order pipeline continues to remain robust, and they're expecting a turnaround there. Update on CapEx also remains quite solid, and they're looking at a sales growth of 30% FY24 to 27 and 36% on the EBITDA growth.
Okay, so maintain of a buy target on Amber, and we just took that quick segue for the top 905, later the 905 brokerage call. But even as we get into markets open, Gautam, what seems to be the big takeaway is that large caps are looking more attractive right now in terms of valuations, in terms of corporate performance as well. If you were to narrow that down, would it be focused on BFSI, or what would be the top 2 or 3 ideas that you are liking right now?
So, Tawana, yes, large caps clearly are the only segments in the market which are right now trading at a discount to their valuations average. So, if you look at Nifty 50, it is trading at close to 19.5, which is a 5% discount to their long period average. And earnings have been holding up better there. In fact, 71% of our coverage universe have either met or exceeded expectations on the large caps, which is obviously standing out amidst all the large, middle, small caps. Financials obviously have driven the earnings, but do remember that the earnings growth in financials is also moderating versus what we have seen in the last 5 years. So between FY19 to FY24, if you look at our banking coverage universe, private plus PSU banks put together, the earnings went up 9 times from 33,000 crores to close to 2,96,000 crores, which is a compounding of 55%. Now, on that base, this year they're still growing at a healthy 14%. Next year, our expectation is a bit more moderate because we do expect the asset quality normalization to happen and margins are already at a high. So we are expecting 10% growth next year and then again 12% or 13%. So in that context, valuations are corrected because when the earnings were good, the market derated them significantly. So it is the only large sector within the broader large cap universe which is offering you better risk reward. So within that, we like ICICI Bank, Kotak Bank, SBI, which are of our model portfolios.
Got it. Okay, Gautam, and we'll extend that conversation, but just 20 seconds left for the markets to kickstart. So let's just focus on that for a moment, and then we'll carry forward this conversation. It will be interesting to know somehow whether there are new leaders in the bull market. Could banks be the new leaders, because private banks, because they were not the leaders of the previous bull market. I call it the previous bull market because come December and January, that market seems to have ended. But here's how the markets are starting off. 0.5% in the red. So not a pre-start at all. So 135 points, 22,790. Now this is below Jan lows, by the way, viewers. And if we kind of go below this level and close below this, that may not be a healthy sign. 0.7% now and counting. So the Indian markets continue to be under pressure. Mid caps and small caps, I reckon, looking at the state of the large caps, that they might also be getting punished right now, should bring them up. 1.5% for the mid cap space. Small caps look 1.63% higher. No, there is no relenting of the selling pressure. The Valentine's Day red is being extended. Let's get the heat map up on the screen. Is there some green? Yeah, maybe a few. Sun Pharma, HUL, Cipla, but nothing on news per se. Look at the quantum of red. M&M booked 30,000 vehicles. The stock is down 3.5%. Wonder what it would have had to do in order to open in the green. BEL 2.5%, Tata Steel 2.5%, Shriram Finance, ONGC, NTPC. This is just brutal selling, because I must tell you, in M&M's case, brokerages have a target price of 36 to 3,800. They have put in the right foot forward with regards to the EV bookings as well, and yet it is the top loser. But effectively, Tamanna, it's a sea of red. I'm handing it over to you. I really doubt you have better luck than me.
Yeah. You know, Parag Thakkar called the M&M call because we asked him about the EV bookings, and he said very clearly that it's not quite enough right now as far as M&M is concerned. You know, is this a tariff fear playing out? Is this a consumption fear playing out? Could be a whole factor of things. Tariffs perhaps top of mind because of the kind of losses you're seeing in metals as well, in auto as well, because if they're going to be tariffs on automakers and auto parts, is that going to be a pain point? But yeah, I mean, there is very, very little that is up in the green. Brutal morning by all means. The small cap and mid cap, let's pull that up quickly before we get to the sectoral heat map and revisit. 2% down now. This is relentless. 377 points down on the Nifty mid cap 150. The small cap no better. I mean, cut this any way you want, but this is a market which is in pain. 2% down on the small cap 250 as well. Let's pull up the sectoral index and see whether there's any green, and unfortunately it's only on the India VIX, about 7% up. That's also telling me that there is some volatility which is being expected here, and which is why you're seeing so much of pain. Nifty reality once again about 3% down. I mean, when you see this, it's reflecting concerns on the economy, it's reflecting concerns on the health of the Indian equity markets as well, and it's reflecting global concerns which could be around tariffs. Let's look at specific stocks this morning and what's happening there. So results, let's look at what GSK Pharma has done. Good set of numbers. Has the street rewarded it? Yes, one outlier. All right, so Neeraj just said, I don't think you're going to find any green. We found one, 11.5% up on GSK Pharma. Was, remember, on my watch list as well. ABFRL on Alex's watch list this morning was seeming like a good set of numbers just because of margin expansion, not enough. BHEL, how is it done? Let's look at RITES. BHEL, because of order win, not helping at all. 1.5% down. RITES Also, another order win has not helped. So is Welspun Corp. All of these order wins, Welspun mildly in the green. SBI Cards, huge upgrade from HSBC. Has it helped? No, it hasn't. Afcons, Nomura sees an upside and has initiated a buy, completely flat. Now, I don't think that's going to help an RVNL. Anyway, it was a poor set of numbers. RVNL about 5.5% down. Utkarsh SFB, they've doubled their provisions quarter on quarter. Numbers were not that great either, 10% down nearly at this point. So yes, we found one idea at least which has worked this morning, but this is a sea of red, Alex. It's not a pretty picture.
It's not a pretty picture. And to the point on M&M, I don't know, is this a case of saying that, it's good news, but it's not enough to pull this counter? And by the way, it performed really well after its earnings. I'm wondering if some of that is playing out right now, maybe some profit booking coming in. But Gautam, I'm wondering what you think about this, because you're talking about bookings of over 30,000 for its EVs in the context of about 1 lakh of EVs that were sold in the previous year. And it's a sizable number for one company to have on the first day of the launch of its products. Is that a negative in your opinion?
No, I think you're reading too much into one day's price move. Do look at the market context. The stock that you're talking about, M&M, we've liked it. It's our top idea. It's part of our model portfolio. It's hardly down 10% from its highs, I think, from 3,200 to 2,850. Market is down 20%. Small cap index is down 25%. There are a lot of number of stocks which are down anywhere between 40 to 50% now. So, we cannot make an opinion basis an opening price trigger of a stock on a particular day. Earnings have been fabulous. They've guided for double-digit growth in fourth quarter for tractor as well. And margins are also looking quite good. So, but yeah, I mean, that doesn't mean that stock cannot fall, because this has been one of the best outperformers, among the top 3 performers of CY24 in Nifty 50.
Okay, just want to mark that the small caps have just inched up a little bit from the lows. In fact, it's not just a bit, by the way. Look at the intraday of the Nifty small cap. It's 0.13% now. And look at that. I mean, it's just first 5 minutes. So yes, Gautam is right. At times, TV anchors can be blamed for reading too much, too soon. But that's the nature of our business. We've not to be watching it dot to dot. As we speak, it's in the green, by the way.
Even this could be too soon.
Yeah, it could be too soon.
It depends on from where you take it.
Of course, completely agree.
That sharp recovery has definitely given some comfort. Started brutally, but yeah. This is
Nifty 52, by the way, 1/3%. So from down being down 0.7, 0.8%, a bit of a pullback. Now, yes, like I said, could be too soon, but good time to, Gautam, just stay on, because it's interesting to watch this intraday movement and just getting a quick thoughts from Sony and Kush as well before we ask you about some other things, but just wanted to bring that going because it's market open. Sony, how do you view the first 6 minutes of trade? What do you do in a scenario like this?
So Neeraj, I think I'll still stick to what I spoke in the morning, and there could be a view, universal view, which could have actually held on to a 22,775 sort of a level. If it breaks, then further shorts can be seen. Well, it broke today; it went to 725. But then we're seeing the recovery. So I think it's still a sell on rise. Anywhere closer to the resistance of 23,000 would be the mark where actually you start selling again. Until and unless it does not cross that resistance band beyond 23,300, it remains quite weak, and it's difficult even to see from current levels whether you give a sell or a buy idea. I think it's quite volatile, but the idea would be to still remain hedged. It's not that we're completely out of the woods. So better to remain cautious and hedged would be the suggestion for now.
Kush, do you want to add something to that? We began the morning talking about glass half full, glass half empty. And you said that you're not even looking, so rather think out of the box. You said there is no box. So there is a matrix level play that is happening right now. What are you looking at in the near term for the markets though?
Just like Sony, I'm going to stick to the view that I had in the morning. Again, if you take that 5-year chart from COVID lows, we've pinpoint hit the rising support line at 22,275 thereabouts. That's the low. The short play is just not as lucrative. I do feel there is a sell on rise kind of a market, but I don't think the risk reward ratio is in favor. There, we could very well go on and test 22,500, but we might just test 23,000, 23,300 before we do that. So the short play from a risk-reward ratio is not as lucrative. If this bounce suggests or rather steadies on for the next 15 minutes or so, you could very well see an intraday recovery, and then perhaps that short covering rally, perhaps an extended one that we've been speaking about for a while, which lasts more than a day, might just come into play.
Okay. Kush, thanks so much for joining us on this conversation. Pleasure having you as always. Gautam, I look at your model portfolio and I'm looking at the mid-cap and the small-cap space, and I see some very interesting names that would benefit from a consumption story, right? So if I'm talking about in Indian hotels in the hospitality space, if I talk about Godrej Properties as well, because there are people that are saying that real estate is going to be a beneficiary when the tax breaks come through, because it allows people to have more EMIs. I don't know what you think about that, but there are also capital market plays. Can you explain your thinking here? Why are these the most preferred picks?
Look, consumption has been a preferred choice for us for many years now, and we've been overweight on discretionaries within the consumption. We've been underweight on staples for a very long time now. And we think that as the impact of this tax cut plays through, people are going to save, people are going to consume, people are going to invest, right? So when they're going to invest or consume, where are they going to do that? I think as far as consumption is concerned, there are a whole host of segments which are going to benefit, which is why you see a broad representation of Indian hotel, a trend there, even a Page Industries, which we had added up for a very long time in our modern portfolio in January. So there are a lot of bottoms up stories which are going to benefit. I don't think staples are going to benefit much, but they've derated massively in the last 4 years. And they serve as a defensive bet in such kind of markets where volatility is very high, as you just explained 5 minutes back. Insofar as investment plays are concerned, we think that the capital market story in India has a very long journey ahead. While we make a lot of hype about the number of demat accounts which got added in the last 3-4 years, we think that we're just about scratching the surface, because the overall equity penetration in household balance sheet is still very minuscule. And as incomes grow, as the awareness about equity investments go up, we think structurally the capital market plays are going to remain in vogue. And within that, brokers, exchanges, wealth managers, asset management companies, the depositories, the whole infrastructure around the capital market companies, they offer a very meaningful opportunity, and which is why we had put out a very big thematic report a couple of weeks back where we highlighted our preferences amongst the capital marketplace. So yes, we continue to like both discretionary consumption as well as investment-oriented themes for capital marketplace.
Gautam, thank you so much for joining us this morning on your take on Q3. So while it's seeming a little dismal right now, the outlook definitely continues to be positive in the longer term. Not immediately, I would say. Now, having said that, a good recovery across the board. I just want to quickly pull up the intraday for the Nifty as well as the small cap index as well before I get one taken from Sony. So the Nifty also has recovered from the lows of the day, still definitely in the red, no changing that. The small cap index also in the red, but has recovered from the lows of the day at least. There was this sharp push down right on opening, which seems to have come back up. Sony, anything interesting you're spotting? As you know, we end this session with you. GSK Pharma comes to light. A lot of pharma plays as well. Piramal, Suvain, AstraZeneca, all of them buzzing this morning. Anything you're liking here?
Tamanna, quite difficult, at this point to whether go for a buy or a sell in stock specific. But one stock from the consumption space, which is in my radar, which seems quite unbothered with how the markets are behaving, rather with a gap down or a gap up. The stock is Britannia. Now, Britannia on a positional basis is consolidating. It is holding on to 48.50, 48.40 out of a sort of a support levels, a slight resistance towards 5,000 levels. I believe that if it's able to cross and take out the levels of 5,000, you can see on a positional basis heading towards 5,100. So I think this is the only stock in the radar which is consolidating, which is looking decent, and one can accumulate at this level with a stop loss of 4850.
Sony, by the way, yes, minute by minute tracking was difficult. The small cap index is yet again down 0.6%. So keep in mind, it's very choppy out there, very, very volatile. Sony, are you taking any positional trades right now at all, or are you avoiding them completely? And if you are, is there a positional trade for the week?
So, Neeraj, for the week, I think, would rather avoid, and perhaps if Nifty is testing towards the low supports around the 20 to 500, now that would be wise to take a position from those levels. I still feel that it could be quite volatile and choppy, and stock specific also, either side, buy or sell, the stop losses can get triggered in this volatility. Maybe wait for a few more days, and the patience could actually be the blessing in disguise that one can actually be looking for.
Soni Patnaik there speaking on, we are all looking for blessings in disguise right now, Soni. So thank you for ending on that positive note. But Britannia, one of the stocks that she is saying, are we going to continue to have a tough calendar year 2025? To speak on that, I'm going to introduce our next conversation on the show this morning. I'm joined by Amish Shah, Head India Research at BofA Securities in our studios. Amish, great to have you here, and thank you so much for coming in.
My pleasure. Thanks for inviting me.
Yeah, it's a tough market right now. It's a tough market, and the pain doesn't seem to be ending on the horizon. What's your view on that? Let me start with that broader point right now. Are things looking a little more murky from here on from an Indian equity perspective?
So Tamanna, I'm sorry to spoil the party, but we definitely are in the bearish camp. Meaning, as you would know, we went negative on the markets back in August last year. And despite the correction, we think Nifty at best is going to return single-digit returns this year. When it comes to mid and small caps, we are still in the camp of them providing negative returns even from these levels. So still more downside.
No, I mean, sometimes you just need, a very clear view. All right, so then what is the positional play over here? I mean, for long-term investors watching this right now, wealth creation opportunities come at bad times. Is this one of them, or there is more to go?
There's more to go. So think of it like this, that single-digit returns for Nifty is equal to you making that from a bond market.
Yeah.
Right? So we all know equities are volatile, equities are risky. If you're going to make a bond kind of a return from an equity, I think you're better off with a bond right now. Fixed income is a better way to do it. And that is as far as the large caps are concerned. And mid and small caps, we argue, will be negative returns. It's best avoided at this point in time.
Wow. Amish, morning. So what is leading to this? Because we've seen, okay, let's argue that there are some internals out here in terms of lack of growth in the last couple of quarters. I believe your notes around Q3 as well paint to a low single-digit or mid-single-digit growth. So earnings are definitely a problem. But I would guess that fund flows out of India, maybe into China, maybe into some other markets, are also to be played out here. One question that nobody's been quite able to answer, and I would love to seek your opinion here. What's happening to FI flows? I mean, there is serious outflows. What are client conversations like? What are you telling your clients about where to park the money? And does this money come back at some point of time due to a catalyst, or will we continue to see outflows in the near term?
So Neeraj, for me, this answer is like a pure arithmetic. If you think about it, in the US right now, you can make a 4.5% return risk-free on a US Treasury. Right? So that's your US dollar risk-free return. Add to that another 2% of rupee depreciation that is likely this year, over and above 4% that has already happened in terms of rupee depreciation so far. So 4.5 plus 2 takes you to 6.5. That is arguably your rupee risk-free return if you're an FII investor, right? And on that, you will at least expect another 5-6% of equity risk premium because you're taking risk. It's not safe. So you want at least 11 to 12% returns bare minimum for you to be excited about equities. And on the back of what I'm arguing, that even after the market correction, if Nifty is going to give you only a single-digit return, that doesn't add up to the 11-12% that we are talking about. And if you're talking about mid-caps, we are talking about negative returns versus you can make 11.5% risk-free somewhere else. So logically, if you think about it, why should that money be in India? So I think a lot of people look at it very simplistically, that the FII positioning and ownership is at a decadal low, and that is a reason why the FIIs will come back. That's just plainly wrong. FIIs will go where they can find returns. Given that the returns risk equation in India is right now not favorable, they would probably look for other alternatives, and it arguably is US equities or US bonds at this point in time.
Okay. And your argument for a single-digit return in Nifty is premised on your earnings expectations and the macro situation for FY26. Could something change that, Amish? I mean, I'm trying to understand, because when I read your note, it's clear. You expecting on the back of not a very great FY25, a fairly moderate FY26, right? And I'm presuming on the back of that, you're expecting single-digit returns. What can change that estimate of single-digit return for the Nifty? Let's stick with the large caps for time being.
Sure. So I think, Neeraj, now it is no longer even a debate that India is going through a growth moderation or a cyclical growth slowdown, right? So that's, I think we don't even have to debate that anymore. So logically speaking, anything which is in a down cycle should trade at lower than long-term averages. Arguably, you know, I'm just going by fundamental principles. Nifty, even after the correction, is still trading a shade higher than long-term averages, which basically means that it is very hard to justify a valuation upside or valuation-led upside for Nifty right now. You know, if at all one could argue that valuation should converge to long-term averages and the valuation should continue to come off. In the meantime, your earnings will compound by about 12% in FY26 on a low base of only 5% earnings growth for Nifty in FY25. Right? So basically some valuation downside, 12% earnings growth upside is possibly your single-digit returns that we are arguing. What could turn, you know, as and when the economic outlook, earnings outlook, you know, starts to inflect back towards growth or higher growth, or possibly when the valuation multiples have come to a level where they start looking attractive and that single-digit returns start to look like mid-teens or higher, then I think obviously the equation turns in favor.
I'm just trying to understand, Amish, if it is currency concerns predominantly, or is there something more when it comes to the FII picture? Yes, the currency concerns are there, but then that's across all emerging markets and a whole bunch of currencies versus the dollar. So is there something more that is not visible right now in terms of FII flows?
So Tamanna, first of all, India started with much higher valuations as compared to the EMs. You know, so valuations clearly was a hurdle in terms of a starting point. And as a result, you know, some emerging markets, YTD this year have already done well. India for the last FY21 to FY24, the growth in, let's say, the mid cap was about 41% CAGR. In the case of small cap was 32% CAGR. That was by far the best growth that you were getting in EMs, and arguably therefore valuations expanded as well. Now that we are going towards a softer growth or a moderation of growth, valuations have to readjust as well. You know, so I think India has just gone through a very good phase, and we are now trying to readjust the markets towards what is going to be the sensible growth in terms of a moderate economy that we are looking at. In comparison to that, a lot of EMs, you know, for a variety of reasons, there were concerns on them and they were arguably cheap, and therefore the money is trying to find pockets where to hide in terms of at least valuation comfort. But you know, taking that as a bigger point, and you know, Neeraj was trying to understand on the earnings as well. So look, even now, so let's say FY25, consensus started with 15% earnings growth. We are likely to end the year with 5%. For FY26, we think that even after consensus having cut their estimates by 360 basis points, there will be a similar earnings cut going forward by the time you end the year. You know, logically, earnings growth is going to settle more closer to early double digits, is what our estimates are. When we look at these numbers on a bottom-up basis, we are able to say that 80% of the differential between us and consensus can be explained by 3 C's. We call it lower commodities, lower capex growth, lower credit growth. That is 80% of our growth differential versus the consensus. The remaining 20% is about consensus expecting a very high or a sharp revival in the discretionary, consumer discretionary growth. You know, the growth is anywhere between 18% to 134%, depending on which consumer discretionary pocket you pick up. And each one of these categories, we have our own nuances, but that kind of a growth we think is unlikely. And the final bit is margin expansion. So if you look at FY24, 2/3 of the Nifty earnings growth in FY24 came on the back of margin expansion. It looks to me that unfortunately the consensus is just dragging those numbers forward and are expecting margin expansion to continue going into F26 as well. But in an environment where for the last 5 consecutive quarters, your top line growth has been in mid-single digit, call it 5-6% kind of top line growth, there is just no pricing power. You cannot expect a company to have lower than GDP growth kind of a top line growth and say that I'm going to hike prices and take margin expansion. So I just think that a lot of estimates, of the consensus are just plainly wrong. And as they become sensible, markets will have to unfortunately adjust to those numbers.
I'm trying to understand whether you see any impact at all of the 2 or 3 things that have happened recently, in the sense one is RBI's operations, then there was a rate cut, then this tax bonanza to boost consumption. Do you see these factors playing out? Because one theory of what we're seeing right now in terms of moderation of growth is simply that the government did not spend during an election year, and that is now recovering. So if that also comes back into this playbook of what I've just described, do you see that making a positive impact on growth, and then of course the rest of the virtuous cycle continues?
So absolutely, Tamanna. I think government is doing its bit, both through the monetary tools and the fiscal tools. So, so let's take each one of them. To your point, in the budget we saw fiscal, we saw the tax bonanza of 1 trillion rupees, or about $12 billion. Now that's definitely a positive on a sequential basis. Can it lead to the growth revival in the consumption category? Yes. But when you try to put it into context, right, there are 2-3 numbers that I can mention. That $1 trillion rupees, or $12 billion, is less than 1% of the total retail market in India, including autos. Right, that market is more than $1 trillion. So can 1% additional, lead to a meaningful revival in growth? Unlikely. 1 trillion rupees is also equivalent to 30 basis points of GDP. Is that good enough to stimulate the entire consumption basket of India? Unlikely. Even this 1 trillion rupees is going to come into your pockets very slowly, because it is through a tax cut. Which basically means that there is some saving in your, in your tax outgo every month. Yeah. So that is spread out over a month and will be more gradual. Similarly, the subsidies bit, to the low-income households is going to come in the form of monthly subsidy payment. So it will be a gradual process. So the point I'm trying to make is that the directional comment on whether that can help revive consumption growth, yes. The quantum of that revival is not likely to be too high. And as a result, we are not positive on everything consumption in the form of rising tide lifts all boats. We are more bottom-up, more nuanced. We like certain stocks or certain pockets of consumption. So we are positive on autos, real estate, some internet, some travel and tourism theme, jewelry. So there are some things that we like, but I would not say that on the back of the stimulus measures, it will be a big boost to the entire consumption sector.
I'm guessing this would have a large cap bias, and we'll get to the preferred list as well. I know you can't talk stocks, but maybe just the themes. But just one quick question, Amish, on just the macro, right? What would it? I know you mentioned that if the valuations were to correct, then that would make you a bit constructive, or if, as and when the GDP growth numbers move higher. So are we to assume, therefore, and because the markets discount good news 6 months in advance, that at least until September or Q2 of the next financial, the macro situation, ceteris paribus, will not make you comfortable? By then, if the markets start discounting FY27, and if there are things outdone there which make FY27 earnings growth look okay, then you might turn constructive. Until then, the markets may stay flattish to maybe marginally lower as per your current thesis.
So absolutely, Neeraj, so look, everything that we are discussing about, there is no structural problem to India. It is only versus what the markets expect versus what is going to be a reality. And reality, in our minds at least, is going to be weaker than what the markets expect, right? Let me put, so at some point in time, can India become attractive again? Of course, because India is always going to be a structural growth market, and we will always look at the right price to get back in, right? It's just that we are not there yet. Now, let me put some statistic to make sense of this. As I mentioned, that in FY21 to FY24, the mid-cap earnings growth was 41%. That of small cap was 32%. And clearly that growth was much higher than what you can get out of Nifty, which is a representative of large caps, right? So because you were giving a meaningful higher spread of growth as mid caps and small caps in comparison to the large caps, there was a reason why the valuation multiples had to expand. right? Now, if you look at even consensus expectations, mid caps are expected to deliver 17.5% growth over the next 2 years, FY25 to 27, and small caps are expected to deliver 19.5% growth, right? Which is a very small spread in comparison to what your Nifty is going to offer you. For that smaller spread, mid caps are still trading at a 48% premium to the large caps. Is that valuation premium justified? Is what we are debating here. In our minds, it's not, and which makes us bearish. So we think that valuation will have to compress because the growth spread versus the large cap was already compressed.
Got it. Now the argument against that, Amish, might be that okay, mid caps is a smaller universe, but the small cap, right, 250 onwards to 5,000, 6,000, what you call, is a small cap space or beyond small caps. And there are a clutch of companies out there. I mean, T&D, recycling, energy, etc., transition, what have you, which are all guiding to very strong earnings assumptions till FY27. And this is after the Q3 con call. We've seen recycling companies, EMS companies, T&D companies talking about very strong earning projections. They've scaled down their estimates themselves, but they're still looking very strong. So my question is, when you are bearish mid caps and bearish small caps, with reason, could there be a large number of outliers simply because a large number of sectors which have gotten created in India in the last 2 months necessarily belong to that small cap universe?
So the short answer is yes. There will always be some bottom-up opportunities to look for. Some of the sectors that you mentioned we don't cover. So I'm not up to speed in order to say whether they are rightly valued or not. I don't know. But absolutely, anything which is going to offer higher growth would deservedly get higher multiples or valuations and can do well. We are trying to look at mid caps and small caps more on a broader basis right now.
Got it.
The only point I would say, Neeraj, is that this definitely looks to me a year where investors would first look for capital protection, returns later, and generally during those times, the money gravitates more towards the large caps. So there may be an element that despite the companies doing better growth, the valuation multiples are still not not to a level where they deserve to be, just because of the risk aversion factor. But having said that, I completely agree that if there are niche pockets which can offer you good growth, they will continue to do well.
Just going through your note as well, Amish, and looking at your perspective on DII flows. I mean, we spoke in quite detail about FIs and what they're doing, but the shock absorbers of our market seem a little shaky as well. Do you think that there could be further contraction in DII flows? Is there any concern in DII flows as well, which is right now the bulwark of what is driving the markets?
So we hope that it stays. But again, if you look at the numbers, markets peaked in September of 24. Domestic flows peaked in October of 24. October of 24 was $8.6 billion of domestic inflows. Okay, if you try to contextualize that $8.6 billion number, it is 2.2 times the average monthly flow between CY21 to CY24. That is arguably the best phase of Indian equities because a lot of retail got into it, plenty of demat accounts, demat accounts went up by 3.5-fold and so on and so forth, right? So even during the better phase of India, the $8.6 billion is 2.2 times that monthly average flows. If you look at India prior to that, so if I look at CY10 to CY20, so the 10-year period, $8.6 billion is about 4.4x the monthly flows that you used to get at that point in time, right? So clearly the numbers had actually gone up quite high, and $8.6 billion seems to be the peak. Since then, if you look at the numbers of November, December, January, they've been in between $5.1 to $5.6 billion, right? And I would arguably say that especially in an environment where most of the other asset classes in India are fully taxed, equity still looks okay. Buy the dips has been the mantra for the retail investors over the last 3.5 years. That has made them returns, and on the back of that, the flows have continued to stay strong. So we all hope that stays, and retail does not.
That faith is not shaken. I think that's important, that faith is not shaken, and it's been proven to be rewarded time and again. As we wrap, and I'm sure Neeraj has a point as well, just wanted to quickly ask you that from what you're saying, a defensive play seems safer. You talked about capital protection. So is it the large cap, pharma, FMCG space, which is the best place to hide for cover in your scenario?
So yes, absolutely. So large caps over mid caps, we definitely agree. Within large caps, we are currently within cyclical sectors. We prefer cyclical rate sensitive domestic cyclicals. So we like real estate, some internet, some autos, financials. This is all rate sensitive cyclical spaces. Okay. Otherwise, we are defensively positioned in healthcare, telco, staples. So we have a fair bit of defensive skew to our portfolio as well. And anything to do with capex, we think is still more expensive. So call it industrials, metals, cement, energy, power. We are bearish on all of those.
But that was going to be my last question. We have a minute, Amish, but just wondering. You track, amongst other things, capital goods and the capex so closely. Those multiples and those valuations have come off quite a bit. Do you foresee even the high quality MNC names, which have been the leaders in the last 3-4 years, to actually be under a bit of a cloud?
So, Neeraj, let us put it like this, that between FY21 to FY24, the overall capex growth in India was 20% CAGR, and that was primarily led by central government capex growing at 31% CAGR, state government capex growing at 22% CAGR. So primarily very large government capex drove that 20% growth. Now that the government capex is trying to roll down, as they are trying to balance capex and consumption growth, we think that the overall growth in the capex space is going to come down from 20 to 13. And when the growth overall comes down, it also brings with it margin contraction and working capital expansion. So we think that earlier in a 20% growth era, stocks were budgeting for 25 to 30% earnings growth, whereas in the 13% era, we would have to talk about mid-teens to high-teens kind of earnings growth, and therefore the valuations have to readjust downwards to reflect that kind of moderation of growth.
Well, tempered conversation, and good to take note of a glass half empty situation as well. Amisha, thanks for laying it out so beautifully.
Thank you.
It's seriously pleasure, and look forward to having you more often.
Absolutely.
Pleasure to speak with you. All right, let's take a quick look at our conversation with Samvardhana Motherson, which is in focus following its Q3 numbers. Listen in.
This is clearly an opportunity for us, especially when you think from a medium-term perspective. Given the global presence, actually we have more than 400 facilities across the globe, so a fair amount of spread across 45 countries. So you're right that we can recalibrate / rejig our production plan depending upon putting them into more favorable jurisdictions, depending on how the tariffs play out. Also, I think do bear in mind that a lot that we buy is also pass-through elements to it. So commodities are pass-through elements to it. We do have custom-nominated parts which would also have pass-through elements to it. And the remaining that we procure, we try and localize it as much as possible. So implication in any case is not going to be as much. But then, as I said, over a medium term, the ability for us to recalibrate ourselves is a lot more than some of the other players which may not be as global.
Now, my second question to you is, moving to this particular quarter, we have seen, I want to just start with the wiring harness business because it's seen a strong margin expansion in a demand environment which has not been very strong. What led to this, margin growth?
You would have seen that the teams have been continuously working and striving very hard globally to make the improvements. So this is a result of all-round operational improvement. Wiring harness is a human-intensive industry, and Motherson is extremely focused on developing human capital around the world. After COVID, there had been a lot of issues, and over a period of time, we have tried to build a very robust manufacturing setup. Apart from that, there has been a slowdown, which did impact us to some extent in some of the geographies. On the other hand, we had won some businesses 2 years ago, which have come into play today. So we have been able to optimize the manufacturing setups and to provide solutions. On top of that, we have also been continuously insourcing some of the products which we were buying and providing better solutions to our customers. So all this on an overall basis resulted in a better performance.
I just want to understand, from both of you that you've given some commentary in your presentation that, the global PV volumes have declined by 1% in this particular quarter compared to the same time last year. The CV business has also seen a degrowth globally, while, we have seen markets such as Europe as well as North America decline in this particular quarter. What is your current understanding of, your reading on Europe specifically? Because growth, while hampers, it forms a considerable amount of revenues, roughly 17-18% on a full year basis for you. Just want to understand, on that aspect as well as on Japan, because you've seen a lot of acquisitions over the last 12 to 18 months. How does these two markets shape up for you going into FY25 and FY26?
So let me start with Japan. So if you would say that at the beginning of our 5-year plan itself, we had indicated that that's one of the markets where we didn't have much presence. And the customer trust allowed us to partner with Honda. We're very grateful that they did give us the opportunity to have Yachiyo and then Atsumitech in the group. And together we continue to develop. And please understand that these two companies also are not just functioning in Japan, they are global. What the company has done over a period of time is not only doing business with Japanese customers and growing that, which will allow us to also bring in other products which we were not supplying to them today, but we can supply in the future and develop more and more solutions. We have also set up new partnerships, one with Matsuisa, which is for automation, and also on the packaging side with Sanko-san. So you would see that how we are using every market to also improve our operational performance and strengthen ourselves end to end. So that's been the basic drive. The Japanese have very good manufacturing knowledge and innovation capabilities on the production side, and the group wants to strengthen that and take it global. Kunal, would you like to add on to Europe?
Yeah, so look, I think in Europe, you're right, things have looked a little downward, but we don't see it as a very, deep end of the ocean. We see it as a shallow piece, which will play itself out. There is always pluses and minuses that occur. If you think from a customer perspective, some of the European customers have been, challenged by different powertrain requirements that the regulator has been putting in place, and the challenges associated with putting all of that together, as well as trying to invest in newer technologies for the future as well parallelly. So as some of that has happened, if you think from a consumer end also, there is a lack of clarity on which powertrain is really going to be playing out. And hence there seems to be some deferring of purchases happening in there, as well as potentially, going after not wanting to deploy large capitals behind a powertrain because, you really still do not know which is going to be the right powertrain to back upon as a consumer. So there seems to be a period of volatility in there, some amount of flux, but we do think in the next, few quarters, things should start looking a lot more stable. And then it's an important market. It has a lot of engineering capabilities, quality capabilities. It's not that Europe's not growing. I think if you especially think from Eastern European perspective, there is a lot of growth in there. There still seems to be a challenge on finding people to work. So inflation continues to play out, which means demand is going to be still resilient. And hence at an aggregate level, we are not too worried about it. It seems like more of a short-term volatility or pain, which will ride itself out. And a diversified model implies that we are able to react to any of these changes. So we'll play with the opportunity set that comes our way along with it.
Now, just one follow-up here, because we have seen in the last week that major automaker Porsche has come out and has mentioned that they've announced their plans to pivot back to internal combustion engine or ICE vehicles. Just wanted to understand, what is your current reading of this? And because they will be spending a considerable amount on it, I just want to understand any kind of reaction on this for you specifically. Do you also expect the other major automakers to come out with such bold measures? There has been some commentary by a lot of them. Just wanted to understand, because while you mentioned your powertrain agnostic, what does this specifically mean for the auto component makers in general? Because you've seen EV sales slow down in Europe as well as Germany as well.
Well, it's good you picked that up. It is, a signs of probably what needs to come. If you look at the different mix of vehicles in Europe, you will see that hybrids continue to be one of the fastest growing segments, which is like an intermediate solution between the full ICE and the EV. Having said so, it's really an ICE vehicle at the end of the day with a battery attached. That's what a hybrid is. And hence it carries best of both worlds, but from a component player probably carries a good amount of content as well for players like us. Secondly, I think, as I just mentioned, people are trying to find their feet around what is the powertrain of the future. I think everyone's belief around EVs and the high trajectory of penetration that EVs can have, I think that's been dented. And hence OEMs pretty much across the board will be looking at the portfolios to say how much we should be investing in which kind of powertrain going ahead as well. So I think Porsche has made that step already, and I would think many more may follow through as well.
Now, for SAMIL in this particular quarter, we did also see that you guys have reduced capex by roughly 500 crores to roughly 4,500 crores now for FY25 specifically. I just want to understand that while non-auto capex is expected to continue in verticals like consumer electronics and logistics, for the auto capex, will it be safe to say that it will be looked at in the next few quarters at that time, and shouldn't just be assumed that it will happen just because it's been announced? So will it be more on a basis at that time? What is the demand environments for you specifically that you're seeing?
Which is right. I think we will breathe with the market depending upon how the volumes play out, depending upon when the SOPs are being planned out. This will be done at that stages. So we will react as things come our way as well. This was originally planned to happen in this year. We have seen a lot of SOPs getting delayed, specifically some of the EV players. And hence, as and when there is clarity on that matter, those capexes will come along with whatever recalibration.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims?
Hi, thanks so much for joining in. You're watching NDTV Profit. This is Ask Profit, the show that gets you answers to all of your stock-related questions. My name is Alex Matthew, and with me is Mahima Vajrajani, and we'll take you through the next 1 hour of trade. Morning, Mahima.
Morning, Alex.
Well, it's not the best start, and actually it's been quite choppy. So let's first take a look at that intraday chart for the Nifty 50, trading with cuts of about 0.4% and well below 22,900. In fact, it's trading at a very key level, and we'll get our technical experts to talk about this, very close to that 22,800 mark. That's where it's finding a little bit of support. Let's look at the broader markets as well. And you have cuts of about 0.75% or thereabouts. You see that start was very, very wobbly. You had the low point of the day that was quite considerably lower than what you see right now, and you saw a pretty sharp recovery immediately after that. And this is evident in the small cap space as well, where you have the small cap index that's also trading with cuts of about 0.7%, and this too has rebounded quite smartly from the low point of the day. Let's take a look at the sectoral picture and the heat map here, because this will give you some perspective on how things stand. Pharma is standing out as one of the only gainers. Of course, pharma and healthcare together as a pack are doing particularly well. Some of the pharma names doing particularly well, and we talk about those individual names in just a bit. But realty, it's a sector that has gotten beaten down in the recent past, and auto on the back of Mahindra and Mahindra losing ground are both sectors that are underperforming. You have IT and banks, which have so far over the last couple of weeks been resilient, but IT is losing about 1% or so right now, and that's certainly a talking point. And so is the PSU banking index, which is down about 1% or so. But let's very quickly mark a few individual names for you. Mahima, what's on your radar today?
Right, so a couple of names that are doing very well despite of the choppiness in the markets. Sandur Manganese is one of them. It's up around 7.6%. GlaxoSmithKline on the back of its numbers, great set of numbers. The commentary coming in is also very positive, which is why the stock is up 16%. Godfrey Phillips is today seeing once again a good run up in trade. On Friday we saw that profit booking did take place in this counter, but today the stock is up about 12% as we speak. Megami Organics, and this is on the back of a news update, which is why the stock is seeing a significant up moves. And in terms of what has happened with the counter, well, a couple of things working in favor of the counter. It's basically China titanium oxide imports will face anti-dumping duty, which is positive for the company, which is why we're seeing up moves of about 8% in the stock. Uflex, another counter on the back of earnings, great set of numbers. All four metrics in terms of revenue, EBITDA, margins as well as net profit is improved, which is why the stock is up 7%. Manappuram, Nava, TV18, Kirloskar Brothers are some counters which are seeing some positivity in trade today, but there are some counters which are of course facing the brunt of the markets being choppy, and a few counters and of course this is on the back of earnings as well. A few counters include counters like Aditya Birla Fashion, Easy Trip, all of these counters not doing very well. PTC Industries also not doing very well. In terms of some counters which are really feeling the pain, also include, a couple of names, a lot of other names on the back of earnings as well, Alex. So these are the counters which are, it's both earnings as well as the market sentiments which are pulling down a lot of these counters.
Yeah, no doubt. And you didn't mention Mahindra and Mahindra, so I will. Mahindra and Mahindra down about 3% off the low point of the day. I want to stick my neck out here and say that this is a little bit overdone, and perhaps the street is taking a negative view. But if you think about it, the announcement of 30,000 plus bookings for its new electric vehicles is a positive, considering that only 1 lakh of units were sold in the EV space in 2024. It's a very substantial number, and I don't think that it's fair to compare this with an internal combustion engine. So if you were to say that maybe the numbers are not as fantastic as they were for the Thar, then I don't think that's the right comparison to be made, particularly because these are expensive cars that you're talking about. They're not really volume drivers. And it's a significant development for a company that has made a late move. It was one of the early proponents of electric vehicles through the Reva acquisition, and it's finally now coming back into the limelight. We've got our first caller for the day, but before we go to Srini from Chennai, let me introduce our experts for the day. We've got Avinash Gorakshakar, who is Director of Research at Profitmart Securities, and Brijesh Ail, who is Retail Research Head at IDBI Cap. Thank you so much, gentlemen, as always, for taking the time. Pleasure speaking with you. Let's go across to Srini now. Hi, Srini. Thanks so much for calling us. You're calling us, I think, about a stock that is in focus today on account of earnings. What would you like to know?
Yeah. No, my point was I actually thought that the results are good and almost covering the next quarter's part as well overall. So I thought the yearly will be good, and I thought I should go for the buy. But unfortunately, it has gone to the lower bottom. So I don't know whether I made a mistake here. How do you read the report? Please advise me on that, because I'm not an expert. So.
No worries. And I'm glad that you're tracking the fundamental developments on this counter. You're talking about Zentech, so that Avinash knows what we're talking about. Let me go across to him on the fundamentals. The buy price is 1,104, Avinash, and the numbers just came through post-market hours on Friday. What do you make of the numbers, and would you say that Srini made the right call to deploy money at 1,104?
Yeah, good morning, Alex. See, my sense is I think in most of the defense companies, it's very difficult to actually get a quarter-on-quarter kind of growth. Basically, the business for defense is lumpy. So, this kind of, performance which has come in the December quarter has been one of those quarters where execution has not been up to the mark. But that doesn't rule out the possibility that going forward with the kind of order book the company enjoys, the company will definitely do well. But yes, this quarter has been a big disappointment, and that is obviously getting reflected, by the stock price as of now. See, my sense is that if the investor can keep a investment time frame of at least 12 to 18 months, because this is one company which has got a very healthy order book in terms of drones, and technologically wise, its products are all approved and obviously are all ready to go. The export market is also a very big opportunity for them. So I think, if we can hold on for at least 12 to 18 months, I think then definitely this purchase which he has done will definitely not go in vain. He has to give in some more time, because typically, to predict quarter-on-quarter performances is not an easy job, and I think it can be unpredictable. So I think keep a long-term time frame in mind and continue to hold. Definitely good long-term prospects continue.
Continue to hold is the view coming in on Zentech. Basically, Alex, in Q4, what has happened is margins have slid quite significantly for the counter, and this is because of the adverse product mix. But I think in defense, this keeps happening. Zen Technologies, exactly, which is why probably the stock is seeing that kind of, and plus valuations have never been cheap for this particular counter, which is why it's correcting to the extent of 20%.
I'd also want to very quickly, Avinash, get your opinion on something. So sorry for cutting you off, but on the topic of this, right? Avinash, seemingly in this market with the kind of pessimism that we're seeing, even a small negative is leading to very sharp drops, and people are not, or investors are not willing to take the risk. Is that what is playing out? And did you see something similar with M&M? How did you read the numbers? Because I want to know what you think.
No, I think, Alex, coming to the point of Mahindra and Mahindra, I think it is too over pessimism which is being played in the markets now. I think, as you rightly pointed out earlier in the show, they've got 30,000 bookings for their new electric vehicle, which is a kind of a sort of a record. And I think that clearly proves the point that the product is likely to be a blockbuster product for them. My sense is that, these kind of dips have to be used by investors to actually accumulate such quality companies when such kind of panic comes in the market. I think fundamentals continue to remain strong. And as far as, defense companies' quarterly numbers are concerned, I think there is another company which went public recently, which is Unimec Aerospace. This company has also come out with a horrible set of numbers. And I think today the stock must be down. But that doesn't mean that the company is bad. I think one bad quarter obviously is a disappointing quarter, but obviously in the longer term, I think these businesses will do well. there are going to be lumpy performances, especially for defense companies, because execution and order book inflow, order execution, all that is not designed on a quarter-on-quarter basis. So I think investors who invest in such companies should realize that they have to invest for the longer term. They can't invest on a quarter or a short-term basis.
So that's the view coming in on Zentech and as well as the defense space overall. The next question that we are taking is on Bandhan Bank. Raman Tyagi is asking this question. He has 430 shares of Bandhan Bank bought at 214 a piece. He wants to know whether he should hold at the current levels or exit. Brijesh, I'll come to you on this one. A very good morning to you. What's the view with respect to Bandhan Banks where charts are concerned?
Yeah, good morning. So specifically the Bandhan Bank from the weekly time frame, the chart is negatively placed. It is making a lower low. Not too much of a support at the current level. We can expect some bounce back trade. So maybe closer to 145, 150. It would be advisable to take an exit because from the long-term perspective, at least from the technical point of view, I think that level will act as a resistance zone.
All right, so that's the view coming in on Bandhan Bank. We have our next caller lined up. Shweta from Hyderabad is calling in. Shweta, a very good morning to you. How can we help you?
Hi, Mahima. Hi, Alex. Good morning.
Good morning.
My question is regarding transformers and rectifiers.
Okay.
I have 90 shares bought at 1106.
Okay.
And I think the stock is drastically going down after the bonus issue and also.
Right.
So I want to know whether is there anything I should do right now? Should I exit or should I add more?
Okay, Shweta, I just want to know whether you want a fundamental view on this one. What was the thinking behind buying transformers and rectifiers?
Because I see this the power sector, I think it has a huge potential, especially the infrastructure in power sector. Okay. So I spotted transformers rectifiers is a very good, fundamentally good stock.
Right.
But nowadays, I think the market is not considering whether which stock or not.
Right, Shweta, that's...
And also the acquisition is pre-corporate announcement, right?
Correct. And as you rightly mentioned, it's probably the markets, but yeah, a lot of factors, playing as well in terms of transformers and rectifiers. Avinash, I'll take your view because she's seen the fundamentals before buying the counter. What's the view and what's the kind of time horizon she can keep holding it for? Because she's sitting on a loss of around 64,000 odd rupees.
No, I think as you rightly mentioned, this stock is trading ex bonus, and I think the numbers which came out in the third quarter have been pretty solid. Very strong performances on the revenue, on the profit side, plus a very strong order book, which is expected to, give the company good visibility over the next, say, 12 to 18 months. So I think, for the time being till the market sentiment is down, I would presume that the stock would underperform. But if the investor has a 12 to 15 month kind of time frame, then I think it does not make sense to sell the stock in panic because fundamentals continue to remain strong. I expect that even the March quarter and FY26 to be equally strong. And, this earnings momentum will continue. And power transformers is a very large opportunity, with power generation getting more and more importance and government also pushing this sector. I would not be surprised that, continuously new orders could also come in. So I think just wait for some time. I think rather than panicking and, thinking that the stock has lost ground considerably, one is the bonus adjustment. And secondly, obviously, the selling has come from investors who have actually got in earlier. So just continue to hold for 12, 15 months. I think long-term prospects continue to be good.
Long-term prospects continue to be good for Trill. Okay, it's a stock that a lot of people have found value in and have benefited from holding. Let's see if that continues. It is that kind of market. Let's admit that, right? The stock is under pressure today. Jana Small Finance Bank is the next counter that we're talking about, and Chandra is writing in from Bengaluru asking about this. 2,000 shares bought at levels of 404. The view is for 1 year that is being sought. Very close to the current market price. The question is for you, Brijesh, on the charts. What would you do with this? Would you hold, and what are the targets that you would have for a 1 year time frame?
So specifically from the 1 year period, I think the level of this 350, 360 is a demand zone. Previously also during the March 2024, the stock has taken support and then seen a decent bounce. So maybe from the year point of view, it can bounce back to 450, 470 level. So that would be a trading bet. And eventually, if everything goes right, then 520 would be the directional view for this counter. So somebody's holding should hold with the stop loss of 360.
Okay, so that's the view coming in on Jana Small Finance Bank. The next counter that we have is NTPC Green. Shahjahan from Muscat is writing in, and he wants to know whether he should accumulate more or sell or hold at the current levels. He's holding around 573 shares bought at 123 a piece. So this is his average price. Avinash, I'll come to you. What's the view with respect to NTPC Green?
No, I think if the investor has a 18-month kind of time frame, NTPC Green entered the capital market recently. I think it's a great business, a very strong kind of growth opportunity. And I think suddenly solar stocks have become slightly unfavorable in the current market situation. But if you see the business model and if you see the kind of capacity expansion this company is planning over the next 12-18 months, I think definitely they should do well. First of all, they've got the parentage of NTPC, so there's a lot of financial and technical support from the parent. My sense is unless the investor has a long-term view, because these kind of stocks are not going to go up in a hurry. But yes, over the next 12 to 18 months, if he can hold on, he can definitely average at the current level. It could be a good bet for the longer term.
Okay, let's take the next caller. We've got Vani who's calling us from Visakhapatnam. Hi Vani, thanks so much for calling us. How can we help you today?
Yeah, hello, good morning.
Good morning.
I would like to know the status of Chennai Petro,
Okay.
wherein I'm holding the shares of quantity 200 and I have an average of 940.78 for each share.
Okay.
So currently I'm running at a huge loss.
Yes. When did you buy this, Vani?
This I have been buying since August. I have been updating my stock since August of 2024.
Right. What was the thinking, Vani? Can you help me as to why you chose this particular counter to invest in?
Yeah, it was like I was very much new to this stock market. I just started it sometime in August only, 2024.
Yes.
So, like in association with my friend, we have invested jointly in this particular share as it was doing really good, and we had received information that it was a very good company.
Okay.
But like after that, I have seen a steady decline in the pricing of this share.
Understood.
So now I'm in a position wherein I cannot hold it, nor can I sell it.
Okay. It is a consequence, Vani, of fundamentals as well as the market as a whole. Let me go across to, and can I clarify, would you intend to hold this for the long term if that is the recommendation?
Yeah, I don't mind holding it for long, but like I would like to take some advice whether I should add some more to this particular share or like just hold it as it is.
Got it. Or move out and invest in something else, right?
I cannot move out because I'm already experiencing a huge loss, almost 92K.
I understand that. But sometimes it's better to book the loss and move out to protect your capital. So let me leave that to Avinash, of course, to give you the guidance that you need. Avinash, it is the space that has seen not so good times, right? So lots of headwinds playing out and understandably so, right, on the earnings front. But would you say that having lost so much in value, she should hold on or she should move out into something else?
No, I think clearly, the price at which the stock has been acquired, Alex, at 940. I don't remember when Chennai Petro was that high, but clearly, the price seems to be quite on the higher side, and that's probably one of the reasons the stock is given a maximum amount of loss for the investor. See, my sense is that unless the investor wants to take at least a 2-year kind of view, unless the investor is willing to wait for this kind of outperformance to happen only over the next 2 years, then only the investor should hold on. Otherwise, my sense is I think it's better to cut your loss and get into something else. Simply, look at PSU banking stocks or typically private banking stocks, where at least the risk reward is in your favor. Because see, whenever you buy a stock, you have to obviously look at the risk reward and the kind of the risk which you are taking to get that upside. In case of the current investment, I think the buying price has been very, very high, and to get that price, I think is going to take a long time. And I wouldn't advise the investor to even average at the current levels, because this is a commodity business and where margins are already going to be dictated by crude prices, the rupee movement, etc. So I think the best scenario is to get out and probably look at investing into some other stock like maybe a Bank of Baroda or maybe a Canara Bank, where I think the risk reward is in the favor of the investor.
And of course, Mahima, being a chartered accountant, can explain this to you. Vani, in the event that you have to book a loss in the capital market, there is a provision in the law for you to set off against future capital gains. And if you book it in this financial year, which is still about a month and a half, you can actually utilize it over the next 8 financial years, correct?
Correct.
Yes.
Correct. So yes, as Alex correctly mentioned, that's the right strategy to adopt. If you're looking for saving some taxes on your capital gains. Moving on to our next query, we have a query from Jagdish, who's from Andhra Pradesh. He's bought Copran shares. He's bought around 200 shares at a price of 325, which is averaged out. Copran is basically a fully integrated pharmaceutical company that manufactures and supplies high quality formulations, and it's basically into API. He wants to know the view with respect to this. He wants to know whether he can average out. Any suggestions on this? Brijesh, I'll come to you. It's a small company, 800 crore market cap, but with respect to the charts, how is it faring?
So yeah, it's quite difficult because the stock has been falling quite a bit, like from the levels of 220, 225, it is almost at 168. So structurally, I can't see any strength. Maybe fundamentally, if there is some strength, then we can figure it out. But then from a directional point of view, or maybe from technical perspective, there can be a further damage. The stock can come close to 150 levels. So I think that would be the immediate trend for the stock. And we need to keep a watch on it. So maybe if fundamentals are okay, then might be closer to 150. We can add few quantity, but on an immediate basis, I think 150 would be the next level to watch.
In fact, pharma as a sector is doing well, and the stock is up 2.5% despite the kind of choppiness in the markets. All right, we have our next caller lined up. Tarun from Ranchi is calling in. Tarun, a very good morning to you. How can we help you today?
Yeah, very good morning. Actually, I'm holding Hindalco Industries Limited for a long time. I bought total shares at an average price of 595.
Right.
And I'm going to hold it for a long time. I just want to ask you whether I should accumulate more as the stock and also other metal stocks. All metal stocks like Hindustan Zinc, Vedanta Limited or Tata Steel. I want to buy all these stocks. Is it the right time to buy these?
Okay. Okay, Tarun, when you chose Hindalco, was it the fundamentals that you saw? Should I get your fundamental view on this particular counter?
No, Hindalco is a good company. It's already giving a lot of profits every quarter. Nothing bad with the company at all. It's just fallen itself. That's all. It's a good company. I worked in Hindalco for a long time myself, so it's a very good company.
Right.
These are all profitable companies like Hindalco, Hindustan Zinc, profitable company, Vedanta Limited, profitable company.
Right.
Okay, these are all profitable. Just wanted to know what should I do? I should buy more?
I understood your point, Tarun. Okay, Avinash, I'll come to you. He wants to invest in metal counters and he wants to know whether he should accumulate Hindalco at the current levels or not. I read a BOFA report today which said that they are completely avoiding global cyclicals at the moment because of a lot of uncertainty going on, when global factors play its role. What's your with respect to the metal space as well as Hindalco?
No, I think we also look at metals, with a little cautious stance as of now, because see, frankly, with the kind of tariffs announced by the US president, I think going forward, there are expectations that tariff war could increase, and that definitely could put a little bit of pressure on steel exports, specifically, aluminum exports. One good part for Hindalco specifically is that Novelis came out with very good numbers. So, they have a pretty good stance on that kind of positioning on the Novelis side. But if you look at the domestic market side and most importantly, the outlook for margins, at least for the next couple of quarters, till the currency does not stabilize and till the tariffs are not very clear, I would say that there's no hurry for an investor to actually go and buy these stocks immediately. You could possibly see the stock remaining in a very close range, at least till this coming September. And post-September, obviously, as demand, improves and obviously tariffs are more or less clear. At that point of time, one could think of accumulating the stock. There's no doubt that Hindalco is a great company with a very strong product franchise and a very strong cost optimized structure. But I think in the current scenario, going for metal companies would be a little risky. So it's better to wait and watch for some time.
Watch out for what's happening in China as well. That's something that is going to have a bearing on metal prices, whether or not the bounce back happens in that economy. Pradeep is calling us from Kerala. Hi, Pradeep. Good morning. How can we help you today?
Good morning, Mr. Alex. How are you?
Very well. Please go ahead with your question.
Yeah, I know lots of people crying. Anyway, I'm looking for subscribe.
Okay. Okay.
Yeah, right now I think I lost almost like a 35% of the loss, and I would like to. This is the right time to add more, or so I need to wait for few more sectors. Few more. Pardon me? Yeah, go ahead.
Few more?
Few more, like a week or once.
Okay. So is this the right level to accumulate? And you've bought Brainbees solutions based on the fundamentals, right, Pradeep?
Right, yeah.
And so you're looking for a long-term view on this, right?
Yeah, it's like 1 year.
1 year time frame. Okay, Brijesh, then I'm going to come to you on the charts. The acquisition price is 655, quite a sharp erosion in capital. Close to 400 is the level right now. Would you add or would you wait for better levels?
Alex, this is the new listed.
Okay, you don't have enough data. Sure. Avinash, any view on Brainbees solutions? Down about 3% or thereabouts in trade. And if I remember correctly, post its results, it's taken a bit of a hammering.
No, I think, see, the business model is very strong and the growth opportunity over the longer term definitely is very attractive. But yes, in the short term, with these kind of numbers, valuations still appear to be quite expensive. So I think, if the investor has just a 1 year perspective in mind, then I think, I don't think, you're going to see a very strong kind of re-rating in the near term. Unless the investor has a really long-term view and can stay invested here for the next couple of years. See, because this business has been new, it was, promoted with a lot of fanfare during the public issue time. But unfortunately, the company has not delivered on the numbers. So I think, despite having a very strong franchise, unless the market sees better earnings growth and better good quality performance numbers from the company, any short-term upside is not possible. So I would say that, rather than booking a loss, just keep a long-term time frame of at least 12 to 18 months. 1 year could be a little short. So I think keep the faith alive and keep invested for a longer period of time.
Okay. The stock is taken a beating of about 19-20% over just a month's time frame. And I guess the advice is appropriate. Wait and see how it pans out. Hope that answers your question. Now, we have to slip into a quick break, but a quick reminder for tomorrow. We've got, before that, Brijesh, thanks so much for joining in. I understand that you have to leave us, and thanks so much for taking the time. Avinash, to stay with us. Quick reminder for tomorrow. Tomorrow, of course, 18th of February, 10 a.m. onwards, we've got the flagship business event of NDTV Profit. It's called the NDTV Profit Conclave. It's set to bring together some of India's biggest corporate and political leaders to discuss the country's roadmap to becoming a developed nation by 2047. The theme is Blueprint for Viksit Bharat 2047, and the conclave will focus on inclusive development, sustainable progress, and strong governance with a special emphasis on youth empowerment. Union Minister Piyush Goyal will be joining us, and so will State Bank of India Chairman C.S. Setty. Mahindra & Mahindra's Anish Shah, Nadir Godrej, Ramdeo Agarwal, and Morgan Stanley's Rhythm Desai, all of them are going to be there at the event tomorrow. Hope you're going to be there as well. We'll be back after this very quick break. Do stay tuned.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
tax regime for individual. In fact, there has been discussion on how to sort of reduce the tax rate.
I am now happy to announce that there will be no income tax payable up to income of 12 lakh rupees.
Do you really know the company you invest in? What's the picture behind presentations and claims?
Hello and welcome. You're watching KYC, which is Know Your Company. It's a show designed to give the regular investor powerful, actionable insights into fundamentals of single NSE listed companies every day. So we're going to bring you today Aadhar Housing Finance. It's of course, as the name suggests, a housing financier. It's one of the largest private housing financiers in the small mid-cap kind of space. Has around 18,000 crore in terms of market cap, does mortgage related loans and products. It also has a presence largely in 20 plus states. It gives loans for residential property purchase as well as construction. It also does home improvement and extension loans. Of course, all of this is secured and all of this is in the retail category. Just quickly rolling forward, loans for commercial property and construction as well as acquisition. So it does those as well, but a smaller quantum, and it's largely focused on low income housing. Sub 15 lakhs is the loan ticket size which they generally give out. Their average ticket size per customer is 10 lakh rupees. So really, really small in terms of loan size. 74% of its loans are to retail and retail home loans, and 26% is other mortgage loans, but again backed by housing and largely retail. Now, in terms of just the trajectory, in terms of scale, 21 states that it currently covers. It has branches across these 21 states, and the number of branches at the end of Q3 is 557. So it's a wide branch network that it has. Also growing at a healthy clip, that number. So something to look out for in terms of growth as well. But quickly on to parameters, and we discuss these every day, and depending on the type of company we break down parameters. But this one is a housing financier, NBFC, so these are the parameters we look at. We look at the income statement, how quickly that has grown, the balance sheet, how well and how adequate is its capital adequacy ratio, as well as what kind of growth clip does it have on the AUM. Operational metrics, this is key generally for housing financiers and NBFCs because it determines, and we try to break down what the spread is, what the margin is, what the yields are like, and what's the kind of ROA that the company clocks. ROA is return on assets, and it's a measure of profitability. So how profitable and how consistently profitable is the company? That's something we look out for. Among others, we look at shareholding, street cred, street coverage, as well as valuations, all relevant metrics to look for when you're looking at a company and when you're analyzing it. Of course, over the next 20 odd minutes, we'll break this down as well as speak with management. We'll also talk a little bit about risks because that's a key, right? When you're looking at any company from a bottom-up perspective, you want to look at what the risks also are. Let's quickly look at the income statement though, and let's pull that up and let's break it down. Your net interest income has gone up at 28% CAGR over the last 3 years. Provisions down 9%, very healthy because despite a faster clip, growth clip that the company is clocking, you've not seen provisions go up. In fact, it's come down. But mind you, 3 years back was a slightly higher base as well. Profit after tax growing at a very healthy 30% YOY. So you look at those two numbers and it starts to show it's quite stable in that sense. Both of those numbers, 28% on NII and 30% on profit after tax. So those are two metrics, clearly a thumbs up given the kind of growth clip that this one is growing at. Let's look at the balance sheet now. Let's break that one down. You look at AUM growth, extremely healthy. You're looking at a 19% kind of AUM CAGR over the 3 years and 9 months that we're looking at it from 14,000 or sub 15,000 crore. It's gone up to nearly 24,000 crore in just about 2 years and 9 months. So 2 years and 3 quarters. And likely that growth clip will sustain, but it's something that you'll want to ask and quiz management. But look at the borrowing number. Generally, when you're looking at a fast growing company, you'd want the borrowing number also to go up commensurately, and that's exactly what's happened. It's gone up from 8,000 or sub 8,900 crore to 15,000 crore, but it's done its IPO, it's listed, capital adequacy therefore is extremely healthy and continues to remain so. Historically, this company has had a capital adequacy of anything between 35 to 45%, and that seems to continue even in the post-listing era of the company, and that's one key positive you'll want to look out for. And therefore, what this will typically do is a large part of the lending that they do is funded through equity. I'd want to understand, and we'll have the management again, whether that will continue or whether they will do more leverage and more borrowing, because that will add to the profitability metrics as well. So I'd want to look out for that one. The 19% AUM growth is significantly positive, and the CRAR, how does it evolve, is something I'll want to look at. When does the next equity raise actually come? Now, we're looking at operational metrics now, and balance sheet, just to kind of cap off the point, is a neutral, because I'd want to look at those couple of metrics as to how quickly or how much is the company willing to borrow, or will they have capital adequacy between 35 to 45% from a conservative standpoint, and therefore will not take on leverage. That's something I'll want to really quiz the management on. But let's look at yields now. Yields have largely been in the 13 to 14% kind of mark. That's the kind of yield number that we have. You look at the cost of borrowing. The cost of borrowing has gone up from 7% in FY22 to 8.1% in 9-month FY25. This is also because we've seen the rate cycle change, and therefore you've seen cost of borrowings go up. Spreads though have been extremely flat. You've seen the spread anything between 6 to 5.8%. The management has always guided that they'll continue to aspire for this kind of a spread, and spread won't decline meaningfully. Margins are at 9.2%, and we're not flagging that off simply because of what I described in the balance sheet. It's very, very large amount of equity, which is what is funding the balance sheet at this point. If that unwind were to happen, just to give you clarity, 24,000 crore is the AUM. The borrowing number is just about 15,000 crore. So you've got 9,000 crore of equity, which is funding the AUM alone. Now, it's not very common for NBFCs or financial lenders to have that kind of a leverage ratio. It's very, very low, and therefore the risk is very, very low, but also it kind of keeps a lid with regard to returns, and therefore that's something I'd want to look at, and therefore that neutral rating there as well. But cost to income, this also has been fairly decent. The FY22 cost to income was 36.3%, 37.5% in FY24. In FY25, there's a correction here, 35.9% is the current cost to income ratio. So it's the lowest in the last 3 years, the cost to income, and I'd want to know whether that has scope to shrink further or not. Definitely a thumbs up on this metric. You look at ROAs last off, just to kind of cap it off. They've gone up from 3.2% to 4.3%. So ROAs have just gotten better as the years have gone by. Can ROAs hold up will also be the other question, but otherwise operational metrics largely positive in my mind. Let's talk about asset quality. Your NPA ratios, when you're looking at those, largely stable, right? Last at least 4 to 5 quarters, they've largely been range bound. Even your net NPA, largely range bound, anything between 0.9 to 1. And two things which stand out for me when you're looking at asset quality. One is your loan to value ratio. What does loan to value actually mean? It means that the loans that you're disbursing, right, as the ratio suggests, the loans that you're disbursing to the value of the asset, because it's a 100% secured loan, the value of the asset that you have. So say, for example, you have an asset of 100, you've disbursed a loan of only 59. That's what this indicates, and therefore looks very, very comfortable, because in case of a default, I mean, there may be individual loans with different LTVs, but largely with a 59% LTV, the book looks robust, because in case of a default, if you need to recover 59 from a 100 rupee asset, that's very easy to do. And that's what this essentially indicates. So you may want to look out for that as one of those. And second is, it's a 100% secured book. So your loan to value largely indicates the safety net that the company has to try and recover in case of defaults. And that's what gives me comfort to give this a big thumbs up, because it's a 100% secured book and your loan to value ratio is just about 59%. I want to also zoom in on the shareholding pattern. Now, while I've given this a thumbs up, the shareholding pattern, it's because 75% is promoter held. I'd be very curious to know whether the promoter is looking to dilute at any point in time. Mind you, it's a recently listed company, and therefore promoter holding of 75+% is not too common. And even where in NBFCs you have these large promoter holdings, you will somewhere start to see the promoter dilute, because eventually the RBI does want more and more free float holding, as they call it. I mean, in banks, of course, it's capped, but in NBFCs, there is no cap. But at the same time, you would want to try and understand as to whether the promoter holding is going to come off or not. And we will ask the promoters that when we speak with the management today. I want to also talk about street cred. I've given this a positive nonetheless, the shareholding. But let's talk about street cred. Now, this is one metric where the 3-month performance hasn't been great. But when you're looking at the 3-month performance on the Nifty mid cap and small cap, this one has sharply outperformed. And therefore, I'm very tempted to give this a thumbs up on this metric as well. 25% from listing. So those investors who have held on to the stock even or who got the stock in IPO, who have held on to the stock since the day of the listing, have made decent money. They've left money on the table for some of those investors, which is a positive. So all of those metrics point well in terms of the direction in which the stock is expected to be at. You're looking at street coverage. 7 analysts track the stock, and there are some marquee analysts here. There's a Citi, there's a Nomura, there's an Investec. Some of them have given it very, very strong upsides, but the average upside is 41% on this one. In a falling market, it's interesting whether this will start to see downgrades. Well, we've not yet seen it, but you want to keep your eye out on that. But a 41% upside as of now clearly warrants a thumbs up on this count as well. Last off, with regard to valuations, and it's not looking very, very expensive either. You look at an Aptus, you look at a Home First as well. I mean, I don't have the Bloomberg price to book on Home First, unfortunately, because there isn't enough coverage, but it trades at above 3 times price to book, largely. Home First Finance, Aptus Value, there's also an Avas. PNB Housing is one of those where there's a turnaround at play, but at the same time, that one, because of the turnaround and because of the risk, is valued at 1.1 times. Aadhar, for a 4+% ROA business, to value it at 2.3 times seems very, very fair in that sense. So valuations don't seem egregious in any fashion, and they seem okay. And therefore, you're seeing a 2.3 times price to book on this one. But that's broadly the picture with regard to the company. And just a couple of things I want to highlight here before we move on. Of course, there are risks that each company comes with when we invest. And while we have a 7.5, which is a record rating on our KYC, very little wrong that this one is doing at this point, basis the numbers that we're looking at. But I want to highlight a few risks. One, can the scale up of the business continue? That's one thing, and that's one risk that you'd want to bear in mind. There's rising competition in housing finance. It's a decent margin product, it's a secured product, unsecured is facing headwinds, and therefore you might well see that there is plenty of competition pressure which is there. And any kind of asset quality deterioration may also be a bit of a dampener. Other risks, of course, we spoke about, could be promoter dilution. There is also one key piece which we've not spoken about, that self-employed is rising as a share of the business. I'd want to know whether self-employed will come with its set of risks and those risks are getting priced in separately, or is there enough comfort on the asset quality standpoint even from self-employed? So those are some questions that I'll want to ask and quiz Mr. Rishi Anand on. But let me quickly welcome him on board. He is with us. Thank you, Mr. Anand, for coming, speaking with us live this morning. Always good having an understanding housing from or housing finance from your perspective. So I want to first understand, and this is more focused on Aadhar housing, as you would have gathered if you're watching us. So I want to first understand what the growth clip is likely to be and what the levers for that growth clip are for the next maybe 2 to 3 years. From an investor standpoint, what should he expect from you?
First thing first, very good morning, Harsh. It's
good
always a pleasure to interact with you and good to see you. Okay, so first you asked about the growth levers. Let me give you some indicative numbers, and we've always guided these numbers. I will stick to those numbers. AUM growth 22 to 24% as we head towards the financial year closing. Disbursement growth would be about 20 to 22%, which will ultimately tantamount to about 20%, 22% growth in profit after tax. How do we get this growth? What are the levers? There are multiple levers, right from multiple government initiatives which start from PMAY 2.0 interest subsidy scheme to SWAMI scheme that just got announced, SWAMI 2.0, tax benefit that has just come in up to 12 lakhs, which will enhance the loan amount by 3 to 4 lakh rupees for each individual. Then more importantly, the mortgage guarantee fund that has been announced pre-budget, which caters to the EWS LIG segment. So that's from the government initiative perspective. From Aadhar perspective, individually, we are looking at expanding our network. As you would remember, we've already added about 60 branches this financial year, and we will continue with this trend over the next 2 to 3 years. 60 to 75 branches will keep adding. In terms of states, we are already in all possible states. We are already in 21 states. So what we are currently doing is expanding our network into deeper locations, into small talukas and small district centers. That's what we are doing, Harsh.
Understood. And so what allows you or what gives you the comfort that as you grow deeper, there's not going to be any impact on asset quality?
Harsh, going deeper is a part of our overall strategy. See, what is happening is the larger cities, the top 100 cities of the country, because of inflation, because of rise in cost of construction, because of certain bit of competition, there are two things that are happening in larger locations. The ticket size is going northwards because of inflation, as I said, but your yields, incremental yields in large locations are dropping. I will not say substantially, but they are dropping. To counter that effect, what we are doing is we are going deeper, where you get ticket size which is half of what I do at a regular large location. So I get a 5.5 lakh kind of ticket size from deeper impact locations, and I get 300 bips higher yields. So at the company level, I am able to balance out. On one end you have yields dropping and ticket size increasing. On the other end you have ticket size dropping and yields increasing. So at the company level, we are still at a 10 lakh kind of ticket size and about 13.8, 13.9 incremental yields. You touched upon the asset quality. We've been in deeper locations. We have about 140 branches up and running, and we don't see any trends of our, the consumers going bad.
Okay. So, is there risk from competition? Is that something you're visibly seeing?
Okay, before I come to competition, maybe I can just add a little bit more on the asset quality in the
Please.
deeper impact applications. You know what happens, Harsh, is, and you'll have to relate to what I say, is and I've always said, and I've met you 3-4 times, and I've made this statement that the consumers I lend to, the emotional attachment to the asset is very, very high. I think that plays out when we go deeper. It plays out more deeper. You know, this consumer is going to make only one house in his lifetime, so the emotional quotient is very high, and hence, while you would see a little more bounce, because it is the banking habits are still to develop in deeper impact locations. But when it eventually comes to consumer becoming NPA and we going SARFAESI and using legal tools, that's where the consumer gives up and tends to pay up. So that plays a very important role. On competition, the good part is, and while I'm sure the industry is talking about a lot of large players coming into affordable segment, but the way it has transited over the last 6-7 years, Harsh, is within affordable, which is described as loan amount up to 35 lakhs. Within that affordable segment, there are two clear distinctions. One is companies which operate in average ticket size about 15 to 20 lakh, upward of 15 lakhs, about 20 to 22 lakhs. And these are companies like PNB Housing Finance, ICICI Home Finance, the entry of Bajaj or entry of Godrej, etc. And then there are these companies like us who operate in average ticket size below 15 lakhs. As I said, my ticket size happens to be only 10 lakhs. We are not seeing any traction happening on the segment that we operate, which is called as low income housing. So whatever traction is coming in the affordable segment.
Okay. So on your income statement, if I were to just break down your income statement and balance sheet together, your capital adequacy is at 46%. This is likely to come down as you continue to grow. My understanding is you will take on more debt. Please give us a perspective on what the plans for the next 3 years are, because you have enough bandwidth to continue to scale without doing an equity raise. And that will also mean that your ROA shrink because your interest expense will start to creep upwards. Just talk us through what the journey will likely be like.
Great. So first thing first, let me give you a little flavor of our current borrowings. Today, our AUM stands at about 24,000 crores, Harsh. And if I were to remove the direct assignment and the co-lending that we've done, which is approximately about 4,000 crores. So my loan book today stands at 20,000 crores. And my borrowing is at 15,000 crores. So my equity utilization is only equity and profit plowback is about 6,000 crores. Maybe I'll give you a little other flavor of looking at CAR and income level and debt is leverage. Today, we operate at a leverage about 3%. And the way we look at Aadhar Housing Finance couple of years down the line, we will look at a maximum leverage of 4%. And I'll give you what is the logic of 4%. Most of the rating agencies become a little uncomfortable the moment the leverage reaches anywhere between 4 to 4.5. And since we are very well capitalized, I think that's the leverage levels we will be in. We will try and maintain it below 4 levels.
Okay, so what does that indicate in terms of runway? When is the next equity raise expected given a 22 to 24% AUM growth clip?
I don't foresee, at least in the near future, 2 to 3 years time frame, any equity raise is required by the company. And in discussion with the current promoters, I don't think we are going to be doing that.
Understood. And therefore, how will the added borrowing on your balance sheet impact your ROA is what I'll be very keen to understand.
See, we are currently operating at about 4.4% ROA.
Yes.
The way we look at our business for the next 2 to 3 years, Harsh, is the same range, 4 to 4.3 is the ROA we will be maintaining.
Okay. And so therefore, where will you lever? What lever will you use to maintain that ROA given that interest expense will start to climb? Just given the fact that you'll be growing borrowing, there's no other reason there's no cost of borrowing increase per se, but what is that lever therefore that you'll use?
The cost of borrowing, Harsh, is obviously the way the markets are today, and you've just seen a cut happening by the central bank. While when we borrow in this 15,000 crores, etc., it comes on either a repo rate or MCLR link. A repo rate which is about 12% of my total borrowing, gets impacted immediately. And we foresee MCLR benefits also coming in the near future. I think where we are going to leverage is our OPEX reduction with all the technology investments that we've done over a period of time. Efficiencies and productivity levels are going to creep in as we move ahead in the next couple of years.
So therefore, where should your cost?
It's going to be OPEX.
Understood. So where should your cost to income lie, therefore, sir? And what should the journey be? 1 year, 2 years, 3 years? What's the thought?
Cost of income today, we operate, Harsh, at about 36%. And we've always guided that a reduction of a percentage, 100 bips year on year for the next 3 years is what we're looking at. So 3 years down the line, we should be at a cost to income of about 33.5%.
Understood. And sir, with regard to promoter holding, will it continue to be at this 75% plus kind of level? Will it come off significantly, or will you see minor dilutions start to come?
I have, and I'm smiling on that question because I have already answered that question on your platform earlier, and I will stick to that. See what the way it is panned out. See, ultimately, it's a private equity investment which has to die down over a period of time. Having said that, the fund from where Blackstone is currently invested, the fund life is till 2030. So we have good 6 years balance in the balance life of the fund. So I don't, and we are not seeing the promoters being in any haste or in any discussion of diluting the current shareholding, which is at about 75%.
Okay, point noted. So last question, and if you can keep your answer maybe less than a minute, because that's what I've been flagged for. What are the risks in your opinion here?
Harsh, we see two types of risks in our business on a BAU daily basis. One is, and both are related to the word attrition. One is book attrition, which is BT out, and one is employee attrition, which was on a rise till about 6 months back, and we see it plateauing out today. So both attritions are the risk to the business. Having said that, we are today at about 6.2% BT out, and the endeavor is to bring it back to about 5.5%, which is a comfortable range.
Okay, thank you so much, Mr. Anand. Always great chatting, candid conversation, and thank you for answering all the questions, including the little tricky ones. But thanks for coming in and speaking with us.
Thank you, Harsh. Have a good day.
Thank you, you too, sir. Anyway, so that's of course the management of Aadhar Housing. Interesting one. It's a record with regard to the rating as well. But more importantly, the risks are to be well kept in mind. So do look at all of it properly. But with it, we hope that we've covered all the bases. With it, out of time on this edition of KYC. Stay tuned to NDTV Profit. More action on the other side.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
entire special package and measures are kind of focused on AI skilling and how to sort of facilitate the AI centers which is existing at this point of time.
Now a center of excellence in artificial intelligence for education will be set up with a total outlay of 500 crores.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims?
Hello and welcome to Markets at 12. I am Puneet Zaveri, and let's quickly look at how the markets are doing. It's been a tough day for all the stocks, as well as reacting to almost the last leg of earnings. But apart from that, we have seen a lot of pressure across the stocks on tariff-related news, amongst other geopolitical pressures. And we've seen that on the Nifty. It's been a very volatile day today. Hit a low of about 22,725, and then has seen that buying trend coming in the middle. But it's going to be very important of where we end the day today. Let's quickly look at the Nifty 50 contributors as well, because we have seen some big moves there. And one of them is, of course, M&M on the downside, seeing some slight recovery, but ICICI Bank is a very big surprise there on the negative side, while HDFC Bank is, pulling the Nifty on the positive trend, but currently down by roughly 47 to 50 points. We've also seen Bajaj Finserv there, helping the bulls there, but Infi, Bharti Airtel also being the negative trend. Let's also pull up the sectoral index as well to have a look at how the other sectors are doing, and all of them in red except pharma being the key defensive play. One of the key surprises has been the Nifty IT today also. In such a day, we would be expecting some support there, but nothing as such. And the mid cap and the small cap indices are also down in the red today. A little more than the benchmark Nifty indices, down 0.7. The Nifty is down by roughly about 0.4, so almost double there, while the small cap is down 1.25%. Let's also look at the advances and decline ratio, because the broader market has been in focus essentially because of the wild moves that we've seen on most stocks reacting on Q3 earnings. Roughly about 1,800 stocks declining on the NSE right now. And finally, just let's pull up the Nifty 500, and that gives us the true picture, because we've seen a lot of stocks on earnings, as I mentioned, react negatively today. GSK Pharma reacting there positively, and Godfrey Phillips has been one way on the upside. Post its earnings, it had a 18 to 20% move. It's again continuing with a 15% move in trade today. We've also seen Kalpataru Projects also react positively on its earnings, and Uflex is another one. It started actually in roughly about 10 to 12% gains. It's pared down some of those. But on the negative side, we are seeing a lot of pressure on stocks like Tanla. Tanla has been hitting 52-week lows on a daily trading basis. Anupam Rasayan, again, another chemical stock that's not seen a good market demand environment as well. But another one stock that I want to talk about is Mahindra & Mahindra. Now, the company reviewed and reported on the exchanges on Friday post-market hours that they have 30,000 bookings of its electric vehicle BE6 as well as the XEV9e. Now, that news should have enthused the market with such strong numbers, because overall we saw just roughly 1 lakh unit sales in the previous fiscal year of FY24, dominated largely by Tata and MG. But now, even despite these numbers, it's not been a very pretty picture. And I think one of the key reasons has been the tariff news, because Mahindra does export the Oja tractors that they have, and overall it does contribute 55% of its overall profits, the farm equipment division. I think that might be one of the key aspects. But I just want to discuss M&M and on that aspect, the key numbers, because 30,000 bookings on day one itself on Friday, 14 Feb. And that's roughly booking value of over 8,400 odd crores, so roughly $1 billion there. definitely a key aspect. Split between both the models, XCV90 gets 56%, and the top end variant, the Pack 3, essentially for both models across the bookings have been 73%. So that will definitely drive the average selling prices up for both these models. And I just want to highlight 3 key points that Nomura is making. They maintain their buy target price of 3,681. It's roughly a 20 to 25% upside from these levels. And what Nomura has mentioned that they believe M&M has the potential to become the #1 player in terms of revenue market share for battery electric vehicles in FY26. That's one of the key aspects and turnarounds from that report. They've also mentioned that the BE6, which is the cheaper variant priced at around 18.9 lakhs all the way up to 26.9 lakhs, has seen a lot of younger crowd come in and choose that model. And that's another key aspect. It's getting a new customer in, which it hadn't attracted before. And lastly, they mentioned that, the Mahindra EVs might actually also be cheaper because, they're getting the PLI benefit due to higher local sourcing. So that's on Mahindra. While stock is seeing a lot of pressure, I think overall the EV sales is going to dominate the commentary in Q4 as well. But another stock in focus is RVNL. We spoke to the management today because, the stock has fallen by 7% after its Q3 profit declined by 13%, whereas, margins have remained flat. We did, catch up with, the management, Mr. Sanjeev Kumar, the Director of Finance and CFO of the company, to understand what led to this decline. My colleague Anushi has led this conversation.
Q3 in itself is as per tad bit lower than what we expected, but we are our 9 months leading to this, we are subdued. And the reason, of course, is, as those who have been following us would know, that in Q1 we were down 25%, we brought it down to 13%, and now we are a little around 10%. So which means that we are, and just comparing the two Q3 of last year, we are almost there, around 1.5% less. So we expect to keep this trend, and the outlook for the year would be what we initially projected at around 22,000 crore of turnover, and profit will also go up. And this we are taking it in a stride because there were the issues beyond our control, like the summer elections which are going on. Because of that, the administration had problems in acquisition of land. Then there were the political issues, the issues in Maldives, which now is settled. So we are once again commencing the Maldives work at a great pace. And most of our work, which has entered the last leg, the things we acquired on bidding, is going faster. Even the Rishikesh-Karnaprayag railway line, we are achieving much faster progress because the tunnel boring machines and our initiative are doing well. So while we have been in transition, we are in a kind of a V-shaped transition, and we are now moving up almost towards the level that we were a year and a half back.
Okay, Mr. Kumar, you've mentioned the first quarter. We did see an election-related impact on the subsequent quarters as well in terms of where the results are concerned. But now, along with that, I want to understand your sense in terms of execution. Was this also another factor which played into the revenue dip? And if now FY25 was an exceptional year in terms of because of elections and other factors as mentioned, want to get your sense in terms of FY26, what is the kind of growth that we can anticipate from RVNL in terms of where the revenue is concerned, in terms of where the execution is for the orders that are already there?
FY26 will be much better. The reason being that since we have transitioned from a company doing railway work on assignment to now majorly moving into execution after taking works on bidding, even though it may be railway works. So, and we have now around 50% in our order book, and by now we are stabilized to do such works also. And because the initial phase, you mobilize and you start the work, and the pace is not as good as it is. As we have seen 10 years back when we started with the railway works, we started growing much faster after 3 or 4 years. So now we are entering our third year in the works being executed by after acquiring it on bidding, and we have the system implementation system and everything in place. And because now we have a large order book and we are entering the second and third year of completion in many cases, the pace has picked up. Everything is in place. So 25-26 should be better than, not only this year, it should be better than the growth percentage should be much better than what we achieved over the last 3-4 years.
Mr. Kumar, if possible, if you can quantify the growth number in terms of where the revenue could be for FY26?
FY26 we should grow at around 6 to 8%.
Okay, so 6 to 8%.
Yeah, in fact over the year ending 24.
Okay, over FY24, 6 to 8%.
FY24, yeah.
And in terms of margins also, now in this year, we have remained in the 5 to 6% of range.
Yes,
you have a couple
yes.
of projects which are in the 8 to 9% of range as well, which are getting executed. So wanted to get your sense that would there be a margin uptick as well in the subsequent fiscals which are coming?
Yes, in fact, we have some projects like the telecom projects we have acquired. We have one on through competitive bidding in Lucknow, UP West and UP East from the DOT BSNL. And there it's a 15,000 crore project to be executed at a very fast pace to get the last mile connectivity. And that should, the projected completion would be in around 2 years. And there the margin hopefully will be higher because though we bid responsibly, taking the costs and other things. And sometime, like in some of our earlier projects acquired on bidding, like even the Maldives project, the Indore Metro project, Madhya Pradesh Metro, we have the margins are in fact a little better than the railway work. So hopefully the margins will improve as the balance shifts over the next 1.5 years or so.
Okay, so that is the trajectory going forward in terms of where the margins are concerned. Now, talking about the order book, I want to get your sense on what is the current order book value at, and in terms of the order inflows as well, if you can give us a sense in the third quarter and the 9-month picture. What is the order inflow picture totally building as in terms of what are the new orders you have secured? Where is this number currently standing? And what's the growth that you see in the next 1 year as well in terms of where the order inflows are?
The inflows have been increasing. The one is the BSNL DOT project, which we have secured two. That was the maximum possible. So UP East and UP West, that's 15,000 crore. And we have now an order book in which the works acquired through bidding, competitive bidding, is little more than what we have from the railways through legacy assignment basis. And that would be around, we are now almost touching 90,000 crore order book. And we want to always have an order book of 1 lakh crore. So we are, by the end of this year, we will be there.
Okay, so by end of this fiscal year, we can expect an order book of 1 lakh crore. Yeah.
1 lakh crore.
Wanted to also get a sense on some of the key projects in the order book which are there. What's the progress on that? You've already mentioned about the Maldives one and all, but if you can share progress on some other key projects as well.
Yes, the key project, the Madhya Pradesh Metro, that we are doing very well, and some of it will get completed. Then we have transmission lines in Madhya Pradesh. That too was a short period project, so will be ending this year. And we have two overseas projects. One is nearing completion, that is a joint venture project where we are 49% partner in Uzbekistan. And we have another project we are taking in Saudi Arabia. Now these are solar projects, solar parks, and they are short haul projects, 1 year or a bit, at the most 15 months. And it's a totally greenfield project and an area that we have now established ourselves in partnership. And we can also, going ahead, get some more work even in India for solar parks.
Okay, so that's in terms of where the key projects are concerned.
Yes.
Mr. Kumar, my final question to you is about the railway budget this year. Now, if you look at the allocation, you've not looked at a subsequent change. Wanted to get your sense on what you made of this budget and how are you seeing this budget in general? What's the expectation that you're driving from it?
Expectations, because the railway sector is almost at the same level. But now that we are not getting works on assignment, it is if we continue to acquire more railway projects also through bidding. So for us, it should not really matter. But as you have noticed, we are not only in railway infra, we are in other infra from ports to irrigation projects to the metro projects which don't come under the railways exactly. Except the Kolkata Metro, which we are doing as a part of the railway assigned work. But all other railways are, the metro works are part of Ministry of Housing and Urban Affairs. They and the state governments manage it. So, and there the number of metros are also growing. And we are going for the overall pie, the overall infrastructure pie, rather than only the railway sector. So though we are rooted in the railways, we are actually focused at entire infrastructure. So,
well, that was the management of RVNL, and the growth prospects are definitely in the high single digits as the management indicated. But another stock that's in focus is Utkar Small Finance Bank. Now, the company reported its Q3 earnings last week, and it wasn't a pretty picture because we've seen the microfinance, all companies suffer in terms of, asset quality being one of the key issues. My colleague Harsh brings in a detailed view of the same. Harsh.
Well, doesn't paint a pretty picture with regard to the numbers itself. We've seen degrowths across the board, growth only where it matters the least, which is provisioning. Provisioning has gone up sharply. There's been a jump. And that's impacted profit after tax. I'll read out some numbers for you. The annualized credit cost has gone up from sub 4.5 to 8.8%. Slippage ratio currently sits just below 16%. Margins are down 130 basis points. So top line not growing. In fact, 7.5% is now where the margins lie. And we've seen a sequential decline of 1.3% on the margin count. Mind you, want to underline that and really put it out there. Credit cost, I did mention at 8.8%, but the floating provisions are at 190 crores, or rather enhanced by 190 crores in Q3. Despite that, your PCR has fallen, which is provisioning coverage ratio has fallen from 78% to 61%. Sharp decline. Let's talk about NPA ratios now. 3.88% in Q2, currently at 6.17% in a matter of a quarter. And from 0.9%, the net NPA ratio has gone to 2.5% again in just a single quarter. There's tightening of credit supply, it seems, for microfinance borrowers. There's also more difficult guardrails which have been put up for from a lending perspective, and therefore borrowers are not able to refinance, which is also one of the reasons why we've seen the kind of result we've seen. Negative 2.5 on the ROA, negative 22% on the ROE. Not looking pretty at all. Of course, stock under pressure on the back of that.
Well, thanks for that, Harsh. Let's also quickly just pull up, the stock price performance of the past year. We've seen a lot of pressure on this particular one. There was a high that the stock made of about 60 to 61 rupees per share. Let's pull up the 1 year view, and there you go, down 55% from that high levels, and definitely not a good combination. But the other stock that's in, a lot of pressure today is from the defense pack, that's Zentech. Now the company also, is in lower circuit following its third quarter earnings, and profits have, been aided, but it's not a pretty picture again. Let me get my colleague Anushi to talk more on this. Anushi, it's been a lackluster quarter, and so we've seen the stock fall from the highs of almost 2,700. What led to this fall?
Hey, Puneet. So if you look at Zentech, the main talking point here would be on the EBITDA margin front. Now, the margins, if we are looking at, they have declined to 29% as compared to 42.7%. Even if you go to the subsequent quarters before this, we see that there has been a downtick in terms of where the margins are because of gross margins also. But do take in account and consideration that it's also the product mix and the execution of certain orders which lead to the variation in terms of where the margin profile is concerned. So if you look at what the guidance is given for this year, that is 35% for the overall FY25, and this 29% definitely below the 35% mark. But if we take the whole 9-month picture in consideration, it is still in line with the guidance. Now, as you said, that profit, if we are seeing the profit growth, the 30% that we are seeing is due to the higher other income, which has led to the profitability growth. That is why we are looking at a higher profitability number despite the margin downtick which has taken place. Order book stood at about 816 crore as of the December 24 end, and the company remains confident and on track to achieve its annual revenue guidance of 900 crore for the year. Last year it had missed its annual revenue guidance which had given. So for this year they have been on a more conservative approach, as we are seeing. PAT margins they are seeing of about 25% respectively by FY25. So management commentary on what has led to this EBITDA margins decline, what is the commentary forward in terms of the fourth quarter and subsequently the FY25 is something that we should be watching out for the company. Now do note that in terms of where the revenue is concerned, it has remained on a solid trajectory. It's clocked in a 53% of a revenue growth for the quarter, and they're aiming for a 50% of a revenue CAGR for the next 3 years going forward as well. There were a couple of other acquisitions also which took place in the quarter, and there could be questions arising about the capex needs of the companies on the same. They've acquired Applied Research International and ARI Labs for a consideration of 130 crore. This is to strengthen their defense simulation capabilities. The business is divided into two segments, which is simulation and anti-drone systems. So that is something that we could be watching out for on how this would lead to incremental revenues for the business. We've also entered into share subscription and shareholders agreement to acquire 45% stake in Bhairav and to acquire 51% stake in Vector. So these are some of the key developments which have taken place for Zentech, but it's the margin profile which is disappointing and has missed analyst expectations that we'll see on what the management has to comment on it in their con call, which is slated today itself. So yeah, so that is the overall view that we are seeing for Zen Technologies.
Well, thanks for that, Anushi. And definitely the margins falling is never, and the stock's actually down 55% just from the start of this year. So the overvaluation factor for small and micro caps definitely in play as well. Another stock that's in pressure today on the back of quarterly earnings is Centum Electronics. Now, revenue, this EMS player's revenue has fallen by 4.5% in a time where all EMS companies have reported strong revenue growth, and hence stocks are under pressure. EBITDA is down 32%. And the company's actually reported a loss of about 19 crores in this particular quarter. Now, while this is a small cap company, they are integrated into the aerospace and defense space in terms of the EMS category, and hence, a worthwhile stock to look at, but definitely not on the back of Q3 earnings. They mentioned that the margins were squeezed in this particular quarter due to losses in the Canadian subsidiary. They're expecting that to reverse in the next couple of quarters. They've also mentioned that some delay in projects in France has also impacted the margin profile, but definitely a stock to watch out for going forward as well. Another one, well, finally, some positive news in trade today is, Make Money. Now, my colleague Varsha is joining in to talk to us about what's triggering the positive trend on this particular stock.
Yes, thank you for that. So yes, Make Money Organics is up in trade today because the government has imposed an anti-dumping duty on titanium dioxide, which is imported from China. This is because Chinese companies were selling this product at a way too low price, which were affecting the domestic producers. If I were to talk about what this is used for, it's used in many things, but the duty only applies to the kind of used in paints, coatings, plastics, rubbers and inks, while the titanium dioxide used in food, medicine and cosmetics and textiles is not being affected. Let's talk about how much is the duty which is being laid down. The duty will add roughly 40 to 50 rupees per kg to the price of the Chinese titanium dioxide. Now, why this is good for Make Money Organics? Because now the Chinese product will be more expensive, and Make Money will sell this product in India with a higher margin. If you see, the Make Money actually isn't using the capacity much. It is using only 30 to 35% of the capacity of this product, and also the higher sale prices and higher production will lead to much bigger profits or EBITDA for the company. They're currently losing about 80 crore per year on this product, but they expect to make almost 40 to 45 crore of profit in FY26, which will be a sing to almost 120 crore.
Well, thanks for that, Varsha. But you also caught up with Sandhya J, which is the group's Chief Financial Officer at Narayana Rudralaya, talking about the quarter gone by. Listen into a chunk of their conversation.
So we have historically indicated that the international business is a temporary phenomenon. Eventually, it will decline. It is not our focus from a growth driver point of view, and we also believe that the there will be the geopolitical conditions will play out at some point in time. Just that it played out much faster than what we had anticipated because of the political turmoil. We are seeing some footfall coming from the international patients now. The visa restrictions have been relaxed to an extent. So there is some sort of a recovery we are seeing, but we are not counting on that recovery for our business outlook. Our focus continues to be domestic business. And if you see our domestic numbers for Q3, we have shown a very healthy growth on the domestic business. So while international, like you rightly said, declined 50%, the India book of business grew by 18.7% YOY. So we will continue to pivot on that and we'll try to continue to grow our domestic business forward.
Got it. Speaking about the domestic business, I was actually on to ask you that. So what's the outlook there? I mean, for the full year, that is FY25, and of course for the next year, FY26. Now, because you are seeing some pressure in international business, what is the outlook in domestic business? Where you want to take this growth to?
So there are two layers to the domestic business. One is the organic growth that comes because of better patient footfall, improved throughput, improved payer mix. And the second is the inorganic growth for the business, which comes from capacity addition and expansions. So as far as the organic book of business is concerned, I think that will be the trend for the next 2 to 3 years, where we are going to continue to keep driving better throughput through the system and keep trying to aspire for meaningful growth, as you have seen in the past few quarters. As far as the inorganic business is concerned, we have indicated that we are going to add at least 1,400 beds over the next 3 years. These are confirmed additions, which are capacities we have locked up. And we are also looking at more opportunities in pipeline to increase our bed count. Our bed count will be focused around Bangalore, Kolkata, and Raipur to start with, because those are our strong markets and where we are able to get much higher confidence in terms of our growth ambitions. Once we have exhausted the potential of these markets, then we will start looking at the next set of markets.
Got it. Also, Sandhya, how has been the occupancy this quarter? Number one, and since you more focus on revenue per patient, so wanted to know how has the trend been there, and what's the outlook in both the cases?
Sure. So historically, we have not measured occupancy as a key measure. We always say that occupancy is a little misguided because it does not take care of the realities of the business. Having said that, our occupancy is normally in the range of 60 to 65%, and in a quarter like Q3, which is seasonally a weaker quarter for us, it typically comes in at the lower end of that. Now, as far as our ARPP, which is average revenue per patient, is concerned, we have seen a healthy growth in our ARPP, both year-on-year and quarter-on-quarter, and we believe that this trend will continue.
Well, that was the management of Narayana Rudralaya. But with that, that's all the time we have on this edition of Markets at 12. Stay tuned to NDTV Profit for more.
regime for individual. In fact, there has been discussion on how to sort of reduce the tax rate.
I am now happy to announce that there will be no income tax payable up to income of 12 lakh rupees.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV.
Down to 50% plus minus 1. This is a commitment we've given in the budget. Every measure will be taken to bring down debt, and that is something which we owe to the country. We need to have a country responsibly run, at the same time not affect any of our education, nutrition, health, hospital services, and of course the asset building in terms of connectivity, internet connectivity, road connectivity, and every other port, enhancing our capacities and so on. All this will be done. So coming first, immediately after the budget, to Mumbai is now a very holy and sacred duty. The entire ministry is here. We are here now before you to answer your questions. Thank you very much.
So that is Honorable Finance Minister actually addressing the media post the budget as well, clearly indicating that more players are needed in the insurance sector, and the government-private research entities want to actually go ahead and build momentum on R&D in science and technology, and the steps are being taken in the right direction for manufacturing via PLI schemes with companies who are compliant, and the state government will also come forward to address compliance-related stress. Space, nuclear energy sectors, these are the ones which are receiving investments. We will get in more details as well as and when they emerge from the press conference. But let's quickly just look at what markets are doing at this hour. The downtick does continue. If you see in terms of Nifty 50 as well, clearly we are now below that 22,850 mark, 100 points lower, 0.5% cut coming in there, though we've recovered slightly from the day's lowest levels. So we are pretty much at the midpoint. Bank Nifty is also taking a beating in today's day of trade. There you go, almost 300 points cuts coming in terms of Bank Nifty as well. Let's quickly pull up the sectoral indices and see what is the pressure point looking like so far, because clearly, I mean, there you go. It's only pharma which is seeing gains of nearly 1%, but apart from that, real estate, auto, media, consumption, IT, FMCG, all of them down to the tune of almost 0.8% to around 1.5% in today's session. The advanced decline ratio somewhere is favoring the declines, but it's pretty much 50-50 on Nifty 50 with 23 advances to 27 declines. Sensex, again, you see 50-50, but in the broader markets, you just have 420 companies which are trading in the positive versus almost 900 which are in the negative as well. Stocks which are holding up, Bajaj Finserv is holding up to gains today. You have IndusInd Bank, which is seeing gains of almost 1.7%. Adani Enterprises, Power Grid, as well as Cipla, which are trading in the positive. What's losing? M&M. 4.5% is the kind of cuts that we're seeing. What's interesting to see with an M&M is that brokerages are absolutely positive with regards to the kind of bookings they saw for the EV variants, but it's the street which is slightly taking it with a pinch of salt. I think the street had expected a better number in terms of the bookings. So it seems this is a knee-jerk reaction, because you might see that bookings that could pick up. So that's an interesting one to watch out for. Axis Bank, Wipro, BEL, as well as ICICI Bank are trading with cuts. Let's quickly pull up the broader markets and see what's happening with the mid-cap and the small-cap index as we speak. In fact, they're underperforming the benchmark indices. There you go. I mean, mid-cap index 1% lower, as well as if you see in terms of the small-cap 250 as well, 1.4% is the kind of cuts that we are seeing so far. In terms of individual stocks, what is losing? Zen Technologies, 20% is the kind of cuts that we're seeing on the counter on the back of earnings. In fact, Anushi will get us more in terms of, what has happened over here, because the numbers don't look that bad, but I think the street is really punishing it. Senco, 10.5% is the kind of cuts. The markets are not really happy with what's happened with the Senco Gold from the margin perspective. Orchid Pharma, KFintech, RateGain. These are a few of the other names which are taking beating. What's on the uptrend? Glaxo, on the back of earnings, 18 to 19% is the kind of up we are seeing. You have Godfrey Phillip, which is trading with smart gains. Kirloskar Brothers, as well as Manapuram Finance. These are few of the names that we are picking up, which are doing pretty well in trade. So that's with regards to where markets go. But clearly, Anushi, if you see the broader markets, last couple of trading sessions, February itself has been so bad that they have been trading under pressure. And I think when this rout is going to end is what the street is waiting and watching out for.
Absolutely. In fact, if we see what the markets have been at the mid cap and the small caps, everyone has been talking about, and the preference going back to the large caps is something that we should be seeing. But let's introduce our guest for today to discuss more on the markets, and we are joined by Sharmila Joshi from sharmilajoshi.com. Sharmila, firstly, we are starting the show every day now with the markets. What's the outlook for markets currently? Where's the pressure? It's the small and mid caps, the valuations, there more correction on cards. What is your overall outlook on the markets?
Yes, so I think absolutely, it's what you were discussing a little while earlier. I think when we do see some kind of a recovery, my bet is that it will come on in the large caps first. Because all said and done, even in terms of earnings, even in terms of safety, that is where the money will come. And very clearly, everybody who entered the market in that COVID sort of period, for those investors, this has been a very punishing market over these last 5 or 6 months. And typically, retail investors are predominantly in a lot of mid cap and small caps, which really saw a runaway rally. And there would be profit booking there. There would be, in some cases, where losses would be booked. So all the action seems to be in the small cap and the mid caps, largely because that was also sort of the retail and DII flows were what was actually FIs have been sellers for a long time, and we've been making this case that it is the domestic money that has been holding up the market, and we would continue to see pain there. So to my mind, let's not be in a hurry to buy. Levels are looking good in a lot of, they've been looking good in a lot of large caps. Now they've begun to look good even in selective mid caps, but let's not be in a hurry to buy. Because, precisely as you were saying, when this whole thing is going to bottom out and when we are going to see things turn is really, we don't really know. I think that's going to be the tricky question to answer.
Right. So that's with regards to markets. In fact, during the first half of the day, we've also spoken to Anish Shah as well as Gautam Duggad. Firstly, what's happening in terms of markets, what could be expected going forward, and what are the earnings picture painting for FY25, that's the remainder of the year, as well as FY26. First, let's listen into both those conversations.
PSU banks have posted a better than expected set of numbers. We were expecting close to 12-13% earnings growth. The actual number was 24%. And the heartening thing is that all the 6 PSU banks that we track have beaten our expectations. In fact, we've upgraded Punjab National Bank to buy rating during the quarter, while our overarching preference, as far as mid-cap is concerned, is still with, as far as PSU banks is concerned, is still with SBI. Now, the thing is, PSU banks are still benefiting from lower credit costs. If you look at their PPOP growth, NII growth, they are broadly in a mid-single digit to low double digit. So NII growth is close to 5-6%, PPOP growth is close to 10-11%. So what happened is private banks stopped getting that benefit of lower credit costs from last 2 quarters because the base is very normalized for them as far as credit cost is concerned. Whereas PSU banks, which started benefiting from the lower credit cost slightly later into the cycle, are still accruing those benefits. I think a quarter or two down the line, even the PSU bank earnings will normalize. Having said that, the valuations are still very attractive for PSU banks, more so after the recent correction. You've told me obviously very selective in that space because the weightage in benchmark is still very low for PSU banks. As far as we are concerned, we have SBI in the model portfolio, and now we've upgraded Punjab National Bank as well to buy rating. But yes, fact remains that this quarter they stood out because very few sectors in the quarter managed to post 20% plus earnings growth. In fact, you can count them on fingers: healthcare, real estate, PSU banks, and capital goods, and of course, non-lending financial. So 4 or 5 sectors out of the 25 sectors that we cover. And PSU banks are a big part of, the sectors that have beaten those estimates.
Single-digit returns for Nifty is equal to you making that from a bond market.
Yeah.
Right? So we all know equities are volatile, equities are risky. If you're going to make a bond kind of a return from an equity, I think you're better off with a bond right now. Fixed income is a better way to do it. And that is as far as the large caps are concerned. And mid and small caps, we argue, will be negative returns. It's best avoided at this point in time. Large caps over mid caps, we definitely agree. Within large caps, we are currently within cyclical sectors. We prefer cyclical rate-sensitive domestic cyclicals. So we like real estate, some internet, some autos, financials. This is all rate-sensitive cyclical spaces. Okay. Otherwise, we are defensively positioned in healthcare, telcos, staples. So we have a fair bit of defensive skew to our portfolio as well. And anything to do with capex, we think is still more expensive. So call it industrials, metals, cement, energy, power. We are bearish on all of those.
Okay, well, that's the outlook for the markets in terms of where you can be seeing in whether one should be invested in bond markets or the large cap preferences. In terms of sectorals also, Amish Shah clearly indicating towards defensive plays as something that he should be watching out for. But moving on, for nearly 6 months, we have been seeing markets under the strain with a significant correction from the peak in September 2024. This is across all benchmark indices. An essential indicator of these market confidence during this period is the buying and selling activities by company promoters and directors. Here with us is Somit, who has compiled detailed data on these transactions. So Somit, take it away and explain what are we seeing in this.
Indian markets have corrected sharply from their peak. In fact, to be precise, the Nifty Mid Cap 100 and the Nifty Small Cap 100 indices have declined anywhere between 12.5% to 22%. In fact, the Small Cap index technically has also entered the bear market. Also for 2025, if you look at for the Mid Cap and the Small Cap indices, the start is the worst that we have seen since 2016 for the Mid Cap and the Small Cap index. Now, amid this conditions, it is important to track what the insiders have been doing with the companies. Now, for the purpose of insider trading, we have included the buying and selling activity done by promoters, key managerial persons, directors, their immediate relatives, and the employees as well. However, we have not included the buying and selling activity which is related to the stock options. Apart from that, we have also not included shares which have been converted into warrants and shares that have been bought or sold by the company trust. So apart from that, this is what we have included in our data and what are the findings here. Now, when it comes to buying activity, promoters have been quite active for Shobha. In fact, they have not only bought shares in the open market but have also subscribed to the preferential allotment, and close to 69 lakh shares is what they have increased their stake since September end till now, and that is nearly 6.4% of the equity. In fact, Naveen Jindal as a promoter has been quite active in the open market, and he has not only bought shares in JSPL but also in Jindal Stainless. In JSPL, he has bought close to 61.7 lakh shares, that is close to 514 crore worth of shares in the company, and that is nearly 0.6% of the equity. In Jindal Stainless, he has bought close to 20.2 lakh shares, that is close to 0.25% of the equity. Poonawalla FinCorp, promoters have bought close to 40 lakh shares, that is nearly 0.5% of the equity, while Ajit Isaac of Quest Corp has bought close to 7.5 lakh shares in the company, which is nearly 0.5% of the equity. Now, on the flip side, if you look at companies like Cochin Shipyard, DOMS, ZF Commercial and Syngene had seen some selling activity done by the promoter, but that was via a block deal and pretty much known in the market, and a one-time thing. Like in Cochin Shipyard, it was the Indian government who had done a divestment. In DOMS also the promoters, ZF Commercial, the MNC promoter, and in Syngene it was Biocon who had divested the SEC. But apart from that, which are the key activities that we have seen? Firstly, in Page Industry, this is the promoters which have sold nearly 1.5% of the equity. In 361, it is employees who have sold close to 12.5 lakh shares since October till now. In Info Edge, it is the promoters and their immediate relatives which have sold close to 1.2 lakh shares. In Polycab, also promoters immediate relative have sold close to 95,000 shares. And in Tejas Network, it is the employees which have sold close to 5.7 lakh shares. That is nearly 0.3% of the equity. So keep an eye out for these companies. A lot of insider transaction and dealings have been done in these companies.
Well, thanks for that, Sumit. Very interesting set of data that we are looking at. In fact, what stands out is some of the names in which the promoter buying has been very strong. This includes the likes of Soba, which if we go back and see in the last one, it has seen a 34% of a fall. There's counters like Jindal Stainless and JSPL as well. Sharmila, I want to get your view on some of the counters in which Sumit was talking about there being a lot of buying of promoter stake despite the fall that we have been seeing.
Yeah, interesting list, but I would think that the two names which are meaningful are really Soba and the Jindal Stainless JSPL bit. And for different reasons, I think Soba also because it's correcting and because we are seeing the kind of the impact of all these developments that have had on real estate as a sector. Because I think it stands to reason when you're losing money in equity. Then the kind of investments real estate has been seeing seems to have slowed or tapered. So in an environment like that, if there is buying by the promoters, it sort of gives you more confidence that they are expecting that their sector will recover along with market. So I think that's a very good sign. Again, I think for metals, it's a little complicated because I think they will also have an impact from everything happening globally. So how everybody, the world reacts to the steps US is taking, what China will do, etc., all remains to be seen. So these could be the interesting bits according to me, and I think for me, Soba is really the meaningful one.
That's with regards to JSPL as well as Soba. But shifting the focus to the auto pack, M&M is an interesting play that we have been watching out for. The stock is on nearly over 4%. And, the street actually was watching out for the kind of bookings that they would get with regards to the new launches. First, let's head across to Puneet to give us a lowdown. Puneet, in terms of the bookings, 30,000 is a pretty decent number, but it seems that the street is not really enthused with it. What do you make out of it? What are you picking up and what brokerages are saying?
Well, definitely, it's a very strong number in terms of the electric vehicle bookings on the first day itself. But there are two key aspects that you need to know about. One is, of course, the EV booking number, and second is the potential tariffs that might come from April 2nd on imports of automobiles. Now, the company Mahindra & Mahindra exports the Oja tractor in the US, and that might be one of the key things which might be impacting the stock today. But apart from that, when we shift focus to the passenger car side, there is no complaint on that aspect. So just three key data points. They have roughly 30,000 bookings on the first day itself, which was 14th of Feb for the electric vehicle models, the BE6 as well as the XCV90. And what interesting is that the company has mentioned that the collective bookings of all these numbers is roughly about 8,400 odd crores, which is of course executed over the next 12 to 18 months. So definitely a big number there. Apart from that, they mentioned the split between XCV90, which is the premium model. Prices start at roughly about 26.9 lakhs, goes all the way to 30 lakhs. That model has effectively 56% of the bookings, and that's another key number to watch out for. What's interesting is that roughly we sold about 1 lakh electric vehicle cars in FY24. So just on the first day, roughly 30% of that demand has got into M&M, and that's expected to increase going forward as well. But the only disappointment might be on the number itself. If I really have to just pick a number, is because when you compare it to the Thar launch, which happened in August of 2024, that number was much higher than this, because that roughly was 1.7 lakh units in the first hour of opening of the bookings. That's roughly 3 times of what they sold for the Thar in the year of 2023, the calendar year of 2023. When in comparison, the electric vehicle, this is roughly 6 months of bookings that they've got in the first day itself. While not a bad number at all, I think just the comparison with the legendary model of Thar might be a disappointing factor for the market participants if have to really go on and deeper and try to get that number out. But Nomura has come out with a very interesting note. They expect that Mahindra & Mahindra will effectively become the #1 player by revenue market share, not by market share of sales, but by revenue market share because of the higher selling prices of their models by FY26. And that's a big, bold statement that they are making. They're estimating that they will have a total of about 6 lakh cars sold, and roughly about 50 to 60,000 will be the electric vehicles. They've also mentioned that the initial feedback for the lower price model, the BE6, where the prices start from 18.9 lakhs, has seen a lot of younger crowd as well. So overall, there is not too much to speculate. It's a lot of numbers that are going around. But overall, while the EV booking number has been pretty strong, I think the tariff on tractors might be something to watch out for.
A lot of key positives in the store. Thank you, Puneet, for getting us a lowdown on the same. In fact, we did speak to Parag Thakkar as well in the studio of his view, because he's absolutely invested in M&M over the last 2 to 3 months. He's betting big on rural India. Let's quickly hear out his comments as well.
We have M&M in our portfolio, and we have taken it not because of this product launch numbers and all. We have bought it because of we believe in rural recovery. And we believe that we have bought it 3-4 months ago, and when we felt that rural is about to recover. So it was not a bet which was based on these launches. Of course, this was one of the triggers which we anticipated. And I think the numbers are good, but not that great for the launch. But we have it in the portfolio. So we have TVS and Mahindra, 2 automobile OEMs in our portfolio. No, I'm saying, I know that this is what, auto analysts come out with the reports, right? And sometimes it's a human tendency to change your views based on market prices also. So many people were expecting higher number, but it's okay, I think. One has to remember that Mahindra's 50-55% of the profits come from tractors, where they have given a very good outlook, and Q4 should be very good for them. In tractors, that is the channel check we have done. So I would say that just buying it on the base of this product launch and the bookings.
Right, so absolute positive commentary coming in on an M&M from Parag Thakkar as well, that this is just a knee-jerk reaction, and M&M tractors, that sales is expected to be spectacular in the fourth quarter. That's what his channel checks are indicating, and that could be another trigger point for you to look at an M&M. So probably the kind of sell-off that you're seeing today could be a good entry level. But let's take that question with Sharmila as well. Sharmila, how are you looking at M&M?
Just to first comment on this whole argument, let me also give my 2 bits there. See, when you're looking at the booking number, you also have to look at it in comparison to the total number of EV cars that are sold in a year. And then if you look at that booking number, then I think it's a really good number. Of course, if you compare it with Thar or any other car booked on the first day, which market has been sort of waiting for, then the number could look lower. But you must not forget that EV car market is still a developing market, and within that market, if you get this kind of a booking number, then it's really a very good number. If you number of electric vehicles which are sold in a year and what they managed to do on the first day they opened. And if you look at the product, it's a great product. Having said that, I completely agree that it's for Mahindra, this is still a very small bit of their business, EV cars. It's a great launch, but it's a small bit of their business. You do need to focus on tractors and the other larger bits. And to my mind, the sell-off is really more of a knee-jerk, and it's more really sort of accounting for the fact that we are not in a great market to start with, and any piece of news which you think is bad is going to get punished. That's how I'm looking at it. I don't think that I'm too affected by the news as a long-term investor. I do hold Mahindra & Mahindra. So honestly, I didn't really link the fall in the stock to the EV sales number.
Absolutely, any negative news is affecting. You can see Zen Technologies as well. 20% outtake in spite of the kind of numbers that have come in. But Samil, which is Samvardhana Motherson from the Auto Pack, that's another stock that we're focusing on as well today. The stock is slightly under pressure, but the profits have seen an uptick of around 62% during the quarter. The margins have also improved this time around. If you see in terms of the revenues, uptick of around 8% coming in there. Now, clearly, there is a 100 191 crore negative impact on the back of a loss in subsidiary in the third quarter profit number. There has been a negative impact due to hyperinflationary reasons, and impact is pertaining to subsidiaries in Argentina. In fact, we did speak to the management as well. Let's quickly first hear out what they had to say.
This is clearly an opportunity for us, especially when you think from a medium-term perspective. Given the global presence, actually we have more than 400 facilities across the globe, so a fair amount of spread across 45 countries. So you're right that we can recalibrate / rejig our production plan depending upon putting them into more favorable jurisdictions, depending on how the tariffs play out. Also, I think do bear in mind that a lot that we buy is also pass-through elements to it. So commodities are pass-through elements to it. We do have customer-nominated parts which would also have pass-through elements to it. And the remaining that we procure, we try and localize it as much as possible. So implication in any case is not going to be as much. But then, as I said, over a medium term, the ability for us to recalibrate ourselves is a lot more than some of the other players which may not be as global.
That's the management of SAMIL. Clearly, Sharmila, how are you looking at Samvardhana Motherson?
So, I think sometimes what happens is, I've been tracking the stock for a very long time, ever since it was Motherson Sumi, if you remember the older name of the stock. And ever since they sort of had this multinational model, there have always been, some or the other issues. And now, of course, we know the current sort of problems the company is facing. So it's a little unfortunate. I think it's a great stock in the kind of products that they are offering, and their OEMs or a lot of car makers, etc., etc. But that said, the stock price is not reflecting all those positive sentiments. So overall, I think it might be a better idea for now to focus more on direct auto plays than the auto ancillaries. I think you need to let the market settle down a bit before you can do that.
With regards to Samvardhana, from a 12-month, 9% is the kind of returns. It did hit a peak, but a good cool-off that's happened since September, October in terms of the stock price. But let's quickly slip into a short break. Up next, lots more lined up. In fact, we will get you more commentary from respectable finance minister as well. Please stay tuned.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
This entire special package and measures are kind of focused on AI skilling and how to sort of facilitate the AI centers which is existing at this point of time.
Now a center of excellence in artificial intelligence for education will be set up with a total outlay of 500 crores.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Hello and welcome back to Profit Buzzers. Our sector in focus right now is the steel sector, and this is on the back of some positive news which can be expected. In fact, we have a note from Morgan Stanley highlighting the same. Sumit, what is the note positive about? If you can give us some of the key highlights and then some stocks which would stand to benefit from this.
Well, yes, if you look at the Morgan Stanley note which has come in today morning on the steel sector, they are saying that they are listening to increased discussion around the anti-dumping duty or safeguard duty coming in on steel as a product. In fact, they believe that if there is an import duty that comes in on steel, it will be on all the entire steel imports coming into the country, and not just on steel imports coming in from China. They also believe that if there is some steel import that could be incremental, any incremental import duty would be positive for the Indian steel industry, as this could lead to higher domestic steel prices, thereby which will also support the margins of the company going forward, and also their capex, capital expenditure investment that they have planned over the next 2 to 3 years. They also believe that the entire steel industry would benefit out of this, but the companies which have a greater flat products in their product mix would be larger beneficiary of any import duty coming in. They have also said that a 15% safeguard duty may drive the domestic HRC prices, which is the flat product prices, by around 10%, and this may increase the FY26 EBITDA of their steel companies, that is Tata Steel, JSW Steel and SAIL, by anywhere between 15 to 40%. They also say that JSW Steel is the biggest beneficiary, given the fact that they have a high share of flat products and volumes, and SAIL, however, will see a higher delta on the earnings, given the fact that currently they have a low margin. So hence the margin upside for SAIL could be much higher compared to JSW Steel, but overall JSW Steel would be a much bigger beneficiary of an import duty coming in, given the fact that they have more flat products in their total product mix.
Well, thanks for that, Sumit. Sharmil, will come across to you some margin upside that we can see is what the Morgan Stanley note highlighted on the incremental import duty, which should be a positive for the company. Want to understand your overall view on the steel sector, and if you have any picks in which you currently track the sector.
So the stocks I like would be, the stocks that were being discussed. I do think that JSW Steel is a good stock. SAIL, now that it has corrected a lot, and the expectation of all these measures impacting them more favorably. So definitely, I think these are stocks you can keep on your radar. But I think the key thing here is two issues. One is that first we need to wait and see what is the import duty that actually comes in, and there are many moving factors just now. So you need to take everything into understand everything before you really take this kind of a call. And this is one sector which is always sort of moves in line with what is happening globally with prices. So while the domestic picture may look good or the companies may continue to deliver, what happens with prices globally on the London Metal Exchange always is the factor that defines the movement of the entire sector. So I think things are too much in a flux just now to really take a call, because the way the market is, the kind of news flow. But having said all that, I think the two stocks that I mentioned, JSW Steel and SAIL, they continue to look good.
Okay, in shifting focus to the primary markets now, Ajax Engineering is now debuted in which marked its listing today. It opened at a premium of around 8%, and in fact we spoke to the management discussing about how the outlook forward for the business is with the MD and CEO of the company. So do listen into what they had to say as well.
Ajax Engineering started back in 1992, and it's been a category creator, a pioneer, and a dominant player in the self-loading concrete mixer industry, where we have 75% retail market share. By the introduction of this particular product, it was able to democratize mechanization of concrete to provide high quality, consistent concrete across the country in a very wide swathe of applications. Since that time on, Ajax today has become a provider of all kinds of concreting equipments and solutions across the entire value chain of concrete, starting right from the production of concrete to the transportation of concrete, placement of concrete. And because of its innovation-driven capabilities, it is today one of the best manufacturers of slip-form pavers to provide concreting roads, and also has challenged the frontiers in concreting technology by involving itself and commercializing 3D printing in the country. Ajax's business model is a very simple, asset-light, lean business model, which means that its core is design and engineering, has a very strong set of suppliers, and this collaborative partnership of suppliers and thereafter the lean assembly operations has lent itself to a very strong, robust profile in terms of financial performance, the return metrics, the margin profiles, and more importantly, the EBITDA to cash generation in excess of 70% is an outcome of that. Ajax today has the largest network in terms of distribution across the country, 51 dealers, 23 states of coverage, 114 touch points, lends Ajax to what it is in terms of distribution by way of providing accessibility to customers in terms of sales, service, and spare parts across the country. In fact, Ajax has very strong tie-ups with all financiers who provide support across the board. In terms of its growth path forward, I think one of the important drivers of India's becoming a developed economy is infrastructure. And in that space, there are three critical components that we need to look at. The first part is related to the fact that core building materials such as cement is underpenetrated. Concrete is also underpenetrated in terms of just sheer numbers. If you look at it, the cement penetration on a per capita basis is only 260 kilograms. If you look at globally, the averages are between 475-20, which is twice the number. If you look at concrete penetration, and particularly RMC within the total concrete consumption, it's only about 11%.
Right. So, Mr. Saha, if we look at the business background, you've been doing considerably in terms of revenue growth. We have seen that strong kind of a growth coming in the last two fiscals also. 50% is what you had clocked in terms of where the revenue is concerned, and considering H2 is heavier, wanted to understand from you, is this expected to continue for FY25 as well, the 50% of a growth number, and also the upcoming fiscal, that is FY26 also, can we expect a similar line of growth to sustain?
I think the important consideration that we must play here is that from 2014 onwards to 2024, the decadal growth of the company has been 18%. And in the last couple of years, we're coming out of a lower base post-COVID. And also last year was a pre-election year with lots of liquidity and the impetus to the closure of projects and so on and so forth, which gave us a strong performance boost. Having said that, I think our near-term performance indicators are in the range of 15 to 18% growth as we move forward.
Okay, so 15 to 18% is the growth that we'll be looking forward. But Mr. Basu, coming to the margin picture, if we are seeing, we have also looked at a consistent pickup from 11.9% in FY22 to around 16% in FY24. Want to understand from you, firstly, what is leading to this uptick in margins versus your peers who have a 7 to 13% of a margin profile? And is the 15% or the 15 to 16% margin range going to sustain going forward?
Yeah, and good morning. See, I think on the margin, with the kind of growth which the company delivered at a 50% CAGR, the operating leverage kicked in. Ajax has a very low break-even. It's one of the lowest in the industry. And given that background, what it allows for is that whenever there is a volume spike, the fall through to the P&L is high, and that's why you see the swing of about 390 basis points between 22 to 24. So on a go-forward basis, also our estimates are that we'll be maintain the range of 15 to 16% EBITDA from a margin profile in the foreseeable 25 to 26 range.
Okay, so 15 to 16% is the range that we should be looking forward in terms of where the margins are concerned. Now, I want to understand from you, you already have growth plans, which also includes opening a new facility in Karnataka, and this is expected to open in August 25. Along with that, some expansion plans, which includes inorganic growth opportunities as well. Now, considering this was a complete offer for sale component in terms of where the IPO was concerned, would the internal accruals be sufficient enough to fund the overall future expansion plans of the company? Mr. Saha, I'll take this question with you.
No, sure. So I think the company's strong financial profile is indicative of the ability of the company to be able to fund the expansion through internal accruals. As of last year, we had 700 crores of cash available with us. I think that provides us decent enough heft to look at opportunities both within and the outside.
Well, that was the management of Ajax Engineering talking about the outlook forward for the business. But another stock in focus is Zentech, which has hit a lower circuit following its third quarter earnings. Now, if we look at what has happened, we are seeing a growth in terms of where the net profit is concerned of around 30% at 39.7 crore. But this is aided by the higher other income that we are looking at. The main point as to why we are looking at such a drop in terms of where the market price is concerned is on the EBITDA margins. Now, if we see EBITDA margins, they've declined to 29% as compared to 42.7%. Even in the last quarter, if we see, this was the EBITDA margins had remained as a concern for the business. This was due to lower gross margins as well as the product mix also. But as per if you look at FY25 guidance as well, the FY25 guidance for the year has been given as 35%. So 29% is significantly lower. So management commentary on the EBITDA margins is something we should be watching out for. In terms of where the revenues are concerned, 53% growth here, which is in line with their 50% of a CAGR growth for the next 3 years. The company has also maintained its 900 crore of revenue guidance for the year, which is on the conservative side. If you see last year, they had guided for the number, but they had fell short of the guidance. So something that we should be keeping a track is the FY25 guidance number as well. Around that EBITDA, they maintain at 35% guidance. PAT margins, they expect 25%. But Sharmila, coming to you on Zentech, 20% is the reaction that we are looking in terms of where the stock price is concerned. A big hit for the company. But the management commentary overall does not look that negative. Do you think that there is an overreaction in terms of where the Q3 earnings are concerned for this stock?
Well, we did see a phase where there was a sort of a big fancy for anything that, which catered to defense, etc. And all that is correcting now. So, there is a bit of a PE contraction happening in the overall sector. And then it is sort of, you have numbers which market does not perceive too kindly. So I wouldn't put it past, the way markets are currently, that the stock could get punished a little more. But yes, I do agree that this kind of a fall on a single day is a bit of, I think that now the reverse sort of trend is in the market, where if you see bad news, you sell and you try to make money like that. So, which is fair, I think, given the fact that it's a market at the end of the day. But in terms of valuations, I think now the stock looks reasonable.
Okay, so that's the view for Zentech. But let's focus to some of these pharma names now across the sea of red that we are seeing today. two names that stand out is Glenmark and Glaxo, and we have Varsha standing by to break down these results for us.
Thank you for that. So let me start with Glenmark Pharmaceuticals. The stock was actually not doing good in the morning when the market opened, but it's the con call highlights, or the con call which has led to uptick in the stock. But let me just talk about the numbers, where their India business grew 4x, Europe business grew almost 15% year on year, and North America saw marginal growth of 1.4%. The net profit of 348 crore versus loss of 470 crore. This is due to the Glenmark had actually in the last year had implemented some changes in the distribution model, which actually led to the losses in the last year, and this is the reason why you're seeing this huge uptick in the net profit. But the highlighting point here is con call highlights. If you see, the US business continues to remain challenging due to lack of meaningful launches, but they are expecting an uptick in this business in FY26, and they are maintaining their FY25 revenue and EBITDA guidance of 19%, and they're expecting 1 to 1.5% of improvement in EBITDA margin in FY26. That's a key highlighting point, and they're also expecting revenue growth of almost 9 to 10% going forward. Next on my list is GSK Pharma basically. So they've seen the strong performance across key product portfolios. Their respiratory portfolio achieved robust growth, and the net profit growth that you're seeing is due to the lower base. So company had an exceptional charge of rupees 163 crore last year. So overall, a very good set of numbers from GlaxoSmith, and also the con call highlights had led to the increase in the stock price for Glenmark Pharma.
Well, thanks for that, Varsha. Sharmila, coming across to you for these two counters. Now, positive commentary from Glenmark Pharma is what we are seeing, along with strong numbers from GSK Pharma. I want to understand your view on these two.
I think that pharma would be one of the sectors that would to my mind, lead the recovery. But of course, we need to see how, especially for the exporters, what is happening with the rupee, dollar, etc., as well as tariffs, if any. But GSK Pharma, I think, would be a safer bet. I own the stock, and it's not been doing well, as you all were just discussing a little while earlier. And the thing is that there is always a sort of a debate that goes on whether you need to buy pharma which is more export facing, or buy the sort of multinational pharma which is more focused towards the domestic business. So if GSK Pharma's numbers are anything to go by, and if this trend gets repeated in the other companies, then maybe that is something that market could focus on going ahead. But just looking at the valuation and the numbers, I think GSK Pharma looks good to me.
18% of an uptick is what we are seeing for GSK Pharma in trade today. But a couple of other chemical names also in focus, which includes the likes of Sudarshan Chemicals along with Make Money Organics, and Varsha continues to stand with us to share more details on the same.
Yes, so speaking about Sudarshan Chemicals, overall if you see the stock is down. Now this is on the back of earnings that the company had given. So overall on the year-on-year side, you're seeing good uptick in revenue, but quarter-on-quarter is what has not impressed investors. So if you see, revenue was up 18%, EBITDA was up almost 28%, margins were almost 12% versus 11% last year, and a few of the analysts were actually estimating almost 13 to 14% of EBITDA margin. That's what the disappointment has been. And the net profit is down almost 96%. Now the quarter-on-quarter cost of raw material, if I were to talk about, was 56% of sales versus 53%, and the profitability in the pigment segment has actually gone down. The net profit down of 96% that you are seeing is due to the exceptional item of 30 crore. Now they had acquired a global pigment company called Hubac, so the transactional cost related to that is what this exceptional item is been given, that is 30 crore. And the next stock on my list is Make Money Organics, which you see is up 8%. Now this is on the back of anti-dumping duty. So the government has put an anti-dumping duty on titanium dioxide, which is being imported from China, because China was selling this product at a very low prices, impacting the domestic companies of and if you see, the titanium dioxide is used, the duty applies to the usage in paints, coatings, plastics, rubber and inks, while the titanium dioxide used in food, medicine, cosmetics and technology will not be affected. Let's talk about how much is the duty. If you see, the duty will add roughly 40 to 58 rupees per kg to the price of Chinese titanium dioxide. And why this is good for Make Money? Make Money Organics makes this product in India, and the capacity is almost 16,500 metric tons. The utilization is expected to rise from 30 to 35% to 70 to 75% in FY26. Now that is huge, and the realization will increase the price to 215 per kg, leading to 14 to 15% of EBITDA margin, which is currently loss-making product for this company. The titanium dioxide business is expected to contribute 40 to 45 crore of EBITDA in FY26.
Okay, well, thanks for that, Varsha. So pharma and chemical backing up the trend today. But let's go across to the Finance Minister Nirmala Sitharaman addressing the media post-budget today. Well, we are looking at the video. FM Minister just standing by and addressing the media today. The highlights would be on some of the sectors which would be there: insurance, railways. She'll be addressing the media comments on the same. In fact, let's see how that is going today. But before that, we can speak about RVNL, which is in focus. Now, RVNL, if we are to look at, they reported their Q4 numbers, Q3 numbers, and we are looking at a revenue downtick of about 2.6%. EBITDA was down around 4%. Margins stood at about 5.2% versus 5.3%. Net profit seeing a downtick of 13%. Now, in their FY25 guidance, the company did expect an order inflow of 20 to 25,000 crore. In fact, they are bidding for more than 150 plus bids, costing more than 75,000 crore. The current order book stands at about 90,000 crore, and management remains confident on achieving the 1 lakh crore that was given by the management at the start of the year. But we caught up with Sanjeev Kumar, the Director of Finance and CFO of the company, who talked about their margin outlook. So let's listen into that slice of conversation as well.
FY26 will be much better. The reason being that since we have transitioned from a company doing railway work on assignment to now majorly moving into execution after taking works on bidding, even though it may be railway works. So, and we have now around 50% in our order book, and by now we are stabilized to do such works also. And because the initial phase, you mobilize and you start the work, and the pace is not as good as it is, as we have seen 10 years back when we started with the railway works. We started growing much faster after 3 or 4 years. So now we are entering our third year in the works being executed by after acquiring it on bidding, and we have the system, implementation system and everything in place. And because now we have a large order book, and we are entering the.
Well, now let's cut across to Finance Minister Nirmala Sitharaman addressing the media post-budget. But thanks, Sharmila, for joining to Profit Buzzers. But let's see what her take is on the post-budget. Yeah.
Numbers in terms. We talk about how this scheme particularly will benefit the MSMEs in going forward compared to what we've already announced in the last budget as well.
Well, on the MSMEs, this is not the first budget. In fact, last 2, if I would say 3 budgets have been doing various things to improve the business environment for MSMEs. Even in July budget, we had announced that we will come up with a guarantee which at a personal level the MSMEs can take, and also a term loan which will be given, which has never been provided for MSMEs. Earlier, they used to get, and which they continue to get, the working capital assistance. But a term loan for getting plant and machinery was never accorded to the MSMEs. But we, from the budget, July budget, had announced it, and that is what has made immense difference. Now the classification is also changed without anybody losing the benefits that they are enjoying in the categories of micro, small, medium enterprises. So by widening the definition, we are giving them a chance to grow without losing the benefits that they get as a MSME. And also this time we have given a government guaranteed loan up to 100 crores, 60% of which will be guaranteed. So there are immense lot of steps taken over the last few years, but this year, particularly the extent to which government guarantee also goes to strengthen it, will make a big difference to MSMEs. I'll check up with the secretaries if any of them have anything more to add. They can join in.
I just wanted to
Secretary DFS
supplement. The last budget, we have two schemes were announced specifically for SME. One is to provide up to 100 crores for the SMEs under the special mention accounts. That we are getting it approved. And the second scheme was mutual credit guarantee scheme for the MSME, which was launched today by the Honorable Finance Minister. And then first loans were also distributed. And this budget, we have three things we have the Honorable Finance Minister announced in the budget. One is reclassification, both in the investment as well as turnover, so that the firms with a higher capital turnover and also the investment, they will be eligible under the SME sector for lending. That's one. The other is we also announced the credit enhancement for the guarantee cover that we have announced. And also we have announced partial credit guarantee scheme, which will be implemented by the NAFID for the minor enterprises. This also includes other corporates also, but everybody. So these are some of these things announced in the budget, in the last budget and this budget.
One more thing which I would think that the Secretary DFS can mention is that we have given substantial money for development activities and for growth of MSMEs to the SIDBI itself. The SIDBI, being the Small Industry Development Bank of India, is very well placed as an institution to understand the credit requirements of MSMEs. The cycle of business which MSMEs go through is very different from the large businesses. And when public sector banks deal with it, they do understand, they extend it accordingly. However, when a SIDBI-like institution, which is otherwise a refinance institution, does it themselves, the understanding about the credit requirements of small and medium industries are better understood. So we have not only given them greater capital resources, but also announced in the July budget, which we will be following up, that SIDBI will now be opening up branches in every MSME cluster. So when units are present in a cluster, they don't have to go running to search for banks which can fund them. They can still do that. But they will also be SIDBI physically present in the cluster itself.
Mr. Yash Jain.
Your second question first. Rates have also been changed in this new regime. more favorable rates have been brought in, and more higher level or more incomes in the higher bands have also been brought into the lower bands, so that they'll benefit from a lower tax rate. So if you would only look at the rate charts that we've come up with, where the income bands and the rate applicable to them are also rehashed in favor of every taxpayer. So if you are talking of the new regime, the new higher incomes are coming into lower band, the rates for all of them have also been brought down. So on the question of your FIIs and the retail investors, it is true, and I thought you were implying it in your question itself, that FIIs also go out when they're able to, in a position to book profits. Indian market today, Indian economy today, has an environment in which investments are also yielding good returns, and profit booking is also happening. And I'm sure you would have seized that fact also. But I'll also ask Tuhin to say further on it.
See, as you know, the FIIs keep moving up and down depending upon where they want to really park themselves. And it is not true that, the FPIs are really moving from one emerging market to another. I think the general thing is that there is a little bit of, whenever there is a global uncertainty, they would really go back where they actually come from. Largely, I think, as you know, basically back to US. So we have to take that. In terms of resilience, Indian markets have held, although there would be any demand and supply impact would be felt. But these are the issues of temporary measures. If you really look at Indian economy, because eventually, the returns are obtained in the real sector, because the financial sector cannot really just be in a bubble. In the real terms, Indian economy is in a very good resilience, remains one of the fastest, in fact, the fastest large economy. And Honorable Finance Minister has taken a number of measures. If you really see, it's a very growth-oriented budget in which, we are really firing all engines. So, while there is investments, there is consumption, there is an MSME, agriculture, exports and investments. So therefore, I think this strength of the Indian economy will continue to grow despite global headwinds. Global headwinds we have to face. We have faced it in the past and will continue to face it. But I think India is in a strong position to handle it.
Anurag Shah, ET.
Thank you so much, ma'am. We missed this budget press conference in 2024, but thank you for continuing the tradition. No other FM did that. मैम, मेरा सवाल जो है वो जिस तरह से आपने एक बहुत बड़ा ऐलान किया है बजट के अंदर, इंश्योरेंस सेक्टर में FDI की लिमिट 74% से बढ़ा के 100% की गई है, तो ये जो कदम लिया गया है, जो इंश्योरेंस के अंदर आप बदलाव करना चाहते हैं इंश्योरेंस सेक्टर के अंदर, जिसमें 2022 के अंदर इंश्योरेंस एक्ट अमेंडमेंट का एक ड्राफ्ट बिल लाया गया था जिसमें कंपोजिट लाइसेंस, वैल्यू एडेड सर्विसेज वगैरह सारी चीजें जोड़ी गई थी, तो वो कब तक आते हुए दिखेगा? क्या इस वित्त वर्ष में हम उसे देख सकते हैं? और जिस अभी कुछ वक्त पहले आपके द्वारा एक चिंता जताई गई थी एक प्लेटफॉर्म पे कि इंश्योरेंस की जो मिस सेलिंग हो रही है वो बड़ा कंसर्न है बैंकिंग प्लेटफॉर्म पे, तो क्या जो नए अमेंडमेंट आप ला रहे हैं, इंश्योरेंस एक्ट अमेंडमेंट जो नया आएगा, तो उसमें ये मिस सेलिंग के कंसर्न को भी आप शामिल करेंगे? इफ यू अलाउ मैम, सेकंड क्वेश्चन ऑल्सो, बिकॉज वी आर इंटरेक्टिंग विथ यू आफ्टर 2 years. मैम, दूसरा सवाल PSU जनरल इंश्योरेंस कंपनियों से जुड़ा हुआ है. हमने देखा पिछले कुछ सालों में कई सारे सरकार के द्वारा ऐलान किए गए PSU जनरल इंश्योरेंस कंपनीज में पहले लिस्टिंग की बात हुई, फिर मर्जर की बात हुई, फिर प्राइवेटाइजेशन की बात हुई, तो अब आखिर में PSU जनरल इंश्योरेंस पे सरकार का किस तरह से फोकस है? क्योंकि ऑफ द रिकॉर्ड जो कर्मचारी वो कहते हैं कि हम काफी मोरली डाउन है क्योंकि एक सही दिशा नहीं पता चल रही कि आगे क्या होगा.
अगर मॉरली डाउन हो कि नहीं हो, अच्छा प्रॉफिट के कमाने के स्तर पर अभी आप पहुंचे हैं.
यस मैम.
Am I right?
यस मैम, वो सरकार के प्रयासों से.
हाँ, नहीं, बिकॉज दे आर सरकार के प्रयास और कर्मचारी के प्रयास, सबके प्रयास के वजह से. मगर मॉरली डाउन हुआ वर्कफोर्स वो दिखाते नहीं. वर्कफोर्स जब मॉरली अप है तब ही प्रॉफिट का पॉसिबिलिटी होता है. सो मॉरली डाउन नहीं है. आई वांट यू टू also encourage them with your words.
Yes, ma'am. Yes, ma'am.
Otherwise, I'll ask Nagaraju ji, Secretary.
Thank you. There are two questions. One is FDI 100%. This has been announced by the Honorable Finance Minister in the Parliament that we intend to bring the law. We have to change the law. That we are going to intend. The internal governmental consultations we have almost completed. And then we will take the next course of action. Now, along with this, there are also other rules that govern how the investments will be made and the profits will be repatriated if there is FDI. That actually is including the management of the companies where the FDI investment is higher. That also will be part of the proposed amendment bills we are bringing to the Parliament. So once the Parliament approves, those rules also will be notified, so that there is everything, all the reforms that we intend to do in the insurance sector to improve the penetration as well as insurance density will be done through these reforms that we are contemplating and announced by the Honorable Finance Minister. And coming to, I just wanted to add one small point. You know, this is the first time all the general insurance companies have made profit. I think all of you know, this is the Bombay, everybody should remember this. After 8-9 years, this is the first time ever all insurance companies, public sector insurance companies, made profit. Never before. And they are all doing well. There is no, despite when they are making profits, why their morality is down, I don't know. Okay, please increase that. See, mis-selling, we sell large number of policies, both private sector and public sector. Mis-selling basically arises the complaints we receive when the banks are selling. They actually unsolicited persuasion of customers are giving through call centers, making them buy the products which they don't want to at that point of time. And then because the first year premium is higher and people forget about it, that's one. And then there is also a complaint that in some segments of population who do not actually require insurance products, they are also forced to buy when they go for credit. That's one. And then the business houses, some small industries, when they buy, when they take the credit, they are also asked to insure their businesses, including the machinery, plant and everything. And then house building also. And some cases where the house owners are persuaded to buy insurance for themselves for paying the installments. But while this has been there, but now if you notice it, large number of complaints have been reduced. Now we have introduced a policy of 1 year lookout policy. In fact, we encourage our insurance companies to extend this lookout policy to 1 year, 1 month to 1 year. Now, most, including private sector, they are now doing that. If somebody wants to surrender the policy, please surrender. You get a full amount. There is no questions asked. That we have done. And then we also introduced in the public sector companies, including LIC, a callback. Once the product is sold, a callback will go to the customer whether actually he is happy with the product or he wants to surrender. That is also there. We have also asked private sector companies also to do the same callback so that the mis-selling is not there. Those who want to buy, please let them buy. This is, and we are also asking in the banks and other financial institutions, only the trained agents in the insurance segment, only they will be able to sell, not others. These are the measures we have taken to reduce the complaints and also whenever complaints received to redress them. Correct. We have, in fact, our public sector companies are doing it. In fact, private sector also, we have asked them to up to do for 1 year. Yes, composite license is part of the reforms the finance minister has announced.
Next, Ekta Suri from Z Business.
Good afternoon, gentlemen. Good afternoon, ma'am. Ma'am, Ekta from Z Business. मैम मेरा सवाल आपसे ये होने वाला, आपने बहुत राहत दी है इस बजट में एक आम नागरिक को, लेकिन कहीं ना कहीं बजट से पहले भी एक एक्सपेक्टेशन थी कि जीएसटी जो इंश्योरेंस पे है वो कम हो, ताकि विकसित भारत का जो टारगेट है 2047 में इंश्योरेंस फॉर ऑल वो पूरा हो। तो हम वो कब तक कम होते देख सकते हैं? और दूसरा ये कि लोगों का विश्वास जो है वो कोऑपरेटिव बैंक से थोड़ा सा उठ रहा है, क्योंकि हाल ही में जो घोटाला हुआ न्यू इंडिया कोऑपरेटिव बैंक के, तो उसको लेकर सरकार क्या कदम उठा रही है? एक डिपॉजिटर को 5 लाख से ज्यादा का अगर इंश्योरेंस कवर मिल सकता हो, ये 2 सवाल मैम।
जीएसटी के मामले में हमारे एमओएस वो कमेटी को देखते हैं, रेट रेशनलाइजेशन का विषय और इंश्योरेंस का विषय भी चर्चा में आया जीएसटी काउंसिल में। मैं उन्हीं को कहती हूँ कि ही कैन गिव यू अ रिप्लाई टू योर क्वेश्चन।
जो इंश्योरेंस पे जीएसटी का विषय है, पहले तो मैं बताना चाहता हूं कि जीएसटी का रेट घटाना बढ़ाना, किस पे लगना किस पे नहीं लगना, एक काउंसिल का विषय है और काउंसिल इसको तय करता है। जो सब्जेक्ट पे आप बात करें उस पर जीओएम बना हुआ है, उस पर अभी निर्णय होना बाकी है।
हम कब तक एक्सपेक्ट कर सकते हैं कि वो निर्णय कब तक आएगा?
अब वो काउंसिल को निर्णय आएगा, जीओएम का निर्णय आएगा, उसके बाद ही आपके सामने आएगा।
एंड सर, सेकंड पार्ट ऑफ द क्वेश्चन ऑन न्यू इंडिया कोऑपरेटिव बैंक घोटाला जो हुआ है।
Now RBI is seized of the matter. Now only they have taken the actions. We are not going to comment on that.
Anurag Joshi,
but the point about increasing the insurance, that is under active consideration. As and when the government approves, we will notify.
तो सर डिपॉजिटर इंश्योरेंस 5 लाख से ज्यादा बढ़ाया जाए?
That's what I am talking about. That. This is under the consideration of the government. As and when the decision is taken, we will inform.
सर कब तक हो सकता है वो डिसीजन? में रियली सॉरी इफ आई एम आस्किंग
Yeah, you're pressing it too much. If we have an answer, we'll give it to you.
Sorry.
Congratulations on the budget, ma'am. My question relates to the lagging pace of credit growth in the economy, and the pace of credit growth has lagged deposit growth for several quarters. Now I'm aware that the government in the budget you had announced for MSMEs you have increased the guarantee cover, which will release 1.5 lakh crore rupees over the next 5 years. And RBI has also taken measures, it's taken liquidity measures, it's cut the CRR in December. My question is that is there scope for further liquidity and monetary measures to alleviate the cash shortage which still exists in the banking system, and also improve credit growth in the economy? My second question is that the fund of funds, 10,000 crores for startups, how are you looking to operationalize that?
See, I think all of you know the credit growth this year is very good. I think one of the best years of credit growth in the financial system. We are doing well, including the MSME. We have almost about 16%. In retail also is good. Okay, a couple of months it was a little tempered down, but now it has picked up. Further liquidity measures, I think now we expect the 2 measures announced by the Honorable Finance Minister in the budget, the income tax relief, that will give us about anywhere between 35 to 45,000 crores into the banking system, which may actually increase the ability of the banks to lend more to the private sector. That's one. Coming to the 10,000 crores for the startup fund, last time when the Finance Minister announced in the budget, we could, with the 10,000 crores, we could actually lend revolving 90,000 crores to the startups. This time also, we are actually trying to leverage both equity as well as debt, and trying to bring our own banks to complement this fund, and may increase anywhere between 20 to 25,000 crores to the startups. So all the startups will get actually benefited.
Mr. Ashish from Maharashtra Times. Maharashtra Times. Then we have Ram Kumar.
या वैभव वैसे फ्रॉम महाराष्ट्र टाइम्स। एक सवाल ऐसा है कि जो बार बार आपके स्पीच सुनते हुए भी मन में आ रहा था कि एक ओल्ड रिजिम एंड न्यू रिजिम ये जो चल रहा है, तो अगर आप न्यू रिजिम में इतना ज़्यादा लोगों को सहूलियत दे रहे हैं और एंड यू इंक्रीज द टैक्स फ्री इनकम ऑल्सो, देन अभी तक क्या सरकार को फील हो रहा है कि ओल्ड रिजिम कंटिन्यू होना चाहिए, या मतलब आपकी भूमिका क्या है इस पे की, ओल्ड या न्यू?
देखिए, हमारा तो ये प्रयत्न रहेगा कि न्यू रिजीम इतनी अच्छी और सहूलियत वाली हो कि ओल्ड रिजीम की आवश्यकता ही ना रहे, लेकिन हम ऑप्शंस को भी नहीं करना चाहते बंद, क्योंकि धीरे धीरे जो प्रयास हमारा रहा उस प्रयास में जो पहले न्यू रिजीम आई और उसको रिलैक्स करके फिर के बाद वो 75% जो करदाता हैं वो उसमें आ चुके हैं, और हमें आशा है कि इस बार जो वित्त मंत्री जी ने बोनेंजा दिया है न्यू रिजीम को, तो उससे बाकी के भी आ जाएंगे। तो कुछ विशेष छोड़ के जिनका बहुत ज़्यादा, जैसे मान लो किसी का हाउसिंग का है और उसका पास रेंटल इनकम है और उसका बहुत ज़्यादा लोन है, तो उस स्थिति में शायद उनको ओल्ड रिजीम सूट करे, नहीं तो ओल्ड रिजीम प्रैक्टिकली नहीं अपने आप चली जाएगी। लेकिन हम व्यवस्था को रखे हुए हैं और बेसिकली आप देखें उसका जो प्रयत्न सरकार का यही रहा है कि आप माइक्रो मैनेजमेंट ना हम ना करें। हम जब हम सिंप्लीफिकेशन की बात करते हैं तो यदि बहुत सारे डिडक्शंस बहुत सारा वो करेंगे तो उसमें एक तो डिस्प्यूट्स भी आएंगे और दूसरे माइक्रो मतलब मैनेजमेंट हम कर रहे हैं। इससे अच्छा तो अपफ्रंट ही हम रिलीफ दे दें, और उसी तरह की प्रक्रिया रही है। तो इंडिविजुअल साइड में तो मुझे लग रहा है कि न्यू रिजीम विल बिकम, अभी भी वो डिफॉल्ट रिजीम है। आप यदि कोई भी खोलेंगे साइट में तो पहले न्यू रिजीम आएगी, आपको ओल्ड रिजीम के लिए ऑप्शन मतलब एक्सेप्ट करना पड़ेगा, तो अभी भी वो डिफॉल्ट है। थैंक यू।
मिस्टर दवे फ्रॉम गुजरात समाचार।
कुनेश दवे फ्रॉम गुजरात समाचार। मैम, आपका इस टाइम पे बजट बहुत अच्छा है, मिडिल क्लास के लिए रिलीफ की बहुत सारी मिली, मगर सर मैम मुझे एक प्रश्न ऐसा सोच रहा था, हर टाइम हर चीज़ की बात बोल रहे थे। मेरा जीएसटी से क्वेश्चन है, उसमें पेट्रोल और डीजल को जीएसटी में लाने की बात बहुत टाइम से चल रही है, मगर अभी तक आप लोग ने उसके पे कुछ निर्णय नहीं लिया हुआ है।
नहीं, वो क्वेश्चन एमओएस आंसर करेंगे, मगर पेट्रोल और डीजल के ऊपर केंद्र सरकार से प्रश्न पूछने का कोई कुछ बचा नहीं।
इकोनॉमिक में बहुत अच्छा फर्क पड़ सकता है ना।
हमने तो प्रावधान कर चुके हैं कानून में कि पेट्रोल और डीजल आना है, जब भी वो आएगा रेट के साथ उसको कानून में प्रावधान कर बैठे हैं हम। स्टेट्स को निर्णय लेना पड़ेगा। फिर भी अब बोलिए।
मैंने पहले भी बताया कि जीएसटी काउंसिल जिसमें स्टेट और केंद्र दोनों की भागीदारी है और सभी स्टेट के वित्त मंत्री उसमें सम्मिलित रहते हैं, और जीएसटी पेट्रोल पे डीजल पे लगना है नहीं लगना है ये जीएसटी काउंसिल तय करते हैं, और जीएसटी काउंसिल में इस पे कई बार डिस्कशंस हुए हैं, लेकिन अभी निर्णय पे हम लोग नहीं पहुंच पाए, और जिस दिन काउंसिल निर्णय करेगी भारत सरकार कानून उस पर ला देगी।
What भूमिका है? I am telling you, कानून. You may ask him also, but the point remains. Oh, you think he's giving a different answer? No, I don't mind. Huh? He's not the chairman of the GST Council, sir. He's heading a committee which looks into the compensation cess and उसके ऊपर क्या करना है, और मेंबर भी है हमारे साथ। उनसे ही अगर जवाब चाहिए तो वही जवाब देंगे, कोई परवाह नहीं, बट आई एम जस्ट टेलिंग यू। ऑलराइट,
मैडम है चेयरमैन।
देखिए, जीएसटी काउंसिल एक संवैधानिक संस्था है और एक ऐसा उदाहरण जीएसटी पेश कर रही है कि जहां पर फेडरल स्ट्रक्चर में सभी स्टेट और केंद्र मिल करके निर्णय लेते हैं, और कहीं ना कहीं आप सबको जानकारी प्रसन्नता भी होगी कि सरकार, भारत सरकार सबके राय से जीएसटी काउंसिल, जो काउंसिल में निर्णय होता है, और अभी तक एक दो विषय छोड़ दें तो सभी निर्णय वहां पर सर्वसम्मत से होता है। तो एक बहुत बड़ा उदाहरण है देश के लिए कि प्रदेश और केंद्र दोनों मिल करके निर्णय ले रहे हैं, और जब काउंसिल निर्णय लेगा उसमें सभी मंत्री रहते हैं सभी स्टेट के, तो फिर भारत सरकार उस पर कानून लेगी।
इंट्रोड्यूस कर लीजिए।
अभिषेक पांडे, भारत एक्सप्रेस से। मैडम, मेरा 2 सवाल था। पहला सवाल तो ये था कि कोऑपरेटिव बैंक का जो आपने कहा अंडर इन्वेस्टिगेशन है, चूंकि मुंबई सहित पूरे देश भर में कोऑपरेटिव बैंक्स का एक चलन सा चल पड़ा है, लोगों को नजदीक रहता है काम करने में, लेकिन क्या इससे भरोसा खत्म हो रहा है क्या लोगों का? कोऑपरेटिव बैंक में लोगों को खाता खुलवाना चाहिए कि नहीं खुलवाना चाहिए? दूसरा सवाल यह है कि आपके लगातार प्रयासों के बावजूद भी शेयर मार्केट जिस तरीके से फ्लैक्चुएट कर रहा है, गिर रहा है, क्या मार्केट में इन्वेस्टर्स का भरोसा भारत सरकार पर या उनके वादों पर है या नहीं?
अजय, पहला आपका प्रश्न कोऑपरेटिव सेक्टर के जो बैंक्स हैं उनके बारे में है। आपको ये ध्यान हो कि ये आरबीआई का जो इसमें रेगुलेशन है, पहले वर्षों में पहले नहीं होता था, अब ये आरबीआई के रेगुलेशन में है, और जो भी अपना अकाउंट खोलना चाहता है, आज भी पूरे देश में जो कोऑपरेटिव बैंक हैं वो सुदृढ़ व्यवस्था में है। किसी में अगर कोई कमजोरी आती है तो रेगुलेटर का काम ही होता है कि जिसमें अगर कोई भी कुछ कमजोरी आई है उसके ऊपर रेगुलेटरी एक्शन लिया जाए, लेकिन एक बैंक के एक्शन से पूरे सेक्टर के बारे में निर्णय लेना वो सही नहीं है। विभिन्न राज्यों में विभिन्न कोऑपरेटिव बैंक, विभिन्न स्तर के बैंक बड़ी अच्छी तरह से काम कर रहे हैं, उसके बारे में कहीं पर भी छोटा सा भी संशय नहीं होना चाहिए। इट इज ए वेल रेगुलेटेड सेक्टर नाउ, इस बात को हमें अच्छी तरह से समझना चाहिए। दूसरा प्रश्न कि शेयर मार्केट में ये किसी नीति के ऊपर शेयर मार्केट नहीं चलता है। शेयर मार्केट जो है वहां पर फॉरेन इन्वेस्टमेंट कितना आ रहा है, हमारा डोमेस्टिक इन्वेस्टमेंट क्या आ रहा है, क्या आगे के क्या ग्रोथ की क्या संभावनाएं हैं, उसके बारे में है। और एक सुदृढ़ता आई है कि डोमेस्टिक इन्वेस्टर काफी मात्रा में है, म्यूचुअल फंड काफी मात्रा में है, लेकिन जो देश के बाहर की परिस्थिति है, जो एक अनसर्टेनिटी जिसे कहते हैं, उसके चलते हुए और एक जहां पर होता है कि कुछ वो एक अनसर्टेनिटी के चलते वो जो बड़े मार्केट है वहां पे जाना चाहते हैं, तो ये एक शॉर्ट टर्म का उसका प्रभाव है और ऊपर नीचे होना ये स्वाभाविक है मार्केट में।
सरकार से तो लोग अमूमन ये एक्सपेक्ट करते हैं कि एक स्थायी वॉल की तरह वो खड़े रहेंगे अगर इन्वेस्टर्स चूंकि देश के हैं, तो चूंकि ये मुंबई में है इसलिए ये सवाल था कि चूंकि पिछले 1 महीने से लगातार लाखों करोड़ रुपए मुंबई में जिस तरीके से इन्वेस्टर से गए हैं, तो गवर्नमेंट इसके लिए भी कुछ तरीके के जो शॉर्ट टर्म प्रयास या लॉन्ग टर्म प्रयास कर रही है ताकि इस तरीके की चीजों को, अगर बाहरी दुनिया में अगर कोई दिक्कत हो रही है तो भी देश का शेयर मार्केट सुरक्षित रहे या दिक्कत ना हो, इसको लेकर।
देखिए, इसमें जो मार्केट का रेगुलेशन है वो रेगुलेटर करते हैं और मार्केट सुचारू तौर पे चले कि उसमें कहीं पे कोई परेशानी नहीं आनी चाहिए मार्केट में। जो इन्वेस्टर जाना चाहता है, जब वहां से निकलना चाहता है, सुचारू रूप से हो, उसकी पूरी व्यवस्था है, उसमें कहीं पर भी उसमें कुछ आगे पीछे वहां पर नहीं हुआ है। अब रही बात कि अगर हमें खाली अपने देश के ही स्टॉक मार्केट को नहीं देखना है, आपके सारे इमर्जिंग मार्केट के जो स्टॉक मार्केट है उसके ऊपर भी आप ध्यान दीजिए कि किस मार्केट में बढ़ रहा है। पहले यह था कि अगर जो विकसित देश के मार्केट थे वो नीचे जाते थे तो भारत का मार्केट भी नीचे जाता था, ऊपर जाता था। उसमें बदलाव आया है पूरी तरह से, लेकिन पूरी तरह से डीकपल हो गया है वो भी नहीं होता है। तो ये एक मार्केट बेस्ड है कि जहां पर भारत सरकार को या किसी भी सरकार को कब जरूरत पड़ती है कि वो मार्केट में कहीं कुछ करे, जहां पर कोई मार्केट फेल्योर हो। यहां पर कोई मार्केट फेल्योर की बात नहीं है, मार्केट सुचारू रूप से चल रहा है और उसमें कोई परेशानी की बात नहीं।
Yes, please. Please introduce yourself.
हेलो, मैं लितकेश शर्मा, नवभारत न्यूज़पेपर से। मैम, मेरा ये सवाल था कि महाराष्ट्र के विपक्ष के नेताओं का कहना है कि महाराष्ट्र के लिए बजट में ज़्यादा कुछ नहीं है, ज़्यादा टैक्स कलेक्शन मुंबई से जाता है, महाराष्ट्र का एक मेजर रोल है इकोनॉमिक ग्रोथ में, लेकिन रिटर्न में उन्हें कुछ ज़्यादा नहीं मिला। आप क्या कहना चाहती हैं इस बारे में?
ये एक उदाहरण दूंगी। वधावन पोर्ट का 76,000 करोड़ का डिसीजन किस गवर्नमेंट ने किया? नरेंद्र मोदी जी का गवर्नमेंट ही किया ना। वो एक बड़ा प्रोजेक्ट महाराष्ट्र के लिए, इफ सिंसियरली महाराष्ट्र का पोटेंशियल को समझ करके उस निर्णय लेना है तो दशकों पहले लेते थे, मगर उस निर्णय माननीय नरेंद्र मोदी जी के द्वारा ही हुआ। सो महाराष्ट्र का प्रामुख्यता एज अ बिजनेस एंड इंडस्ट्री फ्रेंडली स्टेट हम कभी भूलते नहीं हैं। और इसके अलावा डिफेंस में, डिफेंस प्रोक्योरमेंट में आत्मनिर्भरता होना है। इसके लिए डिफेंस प्रोडक्शन में जितनी भी इंडस्ट्री एंगेज्ड है उनके साथ हम पॉलिसी के तहत सपोर्ट करते हैं, उनको हर किस्म का फैसिलिटी बनाकर देते हैं। उसके कारण आज भारत देश में एक्सपोर्ट ऑफ डिफेंस इक्विपमेंट और उससे कमाई मोर देन 24,000 करोड़, अभी शायद उससे भी बढ़ा हुआ है तो वो महाराष्ट्र का इंडस्ट्रियल फ्रेंडली और केंद्र सरकार उसके साथ समर्थन करके डिफेंस प्रोडक्शन का अच्छा केंद्र महाराष्ट्र भी बने। ऐसे पॉलिसी के कारण महाराष्ट्र में वो डिफेंस प्रोडक्शन की एक्टिविटी अच्छा हो रही है। तीसरा, आज आप हमारे प्रोग्राम में भी देखे होंगे सेवरल एमएसएमईज इधर केंद्र सरकार की बैंकों के द्वारा, हमारे पॉलिसी के द्वारा, एमएसएमई सेक्टर के पॉलिसी के द्वारा अच्छा उनका लिक्विडिटी और असिस्टेंस क्रेडिट फैसिलिटेशन हो रही है। उसके द्वारा इंडस्ट्री भी बलबूते पर आगे बढ़ रहे हैं। सो महाराष्ट्र का केंद्र स्थान अगर हम इकोनॉमी के वो बढ़ावा देने के लिए पूरे रिकॉग्नाइज करते हैं और हमारी पॉलिसी का बेनिफिट महाराष्ट्र को जरूर मिलता है।
Please introduce it.
Hi, Minister. Archana Shukla from BBC News. Two quick questions. One, what is the kind of impact you are anticipating and assessing because of the US reciprocal tariffs on Indian businesses and on the government's fiscal deficit targets? The second question is, just at a time when the government and the RBI both are stepping forward to support more spending in the domestic economy, how is the government attempting to manage the spillovers of rising inflation because of geopolitical pressures and tariff wars around the globe? Thank you.
Inflation has been well within a certain band, and the last declared numbers have shown that it has come down very close to 4. So inflation has been monitored regularly, both from the supply side and also for the Reserve Bank from the monetary side, and that is one of the reasons I would think the policy would give its written statement, MPC's written statement. But that is one of the reasons why the RBI has chosen to cut the interest rate. This time you heard it after about nearly 4 or 5 years.
साल का एक्सपोजर दिलाने के लिए हम इंटर्नशिप प्रोग्राम ले आए और इसके साथ साथ इस बजट में भी ट्रेनिंग फॉर एआई इसके लिए
Good afternoon and welcome. You're watching India Market Close here on NDTV Profit. Let's quickly look at where the Nifty is at, around 0.5% lower. Just about 0.1%. In fact, we've just come off the day's highs, in fact. So, in that sense, a positive, and the recovery from the bottom also looking quite decent in that sense. So, 22,900 is what we are touching at, and from the lows of the day, we've rebounded nearly 200 points. That's the big positive, at least in trade as we speak. Let's look at the heat map of the Nifty 50 counters, and a good mix in that sense, 25 each on both sides, so largely 1:1 in terms of advanced decline. IndusInd Bank doing well for itself. Adani Enterprises, the other name, shining 2% higher in trade. What's not doing well is an M&M, a Bharti, and a BEL, largely languishing, but no major trend per se. You're largely seeing pharma stocks do well in trade. A Cipla is up, a Sun Pharma is up. So some of those names are standing out in terms of sector. But while we're talking sectors, let's pull up the sectoral heat map as well. Try and zoom in. Well, it's looking like a much better screen than what it has looked like for most part of the day. The Nifty Pharma is up 1.1 odd percent. The Fin Nifty is flat, slight positive bias. And we are seeing largely flattish now even on the Nifty, so we've recovered pretty much fully, and likely and hopefully we'll of course analyze technical indicators, but hopefully we close in the green today. It didn't look likely at all at the start of the day, but clearly we're seeing a good recovery. Nifty IT is down 0.7, so some laggards, and the Nifty Auto as well down 0.9. So those are two pockets where we're seeing a bit of pressure as well. But let's look at the broader markets as well. Let's look at the advanced decline, and let's look at the graph for the entire day. And there you go. So the decline still dominating in that sense, but it's definitely narrowed a bit. But it's been volatile also in that sense. If I can just quickly point out those couple of observations. Let's look at also how the mid cap and the small cap indices are doing. Broader end of the spectrum, also you're seeing a very good recovery, very healthy. So just about a slight negative bias coming in on the mid cap. Small cap index down around 0.5% thereabouts. So that's how it's shaping up, but a recovery across the board nonetheless. So some positive cues coming in that sense. Last off, I want to look at the BSE 500 top gainers, top losers, some big movers in trade today. Look at Godfrey Phillips, look at GSK Pharma, just the traction you're seeing on some names, very, very strong. And equally on the negative side as well, some big moves from something like a La Opala down 11%. But let me bring on board our analysts for the day. We have Himang Jani joining us pretty much immediately. Himang, what are you making of this? Is there some semblance of that fall getting stemmed in your view, and therefore are you going out and buying, or are you waiting? What are you doing at this point?
Yeah, good afternoon. See, there has been volatility in the market for a while, and the sentiment is surely weak, given the onslaught selling that we are seeing by the FIIs, and more so in the broader market. We have seen a fair bit of selling, and there is a sentiment effect which is there. But my feel is that one has to really look at the situation in a little balanced way, and I definitely think that at the index level, be it Nifty or Bank Nifty, a large part of the damage is done and is over. Now, you will see a little bit of volatility, but I don't see a significant downside risk. The mainframe indices per se, and even within the mid cap and the broader market, one should surely be looking out for the companies where the numbers have been good, or where you see initial signs of recovery, and which is backed by good numbers or fundamentals of the company. nobody would know exactly at what point the market will bottom out, but given the sort of damage that we have seen in the broader market and even in the index without any specific internal or external event, I don't think that this is a time far more positive for the market rather than being negative.
So Himang, but I know we can't call an absolute bottom, but a broad sense, do you believe that there is a 10% little bit of more pain expected at the broader end, because that's where a bulk of the pain is? So maybe another 10%, 20% broadly. Could you give us your thoughts on how much you believe that a correction could be warranted from here? Of course, the pendulum swings and it swings the other way and you can't judge it, but broadly, if you were to give us a sense.
See, my understanding is that across the mid cap and the small cap stocks, the damage is about 30 to 60%, right? Now, from current levels, how much more pain will be there is anybody's guess. It could be 5%, it could be 10%, because some of these stocks are illiquid, and on a particular day, if somebody chooses to sell something, the impact could be 10-12% also. But it will be difficult to gauge the timing of that, the extent of that. So I think that if we like the company fundamentally, and if the numbers that the company has delivered, or the management call, which where management has given some sort of outlook on how things are looking like for the next, let's say, couple of quarters, that should be a good reference point for investors to kind of start accumulating the stocks. I'm not suggesting that you just go out and buy them because it has fallen 40%, but it makes sense to start buying and maybe buy 2 or 3 parts. I don't think we need to really focus too much about how much more downside could be there, but focus more on how we could go about taking advantage of such a big fall which has happened in the broader market.
Very interesting. So the take coming in that if you're looking at it bottom up and you're liking the story, go for the story. Whether it's 10% lower from here or 20, could only be an opportunity to buy more. Let me also bring on board Amar Dev Singh, the Senior Vice President of Research at Angel One, to talk to us about technicals. Amar, give us perspective. Firstly, good afternoon. Give us perspective. What's your sense from here on the benchmark? Also on where you expect the Nifty Bank to go, as well as what are the levels to look out for?
Yeah, very good afternoon, and thank you for having me on the show. So I've been very categorical for, I would say, many months now that markets at higher levels wouldn't be able to sustain, and higher levels would be sold into based on if you look at the fundamental factors therein, and also technically, if you look at the markets from an intermediate term perspective, clearly some of the technical indicators were pointing from almost, I would say, November towards the start of November that things going forward would be difficult for the markets. And we've seen that the markets are retesting the recent lows as well. But having said that, 22,700, 22,800 for Nifty is a very important technical and crucial support zone, which I see. Yes, breaching that level consistently, then we could be in for some sharp correction towards 22,000 levels. Because if you look at the market from a longer term perspective on the monthly charts, we've seen some of the technical indicators definitely turn negative, and the intermediate term also very negative right now. But short term, we are seeing some sort of buying happening in, and some sort of bullish divergence emerging on the charts. As far as fundamental factors are concerned, not much of negative flows, except the FII continues to be on the sell side. And now looking at Bank Nifty, what we're seeing is that some of the major banks, be it HDFC, be it Axis, be it I would say ICICI Bank, they are definitely holding on. So Bank Nifty is I would say finding very strong support somewhere around the 48,000 levels. So if I look at the levels to watch out for, 47,800, 48,000, that's a major support zone for Bank Nifty. But again, Bank Nifty On the intermediate term charts, definitely points towards at higher levels, 50,000, 50,500, 600. That's going to be a range. So it's going to be a roughly 2,000, 3,000 point range for Bank Nifty, with the major indicators from the intermediate term trend still being very negative. So we are likely to witness these choppy trading sessions which we've been witnessing. And I would say it would be very early to say that there is a trend change right now. For that, Bank Nifty would have to sustain over the 50,000, 50,500 consistently. Then we could say that. Otherwise, we could witness some choppy trading sessions.
Okay. Amar, let me also get your picks out of the way. Picks for this afternoon.
Yeah, so the first is from the pharma space, and that one is Glenmark Pharma. We've seen the stock correct significantly from almost 1800 levels. Currently, it's around 1370, 1380. We've seen some strong buying coming in at lower levels. So this is one stock one can look at. This is more of a contra trade, because if you look at the intermediate term trend, that continues to remain bearish, but short term we are seeing some sort of pullback. So this is one stock one can look at with a stop loss below 1300 levels and a target of 1525 on the upside. So this is one stock from the pharma space, and the other stock to look at is from the auto space, and that is Ashok Leyland. So Ashok Leyland, what we are seeing is that the stock is finding very strong support at the lower levels of around 200 odd levels. That's a major support zone for the stock from a longer term perspective. If that is breached, then we could witness some very sharp downside move. Otherwise, the stock has a possibility of trading higher. Currently, it's around 220 odd levels. It's up by 3% today. So this is one stock one can look at. Any pullback towards 215, 218 can be a very good buying opportunity, with a target of 247 and a stop loss of 197 on the downside.
Okay, so those are a couple of stocks in focus, but Glenmark Pharma was one of them, and we'll stick with the pharma pack. GSK Pharma has delivered a very solid set in terms of the Q3 numbers. Robust volume growths, and in general, the medicine segment and a continued scale up in vaccine offtake has aided the numbers. Varsha's here to give us a walkthrough on the numbers and give us some perspective. Varsha.
Thank you for that. So yes, so very good numbers when it comes to GSK Pharma, and there's a reason we are seeing the stock is up almost 20%. There was a strong performance across key product portfolios, but the respiratory portfolio achieved robust growth, and the specialty portfolio, if I were to talk about, grew 37% year on year, which is a very good thing. And I think because of the specialty portfolio, the margins, there was a uptick in margins because of the change in product mix, considering specialty having a high margin. The pediatric vaccine stabilized with a growth of 15%, and the net profit growth that you're seeing is one of the reasons is of course the low base. So last year company had an exceptional charge of 163 crores, and this is the reason why we are seeing a huge uptick when it comes to net profit. If I were to talk about the EBITDA margins, the gross margins also increased for the company, and the EBITDA margin increase was led by change in product mix and also the cost efficiencies that the company has shown. If I were to talk about the con call highlights, what stood out in con call, so Nuleka, the two products of the company, one is which is used for the asthma, are the key growth drivers which has led to this fantastic growth that the company has seen, and they are actually anticipating launch of 2 oncology assets in Q1 and Q2 of FY26, which will lead to further growth for the company. And management actually remain optimistic about sustaining double-digit growth that the company has seen. So over the next few quarters, we are going to see the double-digit growth, the continuation of the double-digit growth. Lastly, the emphasis management was emphasizing on the volume-led growth strategy with a strong pipeline of products that is coming in the future quarters.
Interesting. Thank you so much, Varsha, for that perspective. Hemang, let me come straight to you. GSK Pharma, would that be on your list, given the pipeline, given the possibility of cancer drug coming on stream, given the fact that you've got all of these opportunities and very solid numbers? How do you read into it? And if so, and if not, any other stocks which you would keep on your radar from the pharma space?
The space would be in a better spot, given the fact that you would see a bit of a news flow around tariffs and all, but for some of the MNC companies, surely it will be a bit positive. And GSK Pharma in particular because the quarterly numbers are very good and it has a very niche kind of business model. A large part of the revenue is coming from vaccines and related products. And if you see any positive news on the new product pipeline front, surely it will be, viewed positively. And I do think that GSK Pharma offers a great opportunity, though the stock is up sharply, but there will be a good entry point that one can look at over the next few days. And overall, there has been a bit of a volatility in some of the pharma names, whether it's Cipla or Sun Pharma, Dr. Reddy, even some of the API companies like Laurus Labs, Aurobindo, etc., have seen a bit of volatility. I do not think that trade tariff related issues will be materially negative for the pharma space, and the numbers have been by and large good. So, something like a Cipla or Sun Pharma, or even for that matter, Laurus Labs, they do provide a good entry point. Some of the stocks like Cadila have actually corrected quite sharply, almost 25-30%. And very stable business model, not too much of a risk I am perceiving over there. So overall, pharma names is quite positive.
Hemang, thanks so much for that perspective, and thanks so much for joining us this afternoon. We'll let you go on that note, unless you want to stay back, because we've got Rajesh Bhatia, Group President and CFO at Uflex, joining us. And interesting set of numbers, Neeraj, that Uflex delivered. Very strong EBITDA growth, double-digit top-line growth. And Mr. Bhatia, let me actually come to you with regard to my first question. How sustainable are some of these numbers? Double digit on top line and the EBITDA growth really stood out. Can you hold on to those margins, or are there any one-offs there in your view?
So there's no one-off in these margins. And I think as we go forward, we're quite confident that we'll be able to sustain the EBITDA margins. On the growth for the revenue will come in from our new investments, which are getting commissioned, especially our aseptic packaging, where we are increasing the capacity from 7 billion packs a year to 12 billion packs a year, which should come in this quarter itself. So that will set the tone for FY26 and beyond with a higher, production capacity. Even in the current quarter, Q3, that plant we operated at 104% capacity utilization, vis-a-vis 84% in the same period last year. So we've seen a 20% utilization growth on a year-on-year basis in that facility. And any additional capacity that comes on our way, I think we'll be able to utilize it much faster. Over the next couple of years, we'll be able to get to 12 billion packs capacity utilization for sure. The next comes from our PET chips resin facility in Egypt, which is already near completion. The mechanical completion of both the plants is now completed, and we are currently, taking activities to commercialization of these. So these two facilities will add on, give us the revenue growth. Plus the revenue growth will also come from some of the facilities which we had set up as on April 24, which are still to utilize their full potential. And our Poland facility, which is currently operating at a lesser capacity utilization, given that Europe still continues to be affected by the lower demand, as well as an increased exports from India, which is sort of keeping that plant utilization levels at less than 70%. So there is a growth potential from that facility. Otherwise, across everything else, we are looking at, we confident that this momentum will continue for sure.
Understood, Mr. Bhatia. I want to also try and understand how customer growth is playing out here, because if you're going from 7 to 12 in terms of capacity, the ramp up is sharp over the next 2 years. What gives you the comfort that pricing will support that kind of growth in volume, and where will that volume growth get supplied to?
So we are we are very well entrenched in Indian market as well as exports. So from our current facility, we are exporting about 35% of the product and 65% is being sold locally. So as the requirement for the aseptic packaging is increasing, we've also seen huge tax cuts coming in the budget, which will all propel the consumption in the years to come. The last time in 23, when we expanded our capacity from 3.5 billion packs to 7 billion packs, we were sold out in the month one. Even today, if you look at our capacity utilization from our existing facility, which is above 100%, and we know for sure that the kind of orders we are not able to accept both domestic as well as internationally because of our capacity constraints. So that gives us a confidence that, ramping up to 12 billion packs over the 2 years will be sort of a cakewalk. The next capacity expansion for us is going to come at our Egypt plant. So once we've digested this, so that plant is going to have a 12 billion capacity, which is our grand foray in the international markets for this set of for this business segment. And we'll start focusing more on supplying that product in Egyptian market, where currently, there is no facility over there, while the consumption is around 5 to 6 billion packs a year. And from there to other markets in Europe, since Egypt has a duty advantage selling to Europe.
Got it. Mr. Bhatia, good afternoon, Neeraj here. I was looking at the presentation that you guys have given in the month of December on the exchanges. And across global and local BOPET films market as well as BOPP films market, your own presentation seems to suggest that capacity and production is much higher than actual consumption. Would this therefore mean that pricing power will not be there? If anything, volume growth will help you clock in growth, not pricing power.
No, if I tell you about Q3, if I see on a year-on-year basis now, the volume growth is 6.3%, but the value growth is 12.8% on a YOY basis.
Okay.
Which clearly shows that other than the top line growth of 12.8%, is 6.3% comes from the volume growth, and the rest comes from the pricing growth.
How is that is happening? Because I'm just saying, now an inquisitive me is asking this to you. When I look at your presentation, that production as well as capacity is much higher than consumption. Logically speaking, that shouldn't aid pricing power, right?
No, I'm probably missing your point here.
Okay, let me mention that, sir, and please, because this will be important.
This is with reference to the Q2, you are saying?
Yes, the December quarter. In the December quarter, you guys came out with an 82-page presentation. On page number 6, it speaks about how the Indian BOPET films market size from 2017 to 2027, as well as Indian BOPP film size, the capacity even in 2027. Will be much higher than the production, and both capacity and production will be much higher than the consumption. Logically speaking, that would mean that pricing power should not be there, right, sir?
So the way it has panned out is that from India over the last 2 years, which was doing about 44,000 tons a quarter exports of the packaging films, the PET packaging film from India, this figure now stands at about 68,000 tons. So while the capacity addition in India has been there's a natural growth in India also of 8 to 10%, but India has done a lot more in terms of, exporting the product from India. So this has happened for PET, this has happened for BOPP as well. So combined, both put together in the last 2 years, if you ask me, there's been a 52% export volume growth of the packaging films from India, which is given the much better pricing power to the domestic producers in the country.
Okay, in which case, my final question to you, Mr. Bhatia, would be that when I again look at your presentation and I wonder if the things have changed. You cited how from 2020 to 2024, you guys have delivered, a 16% revenue CAGR and a 10% EBITDA CAGR, if I'm not wrong. Are those the kind of numbers that you believe can continue And if so, for what period of time? Or would you better those?
So I'll split this into two periods. One is the normal period and other is the COVID period, especially the FY 2021 and 2022, where the raw material prices were 70% higher than what they were today. And they were demand supply, they were the supply chain issues which led to the extra margins for all the packaging film plays. So if you leave out that particular period on an overall basis, if we are looking at between 14 to 15% of the EBITDA margin across the various segments of a business, I think that's the normalized EBITDA one should look at and plan. And your growth will come from the new capacities that you will add, the new dimensions in the business like you will add. And one such huge dimension that is coming in the way is now recycling, with the support from the legislation in India, where from 1st of April now, in the rigid packaging, there needs to be 30% recycled content. And in the flexible packaging, on an overall basis, there has to be a 10% recycled content which has to be used. So what happens with this is that all the brands are looking for the recycled finished products, and so that in the next few years, when these ramp ups from 30% to 60% and from 10% to 60% gets implemented, you'll set up the recycling facilities which will give you the demand and the top lines, as well as the extra margins, because as a newcomer, we've been master of this recycling and all that. We've been doing that since 90s, and we've mastered the art of as to how the recycling is to be done, and the input output norms and all that, and the quality parameters. So I think the momentum is now going to come from there in the next.
Okay. Mr. Bhatia, we look forward to talking to you post the FY25 annual numbers as well, just to get a sense of what the year ahead might look like, in case you give some guidance, etc. But congratulations on what seems to be a very strong quarter, and all the best for the outlook ahead.
Thank you. Thanks a lot.
That's a confident Uflex, by the way. And by the way, Uflex and Polyplex, both of them came out with decent numbers. It's cooled off from the highs of the day, but still up 3.32%. I wonder if Polyplex is also up in the green. Just pull that stock up. No, not really. Flattish completely. Amar, just very quickly, these packaging film companies, they're small. It's not a very large sector, but any chance you've looked at the charts recently?
I would say Uflex at the current levels looks, I would say, good, because it has witnessed almost a 40% correction, and it's around crucial support zones. But again, on the upside, there's more of resistance somewhere around 540, 550. So more of a trading play, I would say, rather than anything else in this particular stock.
Fair call. Okay, fair call. Thanks for that, Amar. And Amar, just stay on if you can, because we'd love to talk about some other large cap names as well. I'm sure Harsh has spoken a bit, but would love to talk maybe a bit more. Just stay on. We'll take a very quick break. Back with India Market Close.
entire special package and measures are kind of focused on AI skilling and how to sort of facilitate the AI centers which is existing at this point of time.
Now a center of excellence in artificial intelligence for education will be set up with a total outlay of 500 crores.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with.
Welcome back. You're watching India Market Close. Thanks for staying with us. We have Puneet joining us now. M&M was the big story over the weekend, Friday, post-market when the news came out. But stock down 4%. Not so cool, is it, Puneet? Because that's the link or that's the theme of what you're covering.
Well, definitely. This could be one of the key factors. But the electric vehicle launch and whatever the numbers that have followed through, brokerages are keen and positive as well. But I think just comparison with the Thar is something that might be impacting negatively. I think the second probable reason, which might be reciprocal tariffs from the US on India on any kind of imports, specifically of tractors, which M&M does. The OJA platform which they have gets imported in the USA. So I think that could be another factor. But today we are discussing the EV launch and the numbers. The company has mentioned that the booking started on the 14th of Feb. And while it got some love on roughly 30,000 bookings just the first day, I think the expectations was something that was much more ahead of the numbers that have come out. So definitely, the total booking value is roughly about 8,400 odd crores. In terms of what the company has mentioned, between the BE6 as well as the XCV 9e, the split is more towards the premium model, which is the XCV 9e. Roughly about 56% of the bookings have come into this particular aspect, and the top end variant across the board models have come in at 73% of the current bookings. So definitely this will lead to the average selling prices getting increased and will impact margins positively as well. What might be the disappointing factor is, the comparison with the previous launch, which was the Thar. Now, the Thar reported roughly 1.76 lakh units of bookings in just the first hour itself. That was 3 times the company's sale of the Thar model, the 3-door, of 2023. So they had roughly about a 12 to 18 month booking on the first hour itself. In comparison, the EV model has roughly about 6 months of bookings as of now. But I might be nitpicking in this aspect because it's been a very strong number coming in. Comparing it with 1 lakh EV car sales that have happened in FY24, 30% of the market essentially coming to M&M in the first day itself is something which is very commendable in terms of the achievements of the company as well. Apart from that, I just wanted to talk about what Nomura had expected. They are expecting M&M to be the #1 player in terms of revenue market share going into FY26. So that will be going ahead of Tata Motors, which has had a 3 to 4 year head start. So that's a big number according to me. The other one that they mentioned is that the initial dealer feedback on the BE6 model, which is the cheaper variant at 18.9 lakhs, has seen a lot of newer and younger crowd come in. Something that was untapped for something like an M&M. And finally, they mentioned that, with PLI approvals will be, beneficial, as well as the higher local sourcing of components will be a key competitor in terms of pricing with the other models as well, which are directly imported, the likes of Kia as of now. So overall, it's a strong number in terms of EV bookings. I think the tariff play is something that's something to watch out for and putting pressure, because the farm equipment division forms 55% of the total profits currently. But overall, it's a strong launch, but stock under pressure today on the back of, some of the key factors that we just discussed.
Okay, thanks for that, Puneet. for giving us that perspective with regard to M&M. Hemin, let me come to you with regard to this one. What's the sense like on charts? We're now fallen off those highs and well off those highs.
Well, frankly speaking, a lot of relative strength. If you see most of the auto stocks, they've corrected significantly. M&M hasn't. A range between 26-25 on the downside and 322 on the upside. But now things are getting just a bit more dicey. I believe it's getting ready to fall under its own weight because it's stagnated, Harsh. If you see over the last almost 10 months or so, we've not made any headway. So 2625 is crucial. We're still a bit far away, but the setup seems to be taking a knock. I believe we could have seen a probably intermediate peak over here. Things are not looking good. We're midweek, mid-month, but whatever I'm seeing seems to suggest that we're set for a round of correction, which might not end in a jiffy.
Okay. Aditya, let me come to you with regard to a fundamental view. You know, one thing that's, of course, the new launches gaining traction is obviously a positive. But the other thing that stood out for me, and I'm just looking at the document which I'm referring to, it's the Parag Parikh FlexiCap Fund. They've really bought into M&M in a big way in January. December holding was 2% of net assets. January holding is 3% of net assets, 3.11. So they are buying in, and they're buying in quickly. From a fundamental perspective, is this a sign, not just this, but among other things, is this one of those signs that make you positive, if at all, on an M&M?
Mutual fund buying does not have a bearing on our decision per se. But I've been already saying this on the channel for the last 6 months with Neeraj as well, that M&M continues to be my top pick within the auto OEM space. M&M's investment in the tractor space, M&M's investment within the four-wheeler space as well, on the ICE engine as well as on the electric vehicle side is tremendous. They are putting in a lot of money, and the products that they are getting out are tremendously different from what they were over the last 5 to 10 years. You can already see the M&M stock has risen from the COVID levels where it was 1,000 to now about 3,000. So it has already tripled out in the last 4 or 5 years, and the company continues to do exceptionally well. The only reason why the stock is correcting today because I think that the valuations are not cheap, and that's why the stock is correcting per se. But longer term, I'm really positive within the OEM space on M&M, given the diversified nature of the business and the strong leadership and the strong investments that the company is already making across all of its divisions. I think it will still do well from here on. The valuations are a little bit expensive. The stock may undergo a time correction of about 6 to 12 months. However, post that, the stock will continue to do exceptionally well. So it remains the topic.
Okay. All right. So M&M is one of Aditya's top picks. And another one which is shining in trade, and we're going to pivot here, Meghmani. Varsha joining us to tell us what's triggering that massive move on Meghmani Organics.
Yes, thank you for that. So yes, Meghmani is buzzing in trade today. Now this is on the back of anti-dumping duty that the government has put on titanium dioxide, which is imported from China, and this is because Chinese companies were selling this product at such low prices, which were affecting domestic, chemical companies. The titanium dioxide is used in many things, but the duty only applies to the kind of used in paints, coatings, plastics, rubbers, and ink, while the one which is used in food, medicine, cosmetics, and textile is not been affected. The duty will add roughly 40 to 58 rupees per kg to the price of Chinese titanium dioxide. Now, why this is good for Meghmani Organics? Because the company makes this product in India, and the Meghmani's titanium dioxide capacity is at around 16,500 metric tons. The utilization is expected to rise from 30 to 35% to 70 to 75% by FY26, and the realization will increase to rupees 215 per kg, leading to 14 to 15% of EBITDA margin. Currently, please note that this product is under losses. The titanium dioxide business is expected to contribute 40 to 45 crore of EBITDA in FY26, and this is the reason why the stock is buzzing.
Okay. Thanks so much, Varsha, for that perspective. Aditya, let me come to you with regard to this one from the chemical space. Interesting. Is there another play in your mind? I know you always come out and tell us about Deepak Nitrite, but what about Migmoney or any others that you have in mind at this point?
And what about Deepak Nitrite as well, because that's taken a really big knock after the results.
Yes.
Yeah, so let's coming on to make money first. I'm not too positive per se on make money organics. I feel that there are a lot of corporate governance issues per se that come up time and again with the company. So it is best to avoid this company as a whole. That's the first point. Particularly on Deepak Nitrite, I would just say for this temporary class is permanent. Of course, the results this quarter have not been great. No, in our interactions with the management with Malik Mehta, he also says is that the results will not be good in the next quarter as well as the quarter after that. Somewhere in Q2 or Q3 of FY26, the results will improve materially, and that's where the real juice of the stock would then be. The valuations have corrected, and they are now reaching some mouth-watering levels where I would definitely be interested in having a good allocation to Deepak Nitrite person. General view on the chemical space, results have been more misses than positives. On the fluorochemical space, companies like Navin Fluorine or companies like SRF still have gotten off positive results. Gujarat Fluorochem, not so positive and not so good outlook as well per se on that. Companies like Archean Chemicals have had some disastrous results per se. So you need to go company by company and then see it's a heterogeneous space. But I think if you get companies right here, valuations have decently corrected here in this call again, so that you can take opportunity of the long-term stories here. Deepak Nitrite continues to be my lock pick here after the correction that they have really had. Only patient investors should go and invest in this company because next 2 to 3 quarters will not be good for them.
Why would earnings improve, you're saying, in Q2 for Deepak?
What is happening in Deepak Nitrite, there has been a slowdown in the agrochemical space, and the demand slowdown has triggered idling of inventory. So the company expects that to improve not in the next 1 or 2 quarters, but after that in Q2. And in Q2, a lot of capacities of MIBK are going to come up, and those capacities will start to add into the revenues per se. So Deepak Nitrite has invested practically in doubling out their revenues, and those capacities will start to come online from FY26. That's when the real juice of the stock would come and the revenues will start to grow at about 20 to 25%. And FY27, all of these final capacities will start to come online. And over the next 3 years, you will see a doubling out of revenues.
Interesting. Okay. Thanks for that, Aditya. Interesting thoughts there. Now, Hemen, just one, before I get to Anushi, one thing on any of these chemical names and how they stand out or not stand out for you?
I think mostly everything has been, maybe except a Jubilant Engravia, everything has been quite wobbly. And I think you're talking about Deepak Nitrite. Frankly speaking, that was a bit of a surprise because long-term charts were looking good. It made a new high a few months back at 3,000 plus and it's gone completely the other way. So I don't know, is there some fundamental weakness which wasn't apparent earlier, or is going to take some time for this to play out? But yeah, the setup, especially for Deepak, has gone for a toss. 1700 is worst come scenario. Oversold, but the way it's fallen, Neeraj, is going to take time for, like the repair and restore setup is going to take some time to play out actually.
Okay. Quick take, something like a rate gain, down 12%. Is there a view that you have on this one, Hemen?
Downward breakdown from a distribution pattern of a range between 850 on the upside and 650 on the downside. Avoid further pain expected. It's not going to turn in a jiffy.
That was quick. Anyway, so let's go across though. Anushi waiting by for Nomura's view on AFCONs. Very interesting one. Anushi, Take it away.
Right, so Nomura has initiated coverage on Afcon's infra, and this is with a target price of 561. So 30% plus of an upside that we are looking in terms of where the stock price is concerned. We have had a couple of notes for Afcon infra. This involves Jefferies and Investec also in the last month or so. Now what Nomura is saying essentially is about its projects and how they are known to complete this in well within the delivered time that has been given to that. In fact, one of their key projects also, they had received a bonus package for that, for completing it before schedule as well. But even if you look at in terms of where the financial performance is concerned, the company has clocked in a revenue CAGR of 22%. This is over the FY25 to 27 period. This is the expectation, and this would be carried on by the ordering momentum that the company has had maintained. PAT CAGR is expected to clock in a growth of 39% as well over FY25 to 27. Just on a quick note, Q3, if you look at the earnings, they had clocked in a 2.7% of a revenue growth, while margins remain majorly in line at 11 to 12% of a mark, and net profit had seen, however, 36% of a gain. So interesting note from Nomura on Afcons, and this is why the stock is up around 1.5% in trade today.
Okay, so doing okay-ish in an otherwise tough market, at least the broader market. Wasn't looking good since the morning, but this one has in some form or shape held up. Thanks so much for that, Anushi. Before I take a view, actually, Hemen, why don't you give us a view on Afcons first?
Okay, there is obviously a paucity of data, Harsh, frankly speaking. I mean, it's just 3 months, 3.5 months, not enough. Support at sub 420 is in an intermediate downtrend. Otherwise, not much help. Oversold, yeah.
Today, some of the pharma names are doing fairly well for themselves. Ajanta Pharma up 4%, Glenmark up 4 as well, Aurobindo up 3.5, Alchem up 3, Lupin up 3, Zydus Life up 2.5. Any of these names featuring on your list or on your radar, Hemen?
I think Zydus looks interesting because it's had a correction. There has been some resilience of sorts. We've taken support sub 900 second time in the last 3 weeks, oversold. So yeah, I think this is where things could start looking up a bit better. On the other hand, something like a Lupin that you mentioned, Harsh, I mean, we've entered a corrective phase, but if you look at the rest of the market and the quantum of the rise left behind by Lupin, I mean, the correction hasn't been deep. So relative strength, undercurrent looks solid in Lupin from a slightly medium-term point of view, Harsh.
Okay, undercurrent on Lupin looking interesting. Today, a clutch of those pharma names have done well. But while people might be not completely bullish or completely bearish, I think Bank of America Securities Head of Research Amish Shah is unequivocally bearish on markets currently, more so at the broader end of the spectrum. We spoke to him on a variety of issues regarding valuations and numbers. Here are a small slice of that conversation.
I'm sorry to spoil the party, but we definitely are in the bearish camp. Meaning, as you would know, we went negative on the markets back in August last year. And despite the correction, we think Nifty at best is going to return single-digit returns this year. When it comes to mid and small caps, we are still in the camp of them providing negative returns even from these levels. So still more downside.
No, I mean, sometimes you just need, a very clear view. All right, so then what is the positional play over here? I mean, for long-term investors watching this right now, wealth creation opportunities come at bad times. Is this one of them, or there is more to go?
There's more to go. So think of it like this, that single-digit returns for Nifty is equal to you making that from a bond market.
Yeah.
Right? So we all know equities are volatile, equities are risky. If you're going to make a bond kind of a return from an equity, I think you're better off with a bond right now. Fixed income is a better way to do it. And that is as far as the large caps are concerned. And mid and small caps, we argue, will be negative returns. It's best avoided at this point in time.
Amish, morning. So what is leading to this? Because we've seen, okay, let's argue that there are some internals out here in terms of lack of growth in the last couple of quarters. I believe your notes around Q3 as well paint to a low single digit or mid single digit growth. So earnings are definitely a problem. But I would guess that fund flows out of India, maybe into China, maybe into some other markets, are also to be played out here. One question that nobody's been quite able to answer, and I would love to seek your opinion here. What's happening to FI flows? I mean, there is serious outflows. What are client conversations like? What are you telling your clients about where to park the money? And does this money come back at some point of time due to a catalyst, or will we continue to see outflows in the near term?
So Neeraj, for me, this answer is like a pure arithmetic. If you think about it, in the US right now, you can make a 4.5% return risk-free on a US Treasury, right? So that's your US dollar risk-free return. Add to that another 2% of rupee depreciation that is likely this year, over and above 4% that has already happened in terms of rupee depreciation so far. So 4.5 plus 2 takes you to 6.5. That is arguably your rupee risk-free return if you're an FII investor, right? And on that, you will at least expect another 5-6% of equity risk premium because you're taking risk. It's not safe. So you want at least 11 to 12% returns bare minimum for you to be excited about equities. And on the back of what I'm arguing, that even after the market correction, if Nifty is going to give you only a single digit return, that doesn't add up to the 11-12% that we are talking about. And if you're talking about mid caps, we are talking about negative returns versus you can make 11.5% risk free somewhere else. So logically, if you think about it, why should that money be in India? So I think a lot of people look at it very simplistically, that the FII positioning and ownership is at a decadal low, and that is a reason why the FIIs will come back. That's just plainly wrong. FIIs will go where they can find returns. Given that the returns risk equation in India is right now not favorable, they would probably look for other alternatives, and it arguably is US equities or US bonds at this point in time.
Okay. And your argument for a single digit return in Nifty is premised on your earnings expectations and the macro situation for FY26. Could something change that, Amish? I mean, I'm trying to understand, because when I read your note, it's clear. You expecting on the back of not a very great FY25, a fairly moderate FY26, right? And I'm presuming on the back of that, you're expecting single digit returns. What can change that estimate of single digit return for the Nifty? Let's stick with the large caps for the time being.
Sure. So I think, Neeraj, now it is no longer even a debate that India is going through a growth moderation or a cyclical growth slowdown, right? So I think we don't even have to debate that anymore. So logically speaking, anything which is in a down cycle should trade at lower than long-term averages. Arguably, I'm just going by fundamental principles. Nifty, even after the correction, is still trading a shade higher than long-term averages, which basically means that it is very hard to justify a valuation upside or valuation-led upside for Nifty right now. If at all one could argue that valuation should converge to long-term averages and the valuation should continue to come off. In the meantime, your earnings will compound by about 12% in FY26 on a low base of only 5% earnings growth for Nifty in FY25. Right? So basically, some valuation downside, 12% earnings growth upside is possibly your single-digit returns that we are arguing. What could turn, as and when the economic outlook, earnings outlook, starts to inflect back towards growth or higher growth, or possibly when the valuation multiples have come to a level where they start looking attractive and that single-digit returns start to look like mid-teens or higher, then I think obviously the equation turns in favor.
Okay, well, that's a relatively circumspect Bank of America on Indian market prospects. And for now, the market seems to be towing that line, but for the fact that the Nifty has seen a bit of a recovery, led by the Nifty Bank, no doubt, 0.4% higher for the Nifty Bank, and pharma is participating. But I must say, even the small caps have recovered a bit of ground. So in some sense, Himen, it does seem that everybody was talking about the Jan low of 22,830. And if we close below that, it would be a problem. The market seems to have respected that level.
Yes, and it's respected that level third time, frankly speaking, Neeraj, because like you said, 27 Jan, then it was 17th February, and now today. So thrice 22,800 has held. Hopefully, the last time around, Neeraj. And a test of this level next time, it's not going to hold. So is this a saving grace? Is this a respite we've all been waiting for a 2-month, 1,500-point bounce? Maybe it's possible. Deeply oversold, Neeraj. So now it's very clear if 22,800 holds for this week till Friday, it won't remain here, frankly speaking. So if it holds, I think we're looking for a good March and maybe a good half April also in terms of a decent corrective recovery, Neeraj.
Are you looking to add to longs in such a scenario? Let's say BTA, if you had to do a BTST versus STBT, Hemant, is it a BTST today?
BTST on everything.
Well, that can't be the answer. So people have limited capital. Give us one.
Okay. BTST on Nifty.
BTST on Nifty, that's your top call.
BTST on Titan.
Okay. Well, Hemant is rattling off names.
So you can ask him one more follow-up. You'll get more answers. Egg him on, sir. I mean, normally we only get 1 or 2 for BTST. But today if we egg him on, he'll give us 4, 5. I think he's in the mood.
It seems to be Nifty and Titan. Not a banking name, not a pharma name, Titan.
Well, jewelry name. We'll settle with that. Aditya, we'll take your views with regard to markets as well. You've always, or since a while now, you've suggested that a correction ought to happen and will be healthy for markets. You think a deeper correction warranted because on relative valuations, 5-year averages, price to earnings versus current, you're still well ahead and therefore valuation still looking slightly on the higher side because that was always your thesis and hence asking you.
I will now give you a very interesting fact. Zen Technologies was valued at 20,000 crores on a revenue of about 800 crores. And that was the kind of bubble that was there in the market. That bubble is starting to get corrected. Now the valuation is completely halved. And I still think that it is not cheap, even though it can deliver a growth of 30-35%. The valuation is still at 60 times multiple, which is not cheap. What people were doing in the last 1 year was, as the stock prices were moving, they were latching onto the momentum. And as the momentum continued, they kept on buying and then they forgot about valuations. There's this concept of BAR, which is buy at any valuation. It doesn't work either on large cap, it doesn't work either on small cap, and it doesn't work either on mid cap. So particularly, I don't have a view on what the market will do this year because as Warren Buffett says, only 2 people know that. That is, one is God and the other is Gaia. But I definitely know this, that a lot of stocks are starting to offer a lot of value. And if you are a long-term investor, and you were missed out on the COVID fall and you missed out on the subsequent rally, this is the time to get in. This is the time to, in a disciplined way, through an SIP, invest in the market. If you had 100 rupees right now, I will invest minimum 25 rupees, maximum 50 rupees now, and wait for the market, how the market behaves. Try to avoid all the bubble sectors that are there in the market, like the PSU sector or the renewable energy sector, which we used to trade at about 100 times multiple. If you buy at any valuation, the market is going to butcher you out. And we're already seeing with many stocks, for example, Zen Technologies, as you have pointed out today, you will be good to go. We are, as Rakesh Mundwalaji once said to Neeraj, on the bull market from Bombay to Delhi, we just...
Aditya, 3 names which you'll want to buy at this point, very quickly. I have just about 20 seconds.
HDFC Bank and one of them will be HDFC AIMS.
Okay, so thanks so much, Aditya, for those views. Hemant, we'll thank you as well. We'll let you go on that note. Some of those stocks buzzing around. Of course, it's been a day of recovery of sorts. We're closing around 0.1% higher on the Nifty. Let's look at it intraday as well. We're likely at the day's high. There you go. 22,974. That's where we are at. So all good trends, frankly speaking. It's getting better as the day has progressed. So that's one. Let's look at the heat map on the Nifty. Try and see how the breadth's improving. Oh, dramatic improvement with regard to breadth. Some of the larger heavyweights starting to participate also a wee bit. And just the breadth of the market looking better in itself is aiding the indices higher. well, decentish in terms of moves, but that 1.4% move by HDFC Bank, 4% up on Adani Enterprises, those are some big moves in relative terms. Let's look at HDFC Bank's move intraday. I'm curious to know how that move has played out because surely doing very, very well. There you go. It's definitely aided the index, I'm sure. Let's look at the contributors as well. No spikes though that we can see on the graph. Contributors, there you go. It's essentially HDFC Bank which has taken the market higher, at least in trade today. Reliance also doing fairly well for itself. Bajaj Finserv has done very well. Power Grid also 2% plus higher. Those are some names for you which have done well. But let's look at the sectoral heat map as well. Try and zoom in. The Fin Nifty, of course, even this particular graph has changed quite dramatically, even in the last hour and a half. So looking up, 1.2% higher on the pharma index. The metals index also doing fairly well for itself, up nearly 1%. PSU banking names starting to show a bit of shine, 0.7% higher. You're seeing good traction in the banking index as well, 0.4 odd percent. So across the board, you're seeing a bit of green starting to show up. IT and auto are two other places where there's some bit of pain. The small cap and mid cap indices also not doing too badly for themselves. Let's pull them up. There's been plenty of pain, mind you. Last week we've seen a 7% correction on this index, now up around 0.5%. So clearly positive, closing at the day's high. The small cap index also around 0.1% higher. This one has corrected 10% over the last week. Also curious to see how the realty index has performed intraday, because that one was the top loser last week, again down 10%, and the Nifty Realty closing largely flat, just a mild positive bias, but I believe that we'll take it because just because of the manner in which last week has gone. But that's the key positive as well. Last off, I want to look at the advanced decline all through the day, how the breadth has possibly improved, and it has. We've closed definitely better than how we had opened, as well as most of the day how we've done. So that's the other positive. Quickly on to some big movers. Let's pull up the BSE 500 top gainers, top losers. Not exactly reflective of the big movers because there have been some really big moves. But pharma was one space in focus, and you'll see some pharma stocks there. GSK, Piramal, all of those were buzzing in trade. Manappuram on the back of possible promoter change also coming into play. You're seeing good traction on some of those counters. What's not done well, Ala Opala has slipped further in the last hour or so, and RVNL on the back of numbers. And those are just some big movers along with the data patterns and a Tanla which were under pressure today. But with that, from Neeraj, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.
regime for individual. In fact, there has been discussion on how to sort of reduce the tax rate.
I am now happy to announce that there will be no income tax payable up to income of 12 lakh rupees.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
This entire special package and measures are kind of focused on AI skilling and how to sort of facilitate the AI centers which is existing at this point of time.
Now a center of excellence in artificial intelligence for education will be set up with a total outlay of 500 crores.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Hello and welcome. You're watching KYC, which is Know Your Company. It's a show designed to give the regular investor powerful, actionable insights into fundamentals of single NSE listed companies every day. So we're going to bring you today Aadhar Housing Finance. It's of course, as the name suggests, a housing financier. It's one of the largest private housing financiers in the small mid-cap kind of space. Has around 18,000 crore in terms of market cap, does mortgage related loans and products. It also has a presence largely in 20 plus states. It gives loans for residential property purchase as well as construction. It also does home improvement and extension loans. Of course, all of this is secured and all of this is in the retail category. Just quickly rolling forward, loans for commercial property and construction as well as acquisition. So it does those as well, but a smaller quantum, and it's largely focused on low income housing. Sub 15 lakhs is the loan ticket size which they generally give out. Their average ticket size per customer is 10 lakh rupees. So really, really small in terms of loan size. 74% of its loans are to retail and retail home loans, and 26% is other mortgage loans, but again backed by housing and largely retail. Now, in terms of just the trajectory, in terms of scale, 21 states that it currently covers. It has branches across these 21 states, and the number of branches at the end of Q3 is 557. So it's a wide branch network that it has. Also growing at a healthy clip, that number. So something to look out for in terms of growth as well. But quickly on to parameters, and we discuss these every day, and depending on the type of company we break down parameters. But this one is a housing financier, NBFC, so these are the parameters we look at. We look at the income statement, how quickly that has grown, the balance sheet, how well and how adequate is its capital adequacy ratio, as well as what kind of growth clip does it have on the AUM? Operational metrics, this is key generally for housing financiers and NBFCs because it determines, and we try to break down what the spread is, what the margin is, what the yields are like, and what's the kind of ROA that the company clocks. ROA is return on assets and it's a measure of profitability. So how profitable and how consistently profitable is the company? That's something we look out for. Among others, we look at shareholding, street cred, street coverage, as well as valuations, all relevant metrics to look for when you're looking at a company and when you're analyzing it. Of course, over the next 20 odd minutes, we'll break this down as well as speak with management. We'll also talk a little bit about risks because that's a key, right? When you're looking at any company from a bottom-up perspective, you want to look at what the risks also are. Let's quickly look at the income statement though, and let's pull that up and let's break it down. Your net interest income has gone up at 28% CAGR over the last 3 years. Provisions down 9%, very healthy because despite a faster clip, growth clip that the company is clocking, you've not seen provisions go up. In fact, it's come down. But mind you, 3 years back was a slightly higher base as well. Profit after tax growing at a very healthy 30% YOY. So you look at those two numbers and it starts to show it's quite stable in that sense. Both of those numbers, 28% on NII and 30% on profit after tax. So those are two metrics, clearly a thumbs up given the kind of growth clip that this one is growing at. Let's look at the balance sheet now. Let's break that one down. You look at AUM growth, extremely healthy. You're looking at a 19% kind of AUM CAGR over the 3 years and 9 months that we're looking at it from 14,000 or sub 15,000 crore. It's gone up to nearly 24,000 crore in just about 2 years and 9 months. So 2 years and 3 quarters. And likely that growth clip will sustain, but it's something that you'll want to ask and quiz management. But look at the borrowing number. Generally, when you're looking at a fast growing company, you'd want the borrowing number also to go up commensurately, and that's exactly what's happened. It's gone up from 8,000 or sub 8,900 crore to 15,000 crore, but it's done its IPO, it's listed. Capital adequacy therefore is extremely healthy and continues to remain so. Historically, this company has had a capital adequacy of anything between 35 to 45%, and that seems to continue even in the post-listing era of the company, and that's one key positive you'll want to look out for. And therefore, what this will typically do is a large part of the lending that they do is funded through equity. I'd want to understand, and we'll have the management again, whether that will continue or whether they will do more leverage and more borrowing, because that will add to the profitability metrics as well. So I'd want to look out for that one. The 19% AUM growth is significantly positive, and the CRAR, how does it evolve, is something I'll want to look at. When does the next equity raise actually come? Now, we're looking at operational metrics now, and balance sheet, just to kind of cap off the point, is a neutral, because I'd want to look at those couple of metrics as to how quickly or how much is the company willing to borrow, or will they have capital adequacy between 35 to 45% from a conservative standpoint, and therefore will not take on leverage. That's something I'll want to really quiz the management on. But let's look at yields now. Yields have largely been in the 13 to 14% kind of mark. That's the kind of yield number that we have. You look at the cost of borrowing. The cost of borrowing has gone up from 7% in FY22 to 8.1% in 9-month FY25. This is also because we've seen the rate cycle change, and therefore you've seen cost of borrowings go up. Spreads though have been extremely flat. You've seen the spread anything between 6 to 5.8%. The management has always guided that they'll continue to aspire for this kind of a spread, and spread won't decline meaningfully. Margins are at 9.2%, and we're not flagging that off simply because of what I described in the balance sheet. It's very, very large amount of equity which is what is funding the balance sheet at this point. if that unwind were to happen just to give you clarity, 24,000 crore is the AUM. The borrowing number is just about 15,000 crore. So you've got 9,000 crore of equity, which is funding the AUM alone. Now, it's not very common for NBFCs or financial lenders to have that kind of a leverage ratio. It's very, very low, and therefore the risk is very, very low, but also it kind of keeps a lid with regard to returns, and therefore that's something I'd want to look at, and therefore that neutral rating there as well. But cost to income, this also has been fairly decent. The FY22 cost to income was 36.3%, 37.5% in FY24. In FY25, there's a correction here, 35.9% is the current cost to income ratio. So it's the lowest in the last 3 years, the cost to income, and I'd want to know whether that has scope to shrink further or not. Definitely a thumbs up on this metric. You look at ROAs last off, just to kind of cap it off, they've gone up from 3.2% to 4.3%. So ROAs have just gotten better as the years have gone by. Can ROAs hold up will also be the other question, but otherwise operational metrics largely positive in my mind. Let's talk about asset quality. Your NPA ratios, when you're looking at those, largely stable, right? Last at least 4 to 5 quarters, they've largely been range bound. Even your net NPA, largely range bound, anything between 0.9 to 1. And two things which stand out for me when you're looking at asset quality. One is your loan to value ratio. What does loan to value actually mean? It means that the loans that you're disbursing, right, as the ratio suggests, the loans that you're disbursing to the value of the asset, because it's a 100% secured loan, the value of the asset that you have. So say for example, you have an asset of 100, you've disbursed a loan of only 59. That's what this indicates, and therefore looks very, very comfortable, because in case of a default, I mean, there may be individual loans with different LTVs, but largely with a 59% LTV, the book looks robust, because in case of a default, if you need to recover 59 from a 100 rupee asset, that's very easy to do, and that's what this essentially indicates. So you may want to look out for that as one of those. And second is, it's a 100% secured book, so your loan to value largely indicates the safety net that the company has to try and recover in case of defaults, and that's what gives me comfort to give this a big thumbs up, because it's a 100% secured book and your loan to value ratio is just about 59%. I want to also zoom in on the shareholding pattern. Now, while I've given this a thumbs up, the shareholding pattern, it's because 75% is promoter held. I'd be very curious to know whether the promoter is looking to dilute at any point in time. Mind you, it's a recently listed company, and therefore promoter holding of 75+% is not too common. And even where in NBFCs you have these large promoter holdings, you will somewhere start to see the promoter dilute, because eventually the RBI does want more and more free float holding, as they call it. I mean, in banks, of course, it's capped, but in NBFCs, there is no cap. But at the same time, you would want to try and understand as to whether the promoter holding is going to come off or not. And we will ask the promoters that when we speak with the management today. I want to also talk about street cred. I've given this a positive nonetheless, the shareholding. But let's talk about street cred. Now, this is one metric where the 3-month performance hasn't been great, but when you're looking at the 3-month performance on the Nifty mid cap and small cap, this one has sharply outperformed, and therefore very tempted to give this a thumbs up on this metric as well. 25% from listing, so those investors who have held on to the stock even or who got the stock in IPO, who have held on to the stock since the day of the listing, have made decent money. They've left money on the table for some of those investors, which is a positive. So all of those metrics point well in terms of the direction in which the stock is expected to be at. You're looking at street coverage. 7 analysts track the stock, and there are some marquee analysts here. There's a Citi, there's a Nomura, there's an Investec. Some of them have given it very, very strong upsides, but the average upside is 41% on this one. In a falling market, it's interesting whether this will start to see downgrades. Well, we've not yet seen it, but you want to keep your eye out on that. But a 41% upside as of now clearly warrants a thumbs up on this count as well. Last off, with regard to valuations, and it's not looking very, very expensive either. You look at an Aptus, you look at a Home First as well. I mean, I don't have the Bloomberg price to book on Home First, unfortunately, because there isn't enough coverage, but it trades at above 3 times price to book, largely. Home First Finance, Aptus Value, there's also an Avas. PNB Housing is one of those where there's a turnaround at play, but at the same time, that one, because of the turnaround and because of the risk, is valued at 1.1 times. Aadhar, for a 4+% ROA business, to value it at 2.3 times seems very, very fair in that sense. So valuations don't seem egregious in any fashion, and they seem okay. And therefore, you're seeing a 2.3 times price to book on this one. But that's broadly the picture with regard to the company. And just a couple of things I want to highlight here before we move on. Of course, there are risks that each company comes with when we invest. And while we have a 7.5, which is a record rating on our KYC, very little wrong that this one is doing at this point, basis the numbers that we're looking at. But I want to highlight a few risks. One, can the scale up of the business continue? That's one thing, and that's one risk that you'd want to bear in mind. There's rising competition in housing finance. You have, it's a decent margin product, it's a secured product, unsecured is facing headwinds, and therefore you might well see that there is plenty of competition pressure which is there. And any kind of asset quality deterioration may also be a bit of a dampener. Other risks, of course, we spoke about, could be promoter dilution. There is also one key piece which we've not spoken about, that self-employed is rising as a share of the business. I'd want to know whether self-employed will come with its set of risks and those risks are getting priced in separately, or is there enough comfort on the asset quality standpoint even from self-employed? So those are some questions that I'll want to ask and quiz Mr. Rishi Anand on. But let me quickly welcome him on board. He is with us. Thank you, Mr. Anand, for coming, speaking with us live this morning. Always good having an understanding housing from or housing finance from your perspective. So I want to first understand, and this is more focused on Aadhar housing, as you would have gathered if you're watching us. So I want to first understand what the growth clip is likely to be and what the levers for that growth clip are for the next maybe 2 to 3 years. From an investor standpoint, what should he expect from you?
First thing first, very good morning, Harsh. It's
good
always a pleasure to interact with you and good to see you. Okay, so first you asked about the growth levers. Let me give you some indicative numbers, and we've always guided these numbers. I will stick to those numbers. AUM growth 22 to 24% as we head towards the financial year closing. Disbursement growth would be about 20 to 22%, which will ultimately tantamount to about 20%, 22% growth in profit after tax. How do we get this growth? What are the levers? There are multiple levers, right from multiple government initiatives which start from PMAY 2.0 interest subsidy scheme to Swami scheme that just got announced, Swami 2.0, tax benefit that has just come in up to 12 lakhs, which will enhance the loan amount by 3 to 4 lakh rupees for each individual. Then more importantly, the mortgage guarantee fund that has been announced pre-budget, which caters to the EWS LIG segment. So that's from the government initiative perspective. From Aadhaar perspective, individually, we are looking at expanding our network. As you would remember, we've already added about 60 branches this financial year, and we will continue with this trend over the next 2 to 3 years. 60 to 75 branches will keep adding. In terms of states, we are already in all possible states. We are already in 21 states. So what we are currently doing is expanding our network into deeper locations, into small talukas and small district centers. That's what we are doing, Harsh.
Understood. And so what allows you, or what gives you the comfort that as you grow deeper, there's not going to be any impact on asset quality?
Harsh, going deeper is a part of our overall strategy. See, what is happening is the larger cities, the top 100 cities of the country, because of inflation, because of rise in cost of construction, because of certain bit of competition, there are two things that are happening in larger locations. The ticket size is going northwards because of inflation, as I said, but your yields, incremental yields in large locations are dropping. I will not say substantially, but they are dropping. To counter that effect, what we are doing is we are going deeper, where you get ticket size which is half of what I do at a regular large location. So I get a 5.5 lakh kind of ticket size from deeper impact locations, and I get 300 bips higher yields. So at the company level, I am able to balance out. On one end you have yields dropping and ticket size increasing. On the other end, you have ticket size dropping and yields increasing. So at the company level, we are still at a 10 lakh kind of ticket size and about 13.8, 13.9 incremental yields. You touched upon the asset quality. We've been in deeper locations. We have about 140 branches up and running, and we don't see any trends of our the consumers going bad.
Okay. So, is there risk from competition? Is that something you're visibly seeing?
Okay, before I come to competition, maybe I can just add a little bit more on the asset quality in the deeper impact locations. What happens, Harsh, is, and you'll have to relate to what I say, is, and I've always said, and I've met you 3-4 times, and I've made this statement that the consumers I lend to, the emotional attachment to the asset is very, very high. I think that plays out when we go deeper. It plays out more deeper. This consumer is going to make only one house in his lifetime, so the emotional quotient is very high, and hence, while you would see a little more bounce, because it is the banking habits are still to develop in deeper impact locations. But when it eventually comes to consumer becoming NPA and we going surfacey and using legal tools, that's where the consumer gives up and tends to pay up. So that plays a very important role. On competition, the good part is, and while I'm sure the industry is talking about a lot of large players coming into affordable segment, but the way it has transited over the last 6-7 years, Harsh, is within affordable, which is described as loan amount up to 35 lakhs. Within that affordable segment, there are two clear distinctions. One is companies which operate in average ticket size about 15 to 20 lakh, upward of 15 lakhs, about 20 to 22 lakhs. And these are companies like PNB Housing Finance, ICICI Home Finance, the entry of Bajaj or entry of Godrej, etc. And then there are these companies like us who operate in average ticket size below 15 lakhs. As I said, my ticket size happens to be only 10 lakhs. We are not seeing any traction happening on the segment that we operate, which is called as low income housing. So whatever traction is coming in the affordable segment.
Okay. So on your income statement, if I were to just break down your income statement and balance sheet together, your capital adequacy is at 46%. This is likely to come down as you continue to grow. My understanding is you will take on more debt. Please give us a perspective on what the plans for the next 3 years are, because you have enough bandwidth to continue to scale without doing an equity raise. And that will also mean that your ROA shrink because your interest expense will start to creep upwards. Just talk us through what the journey will likely be like.
Great. So first thing first, let me give you a little flavor of our current borrowings. Today, our AUM stands at about 24,000 crores, Harsh. And if I were to remove the direct assignment and the co-lending that we've done, which is approximately about 4,000 crores. So my loan book today stands at 20,000 crores. And my borrowing is at 15,000 crores. So my equity utilization is only equity and profit plowback is about 6,000 crores. Maybe I'll give you a little other flavor of looking at car and income level and debt is leverage. Today, we operate at a leverage about 3%. And the way we look at Aadhar Housing Finance couple of years down the line, we will look at a maximum leverage of 4%. And I'll give you what is the logic of 4%. Most of the rating agencies become a little uncomfortable the moment the leverage reaches anywhere between 4 to 4.5. And since we are very well capitalized, I think that's the leverage levels we will be in. We will try and maintain it below 4 levels.
Okay, so what does that indicate in terms of runway? When is the next equity raise expected given a 22 to 24% AUM growth clip?
I don't foresee, at least in the near future, 2 to 3 years time frame, any equity raise is required by the company. And we, in discussion with the current promoters, I don't think we are going to be doing that.
Understood. And therefore, how will the added borrowing on your balance sheet impact your ROA is what I'll be very keen to understand.
See, we are currently operating at about 4.4% ROA.
Yes.
The way we look at our business for the next 2 to 3 years, Harsh, is the same range, 4 to 4.3 is the ROA we will be maintaining.
Okay. And so therefore, where will you lever? What lever will you use to maintain that ROA given that interest expense will start to climb? Just given the fact that you'll be growing borrowing, there's no other reason for, there's no cost of borrowing increase per se, but what is that lever therefore that you'll use?
The cost of borrowing, Harsh, is obviously the way the markets are today, and you've just seen a cut happening by the central bank. While when we borrow in this 15,000 crores, etc., it comes on either a repo rate or MCLR link. A repo rate, which is about 12% of my total borrowing, gets impacted immediately. And we foresee MCLR benefits also coming in the near future. I think where we are going to leverage is our OPEX reduction with all the technology investments that we've done over a period of time. Efficiencies and productivity levels are going to creep in as we move ahead in the next couple of years.
So therefore, where should your cost?
It's going to be OPEX.
Understood. So where should your cost to income lie therefore, sir? And what should the journey be? 1 year, 2 years, 3 years? What's the thought?
Cost of income today, we operate, Harsh, at about 36%. And
Correct.
we've always guided that a reduction of a percentage, 100 bips year on year for the next 3 years is what we're looking at. So 3 years down the line, we should be at a cost to income about 33.5%.
Understood. And sir, with regard to promoter holding, will it continue to be at this 75% plus kind of level? Will it come off significantly, or will you see minor dilution start to come?
I have, and I'm smiling on that question because I have already answered that question on your platform earlier, and I will stick to that. See what the way it is panned out. See, ultimately, it's a private equity investment which has to die down over a period of time. Having said that, the fund from where Blackstone is currently invested, the fund life is till 2030. So we have good 6 years balance in the balance life of the fund. So I don't, and we are not seeing the promoters being in any haste or in any discussion of diluting the current shareholding, which is at about 75%.
Okay, point noted. So last question, and if you can keep your answer maybe less than a minute, because that's what I've been flagged for. What are the risks in your opinion here?
Harsh, we see two types of risks in our business on a BAU daily basis. One is, and both are related to the word attrition. One is book attrition, which is BT out, and one is employee attrition, which was on a rise till about 6 months back, and we see it plateauing out today. So both attritions are the risk to the business. Having said that, we are today at about 6.2% BT out, and the endeavor is to bring it back to about 5.5%, which is a comfortable range.
Okay, thank you so much, Mr. Anand. Always great chatting, candid conversation, and thank you for answering all the questions, including the little tricky ones. But thanks for coming in and speaking with us.
Thank you, Harsh. Have a good day.
Thank you, you too, sir. Anyway, so that's of course the management of Aadhar Housing. Interesting one. It's a record with regard to the rating as well. But more importantly, the risks are to be well kept in mind. So do look at all of it properly. But with it, we hope that we've covered all the bases. With it, out of time on this edition of KYC. Stay tuned to NDTV Profit. More action on the other side.
entire special package and measures are kind of focused on AI skilling and how to sort of facilitate the AI centers which is existing at this point of time.
Now a center of excellence in artificial intelligence for education will be set up with a total outlay of 500 crores.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in?
Hi, we're talking about Your Money Matters on NDTV Profit because we understand that your money matters. My name is Alex Matthew. Today is a very special conversation. Every Monday we do what is called Money Monday, where we invite one of you into our studios to speak about your financial goals. And we also get a financial planner to join in to help you plan for them. The idea is that we help one of you, and through your discussion with a financial expert, we hope to address the issues that a lot of you watching this at home might also have. Sandeep Rao is joining in today. He's an IT professional and living in Bengaluru. We're going to talk about his financial goals. And to help him with those goals, I've got in studio with me Nisreen Mamaji, who's the founder and chief executive officer of MoneyWorks. Thank you so much to the both of you for taking the time. Sandeep, meet Nisreen. Nisreen, meet Sandeep.
Hello.
So, Sandeep, let me first have a snapshot of your financials that you've shared with us. You have, and correct me if any of these factors is wrong, you've got a cumulative income between yourself and your wife, who is also an IT professional, of 2.6 lakh a month. Your cumulative expenses are around 85,000 rupees. And so your savings are to the extent of about 1.8 lakh. In fact, 1.5 or thereabouts is what you can do on a monthly basis. Is that right?
Yes.
Yeah. And currently you've got direct stocks that you've invested in, and you've got mutual funds that you've invested in, and you've split them, I think, evenly. You've got direct stocks of a little over 1 crore of rupees, and you've got mutual funds of about 1.15 crore. You've also got a PMS that you're investing in. Is that right? 50 lakhs?
Yes, correct.
Okay.
Correct.
And you've got the rest in real estate, about 70 lakh rupees, and gold, which is jewelry, coins, and SGB of about 70 lakh rupees, and a total of about 4.96, nearly 5 crore. That's right?
Yes.
Okay.
Yes.
So why don't you take me through your primary financial goal? Of course, the bigger ones are retirement and saving for your child's education, but you also got a plan to buy a car. Tell me about that.
Yeah, sure. So my current car is a little above 10 years. So I want to change it when it is 15 years so that I don't have to go on with a revalidation and all. So I want to probably at that time I would want to buy a electric car, which in today's terms would be about 20 to 25 lakhs. So I'm expecting it to be less than 30 lakhs in about 4 years. So I want to do financial planning so that I can buy it without taking any loan at that point.
Sure. So congratulations, Sandeep. In fact, I was pretty much impressed with your planning. I think you and Krupa have been, very frugal in your expenses, and you're earning also pretty well. Obviously, because you belong to this industry, and I was quite impressed with the way that you've planned out all your goals and also the detailed, analysis that you have done as far as your goal planning is concerned. As far as your car is, concerned, I think that you can definitely get your car. I think you're planning to have that in the next couple of years in 2029. And from Krupa's cash flow, you can definitely look at the car. In 2029, I think it's about 27 or 30 lakh rupees. So between the two of you, you have detailed the investments as well as the goal planning. So you can I have combined the entire assets, yours and Krupa's, and I worked out a cash flow per year. Now in 2029, you can definitely go ahead with the from the corpus that you have, because you have various assets. Okay, you have lump sums, you have SIPs. Also, you have your PPF and EPF where you are putting in a monthly amount. Okay, EPF you're putting in about 24,000 rupees, and your SIPs are also there between you and Krupa. Now, since you have already taken the lead and mentioned that these are the assets from which you would like to purchase your car, these are the assets from which you would like to work on your son's education from Krupa's, and the retirement we have worked out from yours. So yes, from the combined assets, you can use any of the cash flows from the mutual funds, which is your lump sum and your SIP, and you will be able to withdraw that certain amount for your car in 2029.
Okay, so that's the straightforward answer to the question that you had, Sandeep, but we've got much more to discuss, right? Because I am curious about the investments that you've made. Did you have certain base assumptions on how much you will need? You're now in your early 40s. Did you have a base case assumption as to how long you'd like to work for? You don't have dependent parents, so you have just one dependent. Have you thought of how much you need to set aside for your retirement?
Yes. So what I've done is I've went with the current expenses, which I consider that, okay, I might not have some of the expenses. So I've brought it down to about 70,000 in the current value. And then I've extrapolated what would be the future amount that I would require. So I've put in inflation numbers of about 8%, slightly higher than 6% what we have, because I'm considering the lifestyle inflation, which would be typically slightly higher. And at that point in time, probably will need more of a medical expenses. So inflation, I've calculated it a little higher. So then I've calculated based on that. So I've brought it in what would be the current amount which I would need at my retirement time, wherein I can roughly take out 3% of my corpus as the withdrawal rate annually. So that is how I've done the calculation.
And what is the value that you came up with?
It's about 1.35 crores.
Okay. Is that appropriate, do you think?
So basically what, Sandeep, my advice to you is that your current expenses are around, say, about 75,000 rupees. You're planning to retire at age 52, which is about 10 years hence. In that case, your current expenses and your lifestyle, minus, obviously your son's education, because that's a separate entity completely. So your home running and, the expenses that you want to do as far as transportation, utilities, and, salaries of staff, etc., would be approximately, if you inflate it at 8%, as you have rightly said, that you're inflating it on a higher level, it would be around 150,000 rupees. So on an annual consumption, it would be 18 lakh rupees. Okay. You've also been concerned about keeping on a health corpus, which was a very smart thing to do. So we've budgeted on, say, maybe 1 lakh a year for the next 20 years for maybe any kind of expenses. Obviously, you won't be taking it every year, because God willing, you won't have any kind of health situation on an annual basis. But that's the kind of liquidity that will be provided to you through the planning. You can assume that. And also, you've mentioned your holiday.
Okay, you want to spell that out, Nisreen, because you're talking about him setting aside 1 lakh rupees every year.
No, withdrawing.
Withdrawing.
Yeah, setting aside.
Explain that.
Yeah, sure. So basically, since you have a lump sum corpus, now we're looking at the withdrawals from your age of 52, which is in 2035.
And what is the base case assumption for? So what he's doing right now is saving about 1.5 lakh every month, right?
No, he's saving higher.
So he's saving, okay, 1.7. Yeah. So clarify this for me, Sandeep. You're saving about 1.7, 1.8 lakh rupees per month?
Yeah, roughly around that. So again, it is not the same amount every month, right? So it fluctuates. So we have this quarterly variable and things like that, right? So I would roughly put it about 1.5 to 1.6 lakh on an average.
Okay. So 1.5 to 1.6 lakh per month. What have you assumed in terms of his corpus over the next 10 years, where does it reach? And then from there, if you can talk
Sure.
about the withdrawals.
So yeah, that's a very interesting point that Alex has raised, because that's the crux of the matter. So Sandeep, SIP is about 87,500 rupees. Okay, this is including the EPF that you're putting in, about 24,000 rupees. Your current value is about 2.35 of all your investments, okay, which is your current corpus, including the direct equity, your PPF, EPF, NPS, your lump sums, and your PMS as well. Now, if we forecast that, if you future value that to your 7 years later, because 2032 is when the first installment for your son's education comes up. So we'll start with 2032, which is 7 years hence. At that point of time, your corpus personally will be about 5.7 crores, okay? So Krupa's I'll discuss later, but this is where you start off with, including the future value at 9%, okay? So we've worked out a couple of scenarios for you, just to give you an idea of, when do you run out of the money. So since you have rightly obviously suggested 9% as your compounded annualized growth rate and inflation at 8%, so this is the corpus that you will start with in 2032. Now that's the time I think that you want to buy your home, right? Right. So.
And what have you budgeted for, Sandeep?
I've budgeted at about 1.5 crores currently, so it may go a little higher again depending on my cash flows at that point in time.
Sure. So what you can do is, you've also indicated that you would like to use the HDFC Balance Advantage Fund, and you have 2 properties which will be worth 1.1 crore at that time. So you will be withdrawing about approximately 48.5 crores from the HDFC BAF, and the balance you will be selling those 2 properties that you have, the sites, and you will fund that for the property in 2033. So that's entirely possible, and you're good to go with that. In 2034, also you have another installment of, your retirement starts from 2035. So as far as you are concerned, you are funding the property, and Krupa is funding the child's education. So she starts in 2032. And you have also indicated, what your future value will be. So, you've said possibly it's going to be 20 lakhs, 15 lakhs, 15 lakhs starting from 32 to 35. And if there is a shortfall, you're going to be taking an education loan, because currently, you're not exactly sure what the education will be, but you've said the future value will be so many, installments, which we are going to be using from Krupa's portfolio. Now, she's starting with the future value in 2029 for about of 2 crores, okay? So the first, obviously, installment will be going towards the education, 4 years, 20 lakhs in 2032, and 15 lakhs from 33 to 35, okay, to 36. So there you are planning the undergraduate and possibly the postgraduate education. After that, you are also planning his marriage, which the future value will be about 47 lakh rupees. So that again, we have used that because you have indicated that you would like to use it from Krupa's portfolio itself. Okay, anything that you want to add over here? Because I'm just continuing with the cash flow.
There's a
lot of
a,
information.
There's a lot of numbers, Sandeep, that you've just been subjected to.
Yes.
And see, the bottom line that appears to me is that you've actually done all of the right things so far. You've ticked all of the boxes. So let's get into the brass tacks of it. What are the questions that you have? Because you have certain questions, as I understand it, about the mutual fund investments that you've made and about the direct stocks that you've invested in. Because as I understand it, you pointed out that you've only got a single-digit CAGR return over the last several years in your stocks. So you're wondering whether to switch that out into the mutual fund space. And the other thing that I'm curious about, and that I want Nisreen to comment on, is that you have 2 properties, as I understand it, that are valued at 70 lakh rupees, and you expect it to go to 1.1 crore in the next several years. My only concern, and something that I have seen happen, is the inability to very quickly liquidate real estate. So do you have a backup plan in place there? Is that something that you've thought of?
Yeah, so my thought is that I will probably sell it like how we would do with the equity investment, right? So I would start the process maybe 2 years in advance. It will not be like right at that time, right? Because even the capital gains, like we have 3 years to reinvest, right? So I'll start it at least 2 years before my goal. So that is the thought process. So when I'll start liquidating that. So even if it takes like 6 to 8 months or even a year, I can still wait. So it need not be at the last minute. So that's the thought process that I have for liquidating the property.
Sure. So also, while analyzing your mutual fund portfolio, there were a few comments which I thought I'd share right now. So we worked out the entire asset allocation between, large cap, your direct equity, PPF, PMS, mid cap, etc., and hybrid. So you have about a 24% already, holding into large caps, whether it is index or whether it is mutual funds. So you could possibly look at, stopping Nippon India large cap fund and starting an SIP in the small cap fund, because you have about 10 years, so an SIP maybe in a small cap would probably yield you a little more, because you have thematic about 7% and your mid caps and small caps are less than 1%. Okay, so from the 10-year planning point of view, you could stop the Nippon India small cap and look at the large cap and invest instead in the small cap fund as far as your SIP is concerned. As far as your direct equity is concerned, if you aren't completely satisfied with the returns that you are making, because sometimes for a retail investor it's very difficult to select the stocks, and you might need some professional help in that area. So you could either look at a PMS which is performing well for you, or just switch over to a mutual fund, and in that case you could look at a flexi cap fund or a large cap fund and a multi cap fund. So you look at about, sorry, you were going to say something?
So a couple of questions. Sandeep, are you continuing to invest in ELSS?
No, I am in new tax regime, so I have not invested in the ELSS.
Okay, so one question would be, he would switch out of that, and I see that he's got several mutual fund schemes.
Sure.
Would you suggest a consolidation of some of this, or do you think that it's all right to have these many schemes?
Now that his SIPs basically are into Nippon 50/50, that's the Nifty 50, that's a large cap. You have iPro Nifty Next 50, then you have Mirai Asset Mid Cap, you have small cap pharma, and you've taken up a thematic call of pharma, which I think that you should continue, and you also have IT also, which you should continue. So in the SIPs, I don't suggest any change.
His portfolio?
And he also doing BAF 30,000 a month, which I think is a very good thing to do, because you're going to plan that for your property, which is a few years away. So it's good to have not 100% equity fund when your goal is a little closer, and also to have some liquidity, because in case there's a crisis or something, you can easily withdraw from a dynamic fund, asset allocation fund, rather than from a 100% equity fund, where you might feel that you aren't getting your required return at that particular time. So that's good that you're putting in 30,000 rupees in the BAF, and otherwise I think that you can continue, because it's fairly varied, and only increase towards like a flexi cap category. That part you can give up a certain amount of large cap and introduce a flexi cap and a little bit more of mid and small, because I find the portfolio lacking in that.
I'm seeing Krupa has got a lot more schemes than you have, Sandeep.
Yeah,
do you discuss the schemes with her?
So that's true.
Sorry, say that again?
No, she wanted to try out few things. So she's relatively a new investor, so she tried out a few things. So even I have pruned down my list. Even I had a bigger chunk, but I have come down there. So my question was, like you mentioned, to go with the small cap, right? So currently, like I have exposure to Nippon small cap. Should I continue in
That's the one where you continue the Nippon small cap and they add your SIP there. So stop in the Nippon large cap, start in the small mid cap. As far as Krupa is concerned, in the small caps, I'm sorry. Stop in large and start in small. As far as Krupa is concerned, she can, redeem on completion of her 3 years in the ELSS fund. She has got an ABSL ELSS fund, and instead of that, continue her SIP or the, the returns itself, the corpus, you can switch it to Motilal Oswal mid cap fund. Okay, so that maybe you'll find the that option better. And Mirae Asset Liquid Fund, you have about a small portion of about 70,000-80,000 rupees. So you can use that for your earlier redemptions, or you can switch it right now only into your large and mid cap fund, because you don't keep anything in a liquid fund unless you actually have a goal of using it in the next 1 to 3 months. So that's something that I notice. Even if it's a small amount, it's always put to better use in a higher yielding, possible mutual fund. So Krupa is, doing an SIP of 70,000 rupees. She can continue all the others. There's only one change for the ELSS, depending on also whether you've gone in for the new regime or the old one.
This is absolutely fantastic. Sandeep, I very rarely come across a couple that has gone through the kind of details that you have, and also kudos to you for having planned it, I think, together, but also keeping it separate, because this is something that a lot of people don't end up doing. One person invests for both, or one person invests and the other person saves. So it's great that both of you are investing. Any specific questions that you have for Nisreen?
Yeah, so now that we are talking about like going into BAF or multi-asset fund, right? Any particular thought which one should we go, right? I mean, I was also thinking on the same lines. Like I was looking at ICICI Prudential multi-asset fund, or Parak Parik Flexi Cap Fund, or even Nippon India Multi Cap Fund. So these were the three funds that I was looking at.
Sure.
So any thoughts there?
So you can also look at the UTI multi-asset, which has a larger proportion of gold. So White Oak and UTI both have about 90 to 20% of gold. In the next couple of years, we can, I mean, of course, commodities are already factored in, but as a hedging instrument, you can look at a higher percentage of gold. iPro will have a slightly lower percentage of gold. So, both work very well as far as the multi-assets go. If you're looking at Flexi Cap, you can look at Invesco Flexi Cap or HDFC Flexi Cap as a choice to Parak Parik as well. And if you're looking at multi-cap, you can look at Franklin Templeton multi-cap and Mahindra Manulife multi-cap. So those are the few choices that you have in terms of, not deciding the cap yourself. Okay, but the thing is that a retail investor rarely looks at rebalancing the portfolio. So I feel it's also good that you select the category and then just let it flow from there, and then rebalance maybe when you're closer to the goal.
Just a couple of questions from my end, Sandeep. You've said that your plan to retire is at 52. Does Krupa also plan to retire at 52?
Yeah, somewhere close by, right? So once our son's education and his he's on his set on his course, right? Then probably she will also take retirement.
Okay,
that's the thought.
So I just want to sum this conversation up, because we've had conversations about all of your financial goals, and I think kudos to you once again for having planned it the way that you have. I just want to establish that you've done the right things here. Okay, so Nisreen, the question is, he's got a primary goal of buying a car in 4 years. That's pretty easy, right?
Right.
He's got a pretty large corpus that he's saved up over the course of the last several years. The second one is retirement at 52. He can do that as well?
Absolutely.
And what is the corpus that he needs at that point?
So at that point of time, his corpus will be about 6.2 crores.
Yes.
And he's also kept an annual vacation corpus, which I really appreciated that.
Yeah.
Because, you are you've worked all your life. You've been, planning so well.
I'm glad.
And, it's really, as you said, Alex, kudos to him for even planning the holiday part.
Fantastic.
Okay,
So,
because then you really know that you're in the green.
Yeah. And he's planned his son's education. Irrespective of what he takes up. If he requires less, then he has more set aside for his own requirements and his son's wedding. All of those things are planned. Sandeep, this is the way that I think all of my other viewers should be planning their finances. So thank you so much for joining me today and discussing this with me and with Nisreen.
Yeah, thank you so much for your kind words. One last question, if I may, right? So I just wanted to understand, if you have to move from direct stocks to a mutual fund, is this the right time? Because everything is in red, right? So I was thinking that it'll lessen my tax burden. So is that the right time, or do you think it's better to wait and...
Sure. So, you're going to be moving parallelly. So, you're exiting at a certain index level and you're also entering at a certain index level. So, in that sense, wherever the pain is the least in terms of, capital gains, I think you should do that. But make sure that you don't sit on the liquidity, but you take action immediately and reinvest, the liquidated funds. Because it's never the right time and it's never the wrong time, but it's the time that you spend in the market, which is very relevant, from the financial planning point of view. And so keeping in mind the entire cash flow, just, last few words, that even if you calculate at 9% compounded annualized growth rate, you will still have about 87 lakhs, in your portfolio at 870, and thereafter you will start withdrawing from Krupa's. So between the two portfolios, you're going to be able to meet all your goals, including your travel plan and your medical emergencies, and your retirement also, with an 8% inflated figure every year.
Fantastic.
So, congratulations for that, Sandeep.
Congratulations, Sandeep. Thanks so much for joining me today.
Thank you so much, Alex and Nisreen. Thank you.
All right. Nisreen, so we have a couple of minutes, but I want to ask you this, right? The primary goal was to buy a car.
Sure.
And he set aside a pretty sizable amount, right?
Sure.
25 to 30 lakhs.
Absolutely.
Just to complete that point, is this a lot of people go out and buy cars on loan? Do you think that this is the right way to do it, or should you plan for it like he has done?
Right.
Say that I'm going to do this in 4 or 5 years, and I don't want to take a loan. Is that the better approach?
So, it depends on whether you have investable or, surplus. So either you take an SIP or you take the loan. Now your SIP, if you calculate it at, as what Sandeep has done, is at about 9%, but your loan is costing you 9.5% to 10%. So therein lies the question. Okay,